For Jean-Paul Agon, life at L'Oréal began in sales 39 years ago. He quickly understood the power of advertising.
Read my lips. I'm worth it.
The company obviously thinks it is worth it, spending more than $8 billion a year selling and marketing its brands. A third of that on digital media.
When I was 20 years old, I was in a business school, and at the end, I knew I wanted to do marketing. And for me, beauty is the supreme art of marketing, because it's a marketing that is not only about understanding, analytics, but it's also about emotion, guessing, creation. So I think it's a fantastic marketing. There is no better marketing than beauty marketing.
And from that 20-year-old Jean-Paul Agon, what have you learned about yourself?
My God, a lot, a lot, because it was a long time ago. No, it took me, many years to get where I am today. But I was always passionate. I think the incredible part of L'Oréal also is that every day is a new adventure. Every day is a passion. It's a company made of really passionate people, and every new mission is an adventure.
So what are you like as a leader? Micromanaging or overview?
I like overview, and from time to time I'm tempted to do micromanagement. But when I do that, my team say, Jean-Paul, you should not bother with that. Let us do it.
Do you review, though, the end product every time, or how does it work?
As much as, I have meetings of course, with all the brands, not all the time, of course. I travel in many countries around the world, and I'm just trying to help to make sure that we are taking the right directions, pushing in the right innovations, understanding enough the consumers we are dealing with, trying to pilot the ship.
L'Oréal's Sharing Beauty with All program, launched in 2013, was designed to transform the business. Jean-Paul Agon was determined to make the company ethically and environmentally sustainable. It's been recognized for its efforts, awarded a AAA for water management, climate, and action against deforestation. So when did you start thinking about sustainability?
Pretty a long time ago, especially when I came back from the USA and I took over as a CEO. I really understood at that time that for a company like L'Oréal, especially because we are the leader of the beauty industry, we had to make sure that also we would do the best and the most to make the planet a beautiful place.
What started it? Is it because you say we sell so much that we have to make sure that it doesn't go to waste? Or is it also because the consumers want something that's more sustainable? Or is it because the employees you hire want something more sustainable?
Very good points. I think it's all of that. First, because we have a moral duty. Secondly, because it's what our employees are asking for. Third, because it's what consumers want. Fourth, because it's what the society expects from a big company like us. So that's why we really went into this direction.
Does it make a difference for the consumer? I remember you telling me a couple of years ago, that if a consumer has a choice of a sustainable shampoo or a shampoo that makes our hair better, we'll always go for the shampoo that makes our hair better.
Yeah, but now what we want to do is to make a shampoo that makes the hair better and sustainable. Because now in fact, you're right. Our vision is that we have to find a way that it's not opposite, that it goes in the same direction. And it's the same for economic performance. For example, the sustainability performance should not be opposite to the economic performance. And in fact, we are able to prove that. For example, in the past 10 years, we reduced our carbon emission by 67%, when at the same time we were able to increase our production by 30%.
How do you do that?
We work a lot. We transform all our factories. We have now 10 sites that are carbon neutral. We completely transform the way also we engineer with water. We have what we call dry factories, that they don't use water at all. They completely recycle the totality of the water that they use. We eliminate waste. So it's a very comprehensive effort on all fronts to transform completely the way we produce, we distribute, etc.
And shareholders are behind you every step of the way for sustainability?
Yeah, absolutely. They are very, I think that our shareholders are very proud of what we do. I cannot say that they are pushing us hard to do it, but they are happy and proud.
Do you think Generation X cares more about this than millennials? The younger you are, the more you think about this?
I think that everybody now cares. You know, I think that it's very well understood that there is an urgency. Clearly, we are not talking anymore about a potential threat. I mean, there is a clear and present threat to the planet, and if we are not all doing the maximum in the very short term, it's going to be very difficult. So I think that every generation now understand that.
If I speak to you in 5 years, what will be your story?
In 5 years, probably I will tell you that the most important mission has been the transmission, because of course I will not be CEO forever, and I will be, by the way, very glad to pass the baton one day to my successor.
So if you think a lot about succession, what kind of successor would you like, and what would you like your legacy to be?
I will be proud to have been able to adapt L'Oréal to the new world. I think that we are living in a very special period. The world tomorrow will be very different from the world we knew a few years ago. And you know, my absolute priority right now is to adapt, transform the company in order to make it as successful as a leader, as performant in the new world as it was in the world before. And I'm very confident about it, because that's what we are doing. You know, we are doing a cultural revolution, a digital revolution, a sustainability revolution, and so the L'Oréal will be a fantastic company. And then someone else will take the baton and will drive the adventure further.
Jean-Paul Agon, thank you so much.
Thank you very much.
What do the world's tallest building, KFC in the Middle East, and e-commerce site Noon all have in common? They're all owned by billionaire Mohammed Al-Bar. His investments like the Burj Khalifa and the Dubai Mall have become iconic landmarks, and he's diversified into hospitality, retail, and e-commerce. He was named the most influential man in Dubai and consistently ranks amongst the top 5 most powerful Arab business leaders. But it's not all business all the time. He's also a sportsman. He's an active member of Emirates' horse racing community. Today, on Leaders with Laqwa, we meet Mohammed Al-Bar, the founder and chairman of Emaar Properties. Thank you so much for joining us. You've really built a conglomerate. You've built a company that has multiple interests, multiple units, multiple portfolios. Did you diversify because you saw an opportunity or because you had to?
Well, I think all of us, we look at opportunities. We don't really have to do anything. But I think looking at the Middle East and looking at the industries that I went in with my team, I think we saw amazing opportunities in the Middle East in these sectors. And I'm glad that even though we've got difficult years, the past 2 years have been difficult years for us, still these businesses are operating well. So definitely it's based on opportunities and the sector's long-term growth potential. Where do you see the most growth coming from? Which portfolio, which part of your business will do better than others? The food operating well and strong in the region as a whole, especially with the food delivery business, and that's another story. I would say that our real estate business is still flying really strong. I mean, last year we grew about 28% in the region as a whole. Our e-commerce business is something that's very, very interesting. And we've got an amazing team looking at it, and that's also growing quite fast. But even with this growth, I think one have to be realistic as well. So you look at this growth and you look at what's going on in the Middle East, government policies, look at the world economy and what changes might take place. So you have to be alert at all times. Okay, what does that mean? Do you expect a lot of the growth, in the Middle East? If you look at e-commerce, and we'll talk a little bit more about that, do you expect it to go threefold, fivefold over the next 5 years? Well, I would say that our real estate business should continue to grow at about 20% a year. And that's the shareholders' expectation. And it's hard work to achieve that number and keeping cost under control, margins under control, and political and macroeconomic issues in hand. So food business, I think we should be growing 10% a year, year on year as well in the region. And keep in mind that we're talking about the Middle East, where there is a need for most of industries to grow, just because that I think the Middle East still has room to grow. And the other thing is that if you look at the population in the Middle East as well, and the whole demographics is in our favor. Because they're young, and therefore these are, I guess, the youth will spend a lot more in 5-10 years. Yes. How will the economy shift? Well, I think the economy will shift positively only because I believe Middle Eastern governments are really working harder than any other time in the past, and you see the changes that are taking place, positive changes that are taking place in Saudi Arabia. I think that's the same thing within UAE. I would look at Egypt. I'm quite interested in Egypt as well, and the change that's taking place in Egypt, with all the other issues that we have in the Middle East, where I believe that I don't think it's going to get any worse than this. I think we're looking forward to a more positive trend in policy and in politics, and economic growth as well. In terms of growth, country by country, which is a country that will outperform the others in the Middle East? The majority of our focus is Saudi Arabia, UAE, Egypt. And I would say Egypt is going faster now. Saudi Arabia, I'm quite optimistic with the changes that you see taking place within the coming 24 months. I think you'll see quite a good trend, and the the UAE as well. You've got, of course, the other Arab countries who are some slow, some moving forward, but majority of our business are in these countries. I mean, you're holding a big investment with the PIF on e-commerce for Saudi Arabia. Will there be more, for example, on property in Saudi Arabia? Well, the Public Investment Fund, they are with us in our e-commerce business, but they are also with us in our food business. Now, are we going to do more together? I think there's a possibility. There's a lot of work that they're doing in Saudi Arabia and outside Saudi Arabia, in the region and outside. So I would expect that maybe we should look at real estate together as well, because I think Saudi Arabia will look very interesting the coming years.
How much can it grow, property in Saudi Arabia, over the next 5 years?
Oh, Saudi Arabia, I think it's at infant stage. I think Saudi Arabia can really grow if you talk about pure infrastructure, if you talk about retail, industrial, hospitality, residential. So you just have to make sure that you are going at the right category of residential or the right category of retail. So there's plenty of room to go that way.
When you look at how you spend your time for each of the units and also each of the countries, how do you do it? How do you keep on top of it all?
Well, I try. I still say that the real estate takes a majority of my time.
Is that 50%?
I would say the real estate takes about 40% of my time, and then the rest is split. Noon takes a lot of my time as well. The food takes the least of my time, because the team that sits on top of that business is really world-class team, and they've been in the industry, they know the industry well. Noon is a vibrant team. It's a new organization. I need to give it more time. While my real estate business, I have an A team, but I'm emotional about real estate.
Yeah, I mean, this was like the foundation of it all, right? Do you still see it as your baby?
I think my name is really linked to the real estate more than anything else, while all these other businesses, I've been with them now for 2 years. So it's a new brand of product that's associated with me.
When you look at the various IPOs and the various units, was it to unlock value, but did you ever feel like it was also high risk?
I think mainly to unlock value, and we have investors who have put in their money with us, and it's time for them to get rewarded. But at the same time, I really like putting management under pressure, because IPO is quarterly results. You're out there in the public eyes, under pressure to perform. But mainly value creation. I think that's the business we're in.
A value creation, because what, shareholders understand what you do more, and it almost focuses the mind of managers more?
Well, that is one, but many of our units, that if they're under the mother umbrella, I think value-wise, they're not fairly valued. So as we put them on the side and put them as separate entities, I think you create better value that way, and then you cash out a little bit and put management under pressure.
Are you looking at IPOing any other units or portfolios?
When you look at our business, we have businesses. We have India, we have our hospitality business, we have Turkey business, we have another business in Saudi Arabia. So the reality is that you can take all these businesses public at the right time. I think within the coming 3 years, we'll probably have India going public. We probably have hospitality as well going separately to the public route.
But so how much bigger will you be if I speak to you, and I hope to speak to you before, but if I speak to you in 5 years, how much will your holdings be worth?
I think we should be double in value, because we should be growing in value 20-25% on an annual basis. And I hope that my management and my boards really put that as a focus. And to be honest, I think we're capable of doing that. We just have to focus and have to make sure that we have the right people to do it. And we do this day and night. And that's really how we do business in our region.
But that's acquisitions, or that's organic growth?
I would look at organic growth. If you talk about acquisition, which we have not done much of, I'm expecting that we do more acquisition in the coming 2 years.
Mohammed Alabar, thank you so much. Coming up next, going from bricks and mortar to clicks, we talk Mohammed Alabar's big push into e-commerce and how his company Noon could become the Amazon of the Middle East. Mohammed Albar is not only a titan of property, he's also betting on e-commerce. His startup, Noon, launched its operations in the UAE last year. The site is described as an Arabic-first e-commerce platform and is rivaling the Amazon-purchased Souk, looking to take over 15% of the growing market. One of the biggest investors in Noon is Saudi Arabia's public investment fund, which put up $500 million. But Albar is not just competing against Amazon. He's also a major player in the luxury space. He's partnered with Yux Net-a-Porter Group to offer a premium retail service to the Middle East's fashionista set.
So Mohammed Albar, do you ever feel like there's a conflict that you actually own Dubai malls, but at the same time you're trying to sell on e-commerce platforms?
The issue is that, are you relevant? That's really the big question that we have, is that I don't think it's if there's a conflict or not, but are you relevant to the space? So are we really relevant in this retail scene, or in the whole, the economy is becoming so digital. If you are not thinking about it, if you're not acting to do something about it, I think there is a risk of your business being probably at huge danger the coming 24 months.
And so how do you stay relevant?
I think staying relevant, first of all, I have to talk to my kids all the time. And I learn from them because, I have a little girl that sells jewelry to women in Korea out of Dubai on her Instagram. I mean, what type of world is this? So therefore, I think all of our business, from real estate to retail to hospitality, I think the digital scene is changing all that. So if we talk about e-commerce specifically, or if we talk about Net-a-Porter, it is just moving your business to the digital scene. And I think the whole economy is moving that way, from healthcare to education to retail. So therefore, I think we just want to be relevant. And I don't think there's any conflict, because at the end of the day, there ought to be a collaboration or connection between the real world and the physical world. And can we really try to find a solution and work them together and stay relevant in our business?
But so how much of your sales will actually be done on your e-commerce platform in 5-10 years? And in general, for the Middle East, are you a step behind in actually selling on e-commerce? And so is the potential much bigger than here in Europe or in the US?
Well, remember, I mean, when I look at the Middle East right now, I mean, e-commerce is between 1.5% to 2%.
Tiny.
Which is tiny compared to the rest of the world. So there is room for all of us to grow. Where will this be? I think it will go much faster than the rest of the world, and it will get into the 10-15% quite fast, again, because of the demographics of the region. So we owe it to our society, we owe it to our 300 million Middle Eastern Arabs, that there ought to be a native organization that look after this sector and participate and learn and serve.
What will Noon become? And are you nervous at any point that you're going to head with the most successful retailer of all times, Amazon?
Well, Noon, of course, it will be an ecosystem. And am I nervous? Of course I'm nervous. I'm nervous from everybody. In my real estate business, I'm nervous. In my e-commerce business, I'm nervous. In my Net-a-Porter business, nervous because competition is severe. And markets are open. Anybody can come in. The big players are going to come in. Some of them came already. More are going to come to the region. But I am from that part of the world, and I think it's our duty to participate in the scene. And remember, we as Arab businessmen, we're a bit tribal, which means that I am from this society. I have a duty that get into business and be aggressive and achieve the numbers, achieve success. But that's a duty that I feel responsible for, that competition is good for the consumer in the region, rather than one player come and controlling the life of our customers. I think it's fair to have competition and let the customer win at the end of the day.
Okay, but how do you decide? I mean, how will you go against Amazon? Do you have to convince retailers to sell on your platform instead of Amazon's platforms, or is it a price war? I mean, how do you see the kind of the fault lines?
Well, we are working with the local retailers, and we are their partners. Now, how other international players, they do it through sourcing overseas or working in some other methods, that's their business. But we differ is that our partners are the local retailers. Maybe our margins will be a little smaller, but that's okay. We'd rather win on the long term rather than alienating the local retailers. Now, will there be a price war? Well, the past 2 months, there's a price war. Customers are winning. Everybody's 20% or 15, 10% cheaper on some of the product. So I'm so happy that people in my region, they don't have to buy milk for their kids at 10% more expensive. There was one operator or one monopoly controlling, the human life. I think this is good for all of us. So of course there'll be a competition. But the amazing thing is that the world is open. So much new technologies are being provided to everyone that want to go into the scene. But are you planning long term? You have good people with you. Are you serious about it? Are you willing to provide quality service?
But is it the service or is it the products? How does the Middle East actually shop? What's selling at the moment and what will sell in 5-10 years?
Well, if you look at the mix of what's happening on the e-commerce scene, it's not much different from what's going on in the world. People want delivery, fast delivery. People want quality.
Will they pay for the delivery?
For the time being, we're subsidizing delivery. Because, as I said, people are just learning the art of e-commerce, and that's what global companies are doing. They give it to you for free first, they get you used to this way of life, then later on take a little bit of margin, maybe control market, the usual trick. But what I'm saying is that people want it all. Want quality, want value, want consistent, want delivery time that's fast, and we want the product that they want, which changes from 1 month to another month. And therefore you have to provide that and then get ready to provide the new thing that might be happening next month.
Okay, how important is market share? And how important is market share right at the beginning so that people get used to your platform and not Amazon's?
Market share is very important, and at the beginning you have to be aggressive and you have to probably provide the best service ever. You will be cutting prices as usual because we see it, it's a live competition. There's nothing wrong with that. But the good thing is that the market's big enough. 2 players can come in. Imagine if you do business in UK and there is only one operator. How fair is that to your family?
But isn't there only Amazon here?
Well, there are many other players, I think, in UK as well. I prefer that more than one player in a market. And in the Middle East, there will be more than one player and will be one of the major players in the market.
Up next, we talk the leadership skills it takes to create both the world's largest mall and the tallest building in the world. More with Mohammed Alibar next. MR Properties has grown more than threefold since 2011 and expanded heavily in the Middle East and North Africa despite political instability in the region. So what kind of leadership does it take to shepherd a global company through turbulent times? Well, Mohammed Alibar, chairman and founder of MR Properties, is here. What kind of leader are you? Throughout the program, we were talking about encouraging your leaders, your regional leaders, and also your portfolio managers to be aggressive. Do they always need to be on their toes?
Well, I think, number one, they have to be relevant because the change that's taking place in the world. So are you relevant? And the other thing I like is that I think we all have to believe in the reset. Are we doing this upgrade? Are we upgrading every 1 month? Because there's so much happening. And do we really act? I mean, that's, so we have to be relevant, we have to act, we have to have discipline, we have to believe in the best people, and we have to take care of our society. These are things that these are the elements that I really depend on to manage my business.
Okay, but what does it mean being relevant? Because in more traditional times, you could ask a customer what they wanted, and you're saying, okay, I'm relevant. But now the change of pace is so fast.
Well, relevant is that, are you watching social media daily, what's going on with your customer? And what's going on with your business? There's no more, I'll do a research and I'll wait 30 days. How alert are you? And how alert about how your customer feel, or alert what's going on to the industry, what's going on with politics, what's going on with the economy, what's going on in new tools of management, how fast can you go? So I think, are you awake?
What do you need to be awake for more? Is it for your clients, or is it politics, or is it how your business interests are going?
Well, it's about my customer, number one, my people, number two, the society, what's going on in politics, what might happen to interest rate. You almost have to have all that construction risk in my business, what's going on in technology, what's going on in digital. You almost have to be alert of all this but number one, people. And then you have to make sure that you share with them this environment, and are they fit in this environment?
So what does that mean? What do you see your role? Are you putting the fire under your manager's feet to kind of keep them going, or do you micromanage?
I don't think I micromanage, but there's a situation where I do have to go and micromanage, and I think that's we should be able to go down in case we want to. And remember, I came from my mom's kitchen. I used to work in my mom's kitchen, and when we were all 13 kids living in one room, so I know how to do that. So I can pull back and be the chairman of the organization. But if there's need to move in, I can comfortably move in. But I have reasonably good qualified people with me. But I really think that I'm the target creator. I'm the guy who does the monthly performance reviews. I'm the guy who push the limits. I want people to work hard, because I think we as human beings, our productivity is still low.
I mean, you spend a lot of time in property because that's where you came from. That was the first company. Sure. But what excites you the most in all the others that you're doing? So hospitality, retail, e-commerce.
I would say e-commerce excites me a lot, because when I look at how the digital world is changing our lives, I come back to my real estate business and I say, maybe this office is null and void. Maybe this is all not required anymore. But also, if you look at the digital guys and you see how fast they work, or the process they use, or the age of people in these offices. Therefore, I really believe that the younger generation are running the world, and they run it extremely well. So much learning in the digital side of the e-commerce. But I think my investment in MEVP, which is a private equity firm that specializes only in digital and technology in the Middle East, with almost 80 ventures, that's amazing learning about what's going on in the Middle East as well, and the industry that are about to come.
Do you focus a lot on diversity for your companies? Is that important?
Yes, very important, very important. And I think it's happening naturally. I mean, we don't even have to do it anymore. It's just naturally, that's how.
So do you have metrics?
We have metrics, we have KPIs for that. But as I said, it's so nice that it's really embodied in the organization. It's happening automatically, and I like that.
Do you think it will increase with time, or are you going to see more female workers?
Well, the female workers are really taking charge. I mean, if you look at the people who run my organization, most of our organization, I would say most of our organization, our food boys have to have more of that. But look at our government. highest percentage of senior people in government anywhere in the world.
Mohammed Alabar, thank you so much for joining us. He is, of course, the chairman and founder of MR Properties.
Thank you so much.
Thank you.
Thanks.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live in London alongside Matt Miller in Berlin.
Anna, good morning. Today the markets say, how long will this last? Stocks drift and futures point lower as France says economic activity picked up, but slowly in April. The cash trade is an hour early. Let's get your top headlines for you from the Bloomberg terminal. No joint debt. Austria's chancellor tells us shared debt is not the answer to the coronavirus crisis. Meanwhile, Chancellor Merkel here in Germany reportedly has a workaround for the dispute over ECB bond buying. Testing times. President Trump says the U.S. has prevailed in the battle to boost coronavirus testing to capacity. This as Boris Johnson is forced to water down his plans for rebooting the UK economy. Plus, the Fed dips into credit. On the corporate side, today marks the opening of a much-anticipated facility to buy corporate debt ETFs, a key part of the central bank's coronavirus strategy. Just under an hour away now from the start of cash equity trading in Europe and the UK. Let's take a look at futures here. You can see that we have FTSE futures little changed. Futures across the board are not moving very much, although at least in Europe we see some direction, everything moving to the downside, and more so when you look at the DAX, the IBEX, and the FTSE MIB down a third right now. Take a look at U.S. futures. You see bigger red arrows there on the Dow and the S&P. Those each down 0.5% in futures terms. Nasdaq futures are off about 0.1%. Anna?
Matt, we've got some breaking news coming through from some European corporates. Let's start with the aviation sector. Ryanair saying it will restore 40% of flights from the 1st of July. Given the big cutbacks in capacity that we've seen from these aviation giants, then this would be a substantial ramp up. So restoring 40% of scheduled flights from the 1st of July. They also say that crew and passengers will wear face masks and pass temperature checks. We've seen such things taking place in many Asian airports, and we've seen plenty of imagery of people on planes already wearing masks. But this rule coming through from Ryanair, if you want to take a Ryanair flight, that's what you have to do. Really interested to see how the UK and Ireland manages the quarantine rules that have come in and were much criticised, as you would expect, or haven't come in, sorry, but will come in from the UK. Much criticised by the aviation industry in the UK, of which Ryanair is a part. Interesting to see what they make of that, given some of the exceptions that are coming through and the fact there's a common travel area across that Irish border with Ireland. We'll have to see how all of that plays out and what that means for the UK's ability to implement some kind of quarantine. Also getting numbers out of the telephone company, the telecoms giant that is Vodafone. They're saying that their dividend per share is 9 euro cents. Interesting, going into this, analysts had said that they didn't see Vodafone as needing to cut the dividend to get through the difficulties here. Vodafone does say, though, that the economic impact of COVID-19 is likely to be significant. Perhaps that's a little more aggressive language than some analysts have been looking for, reading the preview that was put together by our colleagues. They also say they're not able to provide adjusted EBITDA guidance for full year 21. They do see adjusted EBITDA for 2021 maybe flat to slightly down, and they see free cash flow pre-spectrum in full year 21 to be at least 5 billion euros. They're also giving us, and this is the metric that people often look at, the organic services revenue up by 1.6% in the fourth quarter. That is better than was estimated, but it is perhaps a little backward looking if that quarter runs from January to March. Matt?
All right, let's get the Bloomberg First Word News right now. Today's top stories off of the terminal. In the UK, there's confusion over Prime Minister Boris Johnson's plan to get people back to work for a second day in a row, maybe the third. London's Chamber of Commerce is telling businesses not to change their plans until there's more information on how to keep staff safe. Companies are also asking for guidelines on what protective equipment to buy. The government is promising to outline arrangements for public transport today, which I believe the Prime Minister recommended no one use. The U.S. has won the battle to ramp up its virus testing capacity. That's according to President Donald Trump. More than 300,000 daily tests are being conducted as of Thursday, according to the COVID tracking project. But his news conference also saw a testy exchange with reporters. That's nothing new for this president. Deaths in the U.S. have now topped 80,000. Federal Reserve officials are pushing back on the market view that rates may go negative. Both Chicago's Charles Evans and Atlanta's Raphael Bostic don't see the tool being used in the U.S. It comes as the central bank says it'll start buying corporate debt in the form of ETFs starting today. The program is coming online as part of the Fed's emergency coronavirus response. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Let's get into the conversation about what's going on in these markets. Mark Cudmore, as always, joins us now from Singapore from our Markets Live team. We've got a lackluster session taking place in Asia, haven't we, Mark? And that seems to be leading to some lackluster futures here in Europe and into the US session. In fact, US futures down a little more. We've recouped around half our losses since the March 23rd low. But are we due for another pullback? Goldman Sachs saying that we could lose up to 20%, just under 20% in the next 3 months. Do you hear people talking a lot about the need for another pullback at all, Mark?
I think we're still in the same situation we've been the last couple of weeks. In fact, what's been kind of interesting in the stock market is that we rebounded so powerfully, so quickly from the March lows, but actually the last couple of weeks we've gone nowhere. We are pretty close to these levels. We were trading within a couple of percent of these levels for all the last few weeks. We've kind of been in this weird stabilization period. And that's strange because normally when you're in bear markets, and even if we've kind of bounced out of it so quickly, you do experience these kind of volatility clusters. You don't expect to get this massive decline in the market, this massive rebound, and then sudden stability. And I'm suspicious that this stability is sustainable. I would have a lot of sympathy for Goldman Sachs' view, and I'm still in that camp. And I think what's one of the weird things is we've kind of paused at this exact level where many people expected the rebound to get to, which means that neither side can declare victory. Certainly bulls are in the stronger hand based on the last couple of weeks, but they haven't reached a point. They're not up on the year. The market is down on the year. The volume weighted average is down in the year. Most stock markets are down significantly still. It's just the US is outperforming. So bulls can't declare victory, but bears are a little bit nervous. So we're kind of stuck in that no man's land. I still think the next 20% move is more likely to the downside.
We're going to talk with, later in the program, Mark, Jeff Henriksen from Thorpe Abbott's Capital. He's also a behavioral economist at the University of Oxford. He says people really aren't looking at the amount of stimulus that's at play here and really not pricing in how much money federal governments and central banks are going to use to bring this economy back. What do you think about that view?
I mean, I've definitely heard that perspective out there. I don't think that people aren't looking at it. I think that people are struggling to understand quite exactly what the real economy impact will be, and then also how this means you should trade an equity market. So I don't think that people aren't looking at it. I think it's everything that people are looking at. It's just that we've never, as far as I know, traded in history, traded equity markets off a stimulus equation. We instead trade equity markets off earnings. Earnings are normally related to the economy. Now, what central banks have done is they've disconnected the economy or the equity market from the economy. And we know that we're now trading some new equation that's based on stimulus. But what is that equation? Like, what amount of stimulus means what multiple for the equity market, or what level of the equity market? So it's very hard for anyone to say conclusively, hey, based on these new way to value the stock market off stimulus packages, it's expensive or cheap. It doesn't matter whether you're a bull or a bear. You can't say that conclusively. So we're looking at new relationships. I think everyone is looking at that. I think it's naive to say people aren't looking at it. But I think that people are struggling to maybe do a good job of it. And perhaps he's much further ahead than many of us in working out how to actually analyze that relationship.
All right, Mark, thanks very much for joining us. Mark Cudmore there, Bloomberg MLive Managing Editor. Remember that you, too, can join the debate on MLive's question of the day. Today they're asking, will U.S., Asia, or Europe stocks do best? Give us your take. Reach out to the MLive team by typing IB plus TV Go on your Bloomberg terminal. Coming up, open borders are key to jump-starting growth. Austria's Chancellor Sebastian Kurz spoke to us about reopening the economy and told us what he thinks is the most important to an economic revival. This is Bloomberg.
There's a good cooperation on the European level to support countries like Italy, France, and Spain. So there's a package of more than 500 billion euros to support these countries, and I hope that this will be helpful.
Do you think that'll be enough, or is there going to need to be some sort of shared fiscal union in Europe to help your second biggest trading partner?
Well, I think that this package is good, but we are not in favor of ideas like Corona bonds or mutualization of debts in the European Union.
Even if it costs Italy its European Union membership, I mean, how important to you is the membership of other EU countries like Italy?
Well, there's no debate about the membership of Italy in the European Union. We are united in the European Union. There's a good cooperation, and I think that we will manage this crisis, and we will also be able to manage the economic situation. But of course, it will be an enormous difficult year.
Austria, Germany, the Netherlands, all of these countries were well prepared before the crisis hit. But there are other European countries like Italy and Spain, which were already in a bad fiscal situation. How much are you prepared to pay in order to keep the European Union together, in order to save those countries that were hit so much harder?
Well, it's clear for us that we want to support them and that we want to show solidarity. And I think it is good that the ministers for finance agreed on this 500 billion euros package to support these countries. And of course, on a European level, among the heads of states, we are also in a discussion if more help is needed.
So do you think it's possible? I mean, the austerity that you practiced put you in a good position now, but your second biggest trading partner, Italy, has 158% debt to GDP. Is it possible for them to get out of that kind of debt trap? How would they possibly do it without
Order canceled.
some form
Order
of debt
canceled.
forgiveness
Order
or shared
canceled.
debt?
Order canceled.
Well,
Order
they
canceled.
wouldn't be able
Order
to handle
canceled.
the situation without the help of the European Union and countries like Austria. But I don't think that the idea of a shared debt is the right answer.
How long do you think, Mr. Chancellor, it's going to take for economies like the Austrian economy to get back to pre-crisis levels? Now that you've earmarked 38 billion euros, you've got more measures to come. When do you see us getting back, or yourselves getting back to pre-crisis levels?
Well, at the moment, it's difficult to say because we are quite dependent on tourism. 15% of our GDP in Austria is tourism. There are some industries like automotive, which have also been hit. So it's difficult to say now, but this year, 2020, will be a very, very difficult year. But we hope that at the next year, in 2021, there will be a positive development again, but probably it could take us a few years.
I know that you're already preparing measures like tax cuts, possibly infrastructure investment, reopening borders with your neighbors. What do you think is going to be the most important move to revive the economy on the post-corona side of the crisis?
For us, for sure, the reopening of the borders is most important because we need the single market of the European Union. We are an export-oriented country, and as mentioned before, tourism also plays an important role in our country. So for the economy in general, but for tourism in particular, reopening the borders is very important.
That was Austrian Chancellor Sebastian Kurz speaking exclusively to me earlier. You know, it's interesting, Anna, he gave us the standard answer on Italy. Yes, he encourages solidarity. They've got a 500 billion euro package, and there's no need for shared debt. But the surprising thing, I think, is that he says opening the borders is the most important aspect to revival of the economy. And you got to think that not just for Austria, but for all European countries, it is really key to get these borders back open again to really improve trade and get the money flowing.
Yeah, that reliance on tourism, surely a big issue the further south you go in Europe, but indeed for Austria, as you discussed in that conversation. I find it interesting that the narrative around solidarity and shared debt doesn't seem to have moved all that far, with northern states versus southern states, to use an imperfect approximation of the debate over corona bonds or other kinds of mutualization of debt. It doesn't seem to have moved on very far, does it? And we spoke to the Spanish economy minister yesterday, who said that they don't even need to tap the ESM. She said they're fine raising money in the markets on their own. If that were not the case, I wonder if things would be moving quicker, if we did see some more panic in yields. Let's tell you what's coming up on the programme, though. We're going to be talking about what the Fed is doing. The Fed jumps into the credit ETF market today. They announced that they would do this back in March, but we've been waiting for them to actually get involved in that market. We'll talk about what that means for corporate debt investors. That's next. This is Bloomberg. Welcome back to the European Market Open. We're 40 minutes away from the start of the European equity trading day. It's looking a little lackluster. The Asian session been weighed down around concern. Well, is it around trade? Is it around valuations? Is it the fact that stocks have rallied quite a way off their lows, recouped half of the losses? Let's talk about what's going on with the Fed and the things that they are buying, shall we? Today marks the start of the much anticipated move from the Fed. The central bank will start buying corporate debt ETFs. It's a key part of its emergency coronavirus lending program. Let's get to Steen Jacobsen, who joins us now from Saxo Bank. Steen, great to speak to you as ever. Your thoughts on what the Fed is buying? Some people have slightly flippantly said you just need a strategy now that buys what central banks are doing. I'm sure life is more complicated in your view.
Absolutely. I mean, one thing being that they're now entering into the junk bond market, and that cascading default effect that will come to this market is going to be interesting to follow 6-9 months down the road. But today is the start of the buy program, but it's not really the start of market having bought this already. If you look at HYG, which is a proxy for this, it's trading in the middle of the range from pre-COVID, and of course up from the middle of where it was at the low end of it. So market is already anticipating this. For me, it is clearly more about what the Federal Reserve is going to do, a negative interest status of interest rather than this. But I'm going to be following this credit element from the cascading of the the investment credit into the junk bond move, and how much Fed is actually going to end up with for ultimately, as they claim to be, the treasury in the U.S.
So what do you expect the Fed to really move the needle on then, Steen?
I think first up is the yield curve control. The amount of issues that we see in the Treasury market right now indicates that we have a yield steepening going on, which is the market repricing the amount of issues that's coming from the Treasury, and I think part of that ultimately could lead to a slightly negative view in the 10-year sector, which I think will force the Federal Reserve to a yield curve control inside the space of this year. So somewhere when we get into the autumn session of the Federal Reserve, that will move to yield curve control. And on the issue of negative interest rates, I see a lot of the Fed governors has been pushing back, but it's kind of irrelevant in my opinion. If the market pushes them to negative interest rate, the Fed will follow them, because Fed is not proactive, it's retrospective in terms of what it does. And I think if you look at the curve right now, we are trading negative interest rates somewhere between December of 2020 and March 2021. So will be as it always is. It will be when the market takes Fed into negative interest rate that will dictate this move.
So you think that the market can push the Fed in that direction, Steen? We've seen these record auctions in treasuries, whether that's 3s, 10s, 30 years, a lot of that coming this week. What will cause volatility in these auctions or around treasury markets at this point? Because there is so much issuance, so much focus on supply. Will we get some volatility around that?
It really depends on the overseas ability to want to buy. I mean, don't forget we had over the last 48 hours another escalation in the China-US rhetoric. China has historically been big. Another overseas customer has been the GCC. As you saw with Saudi Arabia's desperate move this morning on the budget side, they clearly don't have excess funds to play with. So I think, down the line, right now we are in okay position in terms of the market taking the issuance. But as this issue continues to be forthcoming, I think the overseas market will take less and less on this, which will put the omen on the market to be the domestic savers. And as we know, the American is not exactly, sorry Matt, famous for having a high saving rate.
No, it's very true in my case as well, because I try and spend just a little more than I make at all times. I wonder what you think about buying U.S. stocks, though, Steen, versus buying, I try and focus on Europe since I'm here, but we just don't have an Apple, an Amazon, a Google, a Microsoft. I mean, European stocks just don't have these mega caps.
True, and of course it's hurting, and that's what all the outperformance is. I mean, a friend of mine has started calling the S&P 500 the S&P 5, which I think is a good analogy to your question. The 5 names is really everything. But if, I still think the stock market is really driven by a number of factors. One being that the left tail of the risk curve has been taken out by the Federal Reserve, at least in the short term, and the fact the amount of liquidity. But don't forget that the Federal Reserve can create liquidity, but they can't substitute net demand in the economy until they move to actually being able to spend money directly, which is not.
Think we had a problem with Steen's line there. Thank you so much, Steen. If you can still hear me, we were just coming to the end of our conversation, so thanks for joining us. Steen Jacobsen, CIO of Saxo Bank. Coming up, we'll talk about the UK's response to coronavirus. Boris Johnson waters down his reopening of the economy plan. Employers and trade unions tell the Prime Minister that workplaces are not COVID secure. And we hear a bit of a change in tone last night from the Prime Minister. We'll talk about that, about the UK returning to work next. This is Bloomberg.
All right, we are getting breaking news from Saudi Aramco right now. They're publishing their profit and revenue figures in terms of reals. We can see that Aramco's first quarter profit is 62.48 billion reals right now. Revenue in the quarter, 225.57 billion reals. So profit in dollar terms, which may be a little bit easier for you to digest, $16 billion at Saudi Aramco. $16 billion is what they made in the first quarter in dollar terms. The dividend also, of course, published and paid in dollars, $13.4 billion in the first quarter. So it's a hefty chunk of their profits. They're paying out $13.4 billion. They made $16 billion. In terms of the second quarter dividends, it's going to be even more. $18.75 billion will be paid out in the second quarter, according to Aramco, although it does, of course, see COVID-19 weighing on its earnings. According to the statement, you'd have to be blind not to see that. In any case, they're confirming that they also see what we all see. They took steps to further optimize CapEx in 2020, which you got to bet means bringing CapEx significantly down. They do say they're going to retain significant flexibility to adjust expenditures, and it's good to have that anytime you're running such an important company. They've identified opportunities, Saudi Aramco says, to improve operating productivity. So just to repeat, they had $16 billion in profit, paid out $13.4 billion in dividends, and they plan to pay $18.75 billion in the current quarter. Anna?
Let's move on from the oil story, and we will get back to that Aramco story shortly. We'll get to our colleague Anne-Marie Hordern for some analysis a little bit later on this hour. Let's turn our attention to the fight against COVID-19 and how that rubs up against reopening the economy. Boris Johnson here in the UK waters down his plan for rebooting the UK economy. Employers and trade unions have told the British Prime Minister that many workplaces aren't ready for the restart that he called for in a TV address on Sunday. Johnson tells employees that they should now think about going back to work, providing your workplace is COVID secure and providing you can travel to work safely. He said employers can't force staff to return to unsafe environments. I'm very pleased to say that we're joined now by Kate Bell from the TUC, where she's head of Rights International, Social and Economics. Kate, good to have you with us then. Your reaction, do you see a change of tone? Do you welcome a change of emphasis from the British Prime Minister saying that workers cannot be forced to go back to workplaces that are unsafe?
Well, we've had a very confusing few days, I think, for most workers across Britain. We had the kind of pretty chaotic announcement on Sunday, which suggested that workers should go back on Monday. Yesterday, we did see new guidelines published around workplace safety, and we do think they're a step forward. Really important that no one is forced into work in a workplace that is unsafe. And some signs that governments have been listening to what unions have been telling them for weeks around the need for employers to conduct a risk assessment, to publish that risk assessment so that workers can actually know the steps they've taken to make their workplace safe. But of course, those risk assessments still have to happen. People need to be able to see them. We still have to have the guidelines about how transport will be safe for people to get to work. And there's, the ongoing crisis in personal protective equipment, and whether people can have access to that too. So, still quite a lot to be done before people can feel fully secure about going back to work.
He did urge, I'm trying to remember what he said on Sunday, and it was a lot of maybe slightly confused. Well, it raised more questions than answers, as people have been saying. I believe he urged people to avoid public transportation, right? He said it's much better to drive, or even better, walk or cycle to work. Does that mean if you need to take public transportation, then you should be staying home?
Well, it's been slightly unclear. That was one of the things that caused the confusion. I think the guidance is slightly clearer now, saying, you can only to avoid public transport where possible. I live in London, and it's simply not possible
Order
for
submitted.
many people in London
Order
to be
submitted.
avoiding
Order
public
submitted.
transport. That's,
Order
millions of
submitted.
people catching
Order
the tube
submitted.
every day to
Order
get to
submitted.
work. I think we are expecting new guidelines on transport on how to maintain social distance on transport, which is really, really necessary. But I think there will be real questions for people who simply can't get to work if if transport isn't running, what they're meant to do. And I think we do need further reassurance on that.
We see reports today, Kate, that the Chancellor might extend the furlough scheme from the end of June to the end of September, so allowing the Treasury to pay people's wages for a number of, for more months. I suppose that's something that you will welcome if we hear that later today.
Absolutely. I think what we've learned over this week is that, the economy is still going to be restricted for quite many months to come, basically. And many people who want to be back at work, businesses who want to be open, can't be in the foreseeable future. And during that time, it's vital that the furlough scheme continues playing that really valuable role it's had of keeping people in work, of protecting people's livelihoods, and making sure that, when it is safe to reopen those businesses, they're ready to go. They've got their trained staff still on their books, and, those staff haven't kind of experienced a catastrophic hit to their income. So that would be a welcome announcement, and looking forward to hearing what the Chancellor says this evening, I think.
Kate, how many people do you expect to remain working from home? I mean, we've heard from bank CEOs that this is functioning a lot better than they had anticipated. We've heard from a lot of CEOs that they themselves plan to remain working from home for at least some of the time. Is this going to be a new normal?
Well, I think one thing that did come out of that guidance yesterday, and in fact actually was clear on Sunday, was the Prime Minister said clearly, work from home if you can. I think people have been surprised about how they've been able to work from home, how that's gone much better than expected for many people. And I think office workers are going to see, probably a long period of working from home. But that's simply not possible for many people. And I think, one of the other things we saw this week was those kind of awful mortality statistics from the Office for National Statistics showing the kind of jobs which are facing heightened risk from COVID. So people who really can't work from home, so security guards, taxi drivers, cleaners, care workers, and I think those are the people who we've got to be absolutely crystal clear that employers have a duty to protect and must do those risk assessments to make their workplaces safe.
If we see a situation, Kate, how do we get the unions and employees and the government on the same page here? If we see recommendations drawn up and companies can demonstrate that they have followed those recommendations, should staff then feel that everything has been done that can be done to go back to work? And would you then recommend that people do?
Absolutely. And, we know working people, our members want to go back to work. They want to be working, they want to be, earning a livelihood. It's worth remembering that if you're on the furlough scheme, you're taking a pretty big cut to your pay. You're taking, a fifth of your pay has probably been cut unless your employer's topped that up. And, the people want to go back to work. They want to know it's safe. And what we've been calling for all along is just make sure that employers, do provide them that reassurance that it's safe, that they conduct that risk assessment, that they set out the steps they'll take to protect people, and that they publish that so that people can see what they're doing. And then I think, people do want to go back to work, and that's what they'll do when they know that their workplace is secure.
All right, Kate, thanks very much for joining us. Kate Bell, their head of economics at the Trade Unions Congress, talking to us about the confusion generated by the Prime Minister's announcement of economic reopening on Sunday. And I have to say, I lived in London for 3 years, and I never took public transportation. Even living in Chelsea and working in the city.
I'm not sure your experience is typical.
But I found,
yes,
I rode a Vespa.
Working in the city. I'm not sure your experience is typical, Matt.
I'm just saying, I think a Vespa or a bicycle is a much better way to get around. And in any case, that's just my personal advice,
I've been Googling
advice
e-scooters.
there. Yes, great. Very green and quick. Let's get your Bloomberg First Word news from the Bloomberg terminal right now. The U.S. has won its battle to ramp up its virus testing capacity. That's according to President Donald Trump. More than 300,000 daily tests are being conducted as of Thursday, according to the COVID Tracking Project. His news conference, as usual, got a little bit testy with reporters. But deaths in the U.S. have now topped 80,000, and that drives temperatures higher, of course. Federal Reserve officials are pushing back on the market view that rates may go negative. Both Chicago's Charles Evans and Atlanta's Raphael Bostic don't see the tool being used in the U.S. This comes as the central bank says it'll start buying corporate debt in ETF form today. That program is coming online as part of the Fed's emergency coronavirus response. But again, more voices repeating what we've heard over and over again. The Federal Reserve doesn't want to use negative rates. Here in Germany, the Chancellor Angela Merkel trying to diffuse the growing crisis over a German court's ruling on the ECB. A key question is who should respond to the judges, the ECB or the National Central Bank, the Bundesbank? Sources tell us Berlin thinks it can be local policymakers who could provide or could prove less controversial in a response, but the Bundesbank itself seems to suggest it will take a support role with the ECB taking the lead. That'll be interesting to watch. Global news, 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Minutes away, just under 20 from the open now. Up next, we're going to get your stocks to watch, including Allianz, after PIMCO clients pull almost $50 billion. This is Bloomberg.
Welcome back to the European Market Open. We're still 15 minutes away from the start of the trading day for this Tuesday here in Europe. But let's get some of the stocks that we're watching. We've been looking at the details of the earnings season. It seems to be calming down a little bit. We are getting some earnings. We're also getting some other announcements, in particular from leisure businesses. Let's get to Danny Berger. She's got a rundown for us. Danny, where do you want to start?
Anna, starting with Allianz here, the asset manager and insurer seeing major outflows specifically from its manager, PIMCO. They oversee a lot of bonds. They're, of course, famous for this, seeing about $46 billion of outflow over the past quarter. And they're also dealing with the hurt of just being an insurer. More people taking claims as the coronavirus impact hits people, less people working. Last week, they did give their dividend, but still their buyback currently suspended.
All right, we've got Ryanair as well to talk about. What's going on there?
Yeah, so Ryanair is saying that they're going to restore 40% of their flights by July 1st. This means thousands of flights daily, getting up to about 90% of their pre-coronavirus capacity. But one thing here, one little caveat they put in this is saying that it's, of course, subject to government regulation, whether the governments are allowing this, and also just the health screening they're able to do. So they say they're going to require both crew and passengers to wear masks and take temperature checks. Still, again, by July 1st, 40% they're hoping to restore flights by.
All right. This is personally painful to me, because my wife is stuck in Spain. She had a Ryanair flight May 4th. It was pushed to May 16th, then May 23rd, and now they're saying July. And I don't know how I'm going to get her back, Danny. But I guess I'll have to deal with that myself. Danny Berger, thanks very much.
Yeah, hopefully
for
by
your
July.
Help there on the stocks to watch this morning. So, how do you pull off a merger during a lockdown? Well, we spoke to Mike Fries, Liberty Global CEO, about exactly that. It's a $30 billion deal between Liberty's UK broadband network, Virgin Media, and O2, the UK wireless business of Spain's Telefonica. Listen to Fries in this exclusive interview.
There's no relationship between the balance sheet and what we deliver to consumers. As you know, Ed, we run our businesses in Europe at 4 to 5 times leverage and have done so for 3 decades. The key is generating free cash flow, and we will generate meaningful free cash flow from this combination. We each already generate meaningful free cash flow. So we're producing cash at the end of every year. There's no deficit. There's no impact whatsoever. We invest 20+% of our revenue into our networks and our consumers and innovation and technology every single year. So I don't see any impact between the balance sheet and consumers benefiting.
And on that investment, Mike, you talked about this £10 billion the combined company is going to be rolling out into 5G. How has the current crisis changed some of the expectations, both about your ability to invest and deploy that capital into 5G, but also perhaps in the way the government are going to be issuing 5G? Do they increase some of the cost for spectrum as a way of clawing back some of the revenue that they're going to need to fill the budget hole left by the crisis?
Well, listen, every country is handling it differently. For the most part, I think this has been an eye-opener for regulators and government that their broadband providers, their mobile providers are critical and essential infrastructure. So I don't believe there's any body today looking to penalize or in any way make it harder to develop next generation infrastructure. Quite the opposite, trying to make it easier, trying to ensure that companies have the resources and the spectrum they need to deliver even better, faster, more reliable services. So
easier, but potentially more expensive, right?
Well, I'm not so sure. I mean, generally speaking, if you look at the price of broadband today versus what you were getting 10, 15, 20 years ago, or even 5 years ago, we're offering on average in the UK 150 megabits per second is the average speed that our customers are paying for and getting today for, ARPUs that are not meaningfully higher than they were when they were getting 5 megabit or 10 megabit. So the price per megabit has come down materially, and the quality of services have only gotten better. I see that trend continuing because it has to continue. It's a competitive market. We're going to compete with BT, Vodafone, Sky. Then this combination needs to put customers first, and you don't do that generally unless pricing is a big part of that. So.
And Mike, I want to talk about BT because obviously, as you say, this does put you much more in line with competition against them because you are going to be now this combined sort of mobile and broadband operator. Philip Jansen said last week that they were going to be actually cutting the dividend for a period of time because of some of the headwinds created by the COVID crisis. Are you going to face similar headwinds? And if so, what do you do to sort of mitigate?
Well, I can't speak to BT specific, challenges or opportunities. It's a great company. Philip's a great CEO. Say that. On the other hand, we don't pay a dividend today, and this JV will have a 50-50 ownership structure, and it won't be publicly traded. So we don't have the legacy headwinds, if you will, of our capital structure or a dividend. We also, I think, are very nimble. We've been able to build networks right through the crisis. As an essential service, we have crews in the streets extending our 1 gig platform, pushing broadband out to other communities. And so I think for the most part, I'm not going to say business as usual, but the headwinds for us are very different. Competition is a headwind for sure. There are some very specific things, that we pay taxes on and things like that in the UK on our networks. But I would say the organic headwinds we think are manageable here.
That was Mike Fries, Liberty Global's CEO, talking about consolidation, in particular in the UK media space. Up next, we'll delve into the details of that report, the earnings out of Aramco, the energy giant reporting a sharp decline in profits for the first quarter. We'll break down the numbers and what you need to know. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are just about 7 minutes to go until the start of cash equities trading. And right now you can see futures are all pointing down, with DAX futures losing 0.5%. Saudi Aramco reported a first quarter profit of $16 billion US. Sounds like a lot, but it's a 25% drop year on year after the price of crude plunged in March. Due at least in part to the oil price war and in part to the demand slump from the coronavirus. The state oil producer says the results mostly reflect the drop in prices, but sticking to its commitment will be paying out almost $19 billion US in dividends. Joining us now to discuss further is our reporter Anne-Marie Hordern. Anne-Marie?
Good morning, Matt. Well, basically, as you say there, it sounds like a big number, $16.6 billion. This is the world's most profitable company, but it is a 25% drop year on year. And of course, has everything to do with what we've been witnessing the past few months in the oil market, this twin shock on the supply side, given the oil price war, which of course Saudi Arabia and Russia, and then the demand side and the pandemic and what that means for demand around the world. Interesting, especially today, Bernard Looney of BP speaking to the FT, questioning potentially had we seen peak oil demand. Possibly, he says he won't write that off. The dividend is important, as you say there, $18.75 billion for the first quarter dividend. That keeps Aramco on pledge for full year payouts to shareholders of $75 billion. We have seen them already, though, slash spending. Part of that is to make sure they could keep this sacred dividend in place. One interesting thing they did say as well is that looking ahead to the remainder of 2020, Aramco expects the impact of COVID-19 pandemic on global energy demand. We've already seen what happened yesterday. A lot of surprises coming out of the kingdom. On the financial side, we're seeing austerity measures, really drastic ones taking place. And then from the ministry yesterday, they said they were going to cut oil output even further, taking them below 7.5 million barrels a day, which is really key because a lot of consultants and traders talk about that 8 million barrels a day being quite a red line for Saudi Arabia.
Anne-Marie, thank you very much. Anne-Marie Horden with an update on what we can expect from Aramco. We'll look for the opening of the Saudi market. Of course, we saw some big moves on some of that, the change in policy that we've seen from the Saudis from a fiscal perspective, the VAT policy that had a big impact earlier on this week. We'll look to see whether we get any movement in Aramco then. And we've got European equity markets cooled down right now. Euro Stoxx 50 down by, in the futures market, down by around 0.4%. So we'll see whether we get some weakness coming through. In the Asian session, we were weighed down by concerns around valuation. Also, of course, the fight against COVID-19, ever present in the minds of investors, but also trade tensions between the White House and China. All of that very much to the fore. We'll get analysis at the market open. That's coming up next. This is Bloomberg. A minute to go until the start of the European equity trading day for this Tuesday morning. Let's get to your headlines. No joint debt. Austria's Chancellor tells Bloomberg shared debt is not the answer to the coronavirus crisis. Meanwhile, Chancellor Merkel reportedly has a workaround for the dispute over ECB bond buying. Testing times. President Trump says the US has prevailed in the battle to boost coronavirus testing capacity. This as Boris Johnson is forced to water down his plans for rebooting the UK economy. Plus, the Fed dips into credit. Today marks the opening of a much-anticipated facility to buy corporate debt ETFs, a key part of its coronavirus strategy. Matt, what do we see in futures?
We see red arrows here, not big size, but definitely a direction. Euro Stoxx 50 futures down 0.5%, as our DAX futures, FTSE futures doing a little bit better. So it does look like we'll see the continental indexes fall further at the open than we do the FTSE 100. Take a look. Right now, markets are opening up. The FTSE is typically the first out of the gate, and it is down, although only 1 or 0.2%. Let's look at the IBEX. Spain usually comes out next, and IBEX futures actually a little bit higher currently. The only continental index that showed a green arrow on futures. You can see there the cash trade was up momentarily and is now back down. The CAC 40 down 0.4%. The German DAX also down 0.4%. So looks like the IBEX is swinging between gains and losses in Madrid, but otherwise we're seeing European equity indexes, including the FTSE, fall 0.4 to about 0.5% right now. Anna?
Let's check in on the Aramco share price, the oil giants in Saudi Arabia, opening up at this hour. And, of course, we've had earnings through from Aramco. The stock on the move then this morning, but just up by 0.3%, so not a big move coming through so far. We'll see how the market digests the latest from Aramco. The CEO saying that the company took further steps in the first quarter to optimize 2020 capex and giving a host of updates in terms of profitability and the dividend, paying an $18.75 billion dividend for the first quarter. Saudi Aramco's profit drops 25% on crude prices plunge. So we certainly see that the market is open in Saudi Arabia and the stock is making a very small move to the upside, as I say, up around 0.3%. Let's get to the broader market picture then. European markets opening broadly lower. That's amid concerns that a renewed pickup in virus infections makes it tougher to justify current valuations. Joining us now is Esti Dweck, Head of Global Market Strategy at Natixis Investment Managers. Esti, great to speak to you this morning. So we've seen global equities, they sold off from March into April, and now they've recouped around half of the losses that they made since the March low. Do you think we are, well, I mean, I suppose, do we head higher from here? Is there enough solid information to trade on to take us higher, or do we remain nervous around a second spike, around trade tensions, and see reasons to sell risk assets?
I think we're probably going to be at least in consolidation and probably with a little bit more volatility in the coming weeks, because we've priced in a lot of the good news already, and especially a lot of the stimulus. And of course, markets are looking forward. They're looking to 2021, but there's still a lot of question marks about 2020. And at some point, I think
order
the
canceled.
rally is going
Order
to stall.
canceled.
Now,
Order
given
canceled.
the
Order
size of
canceled.
the rebound,
Order
and
canceled.
given that it is
Order
quite
canceled.
consensus that we are going to get this second leg down, it might not be as strong on the way down as what we might have expected a month ago. But at some point, volatility is going to pick up.
So what kind of second leg down? What kind of size are you seeing?
Well, I think there are two different views. There's the view that the rally has been because people were worried they were missing out, and that's why it's continued so much. And then there's the view that people have missed this rally, so as you see a fall, they're going to buy the dip. So I'd say anywhere 10 or so percent. I just don't think we go back to the March 23 lows.
Esti, we saw reports from the White House yesterday that they were taking measures to stop government pension funds, government retirement funds in the United States from investing in Chinese stocks. This just the latest round in tensions, I suppose, which had been very much on the back burner and have now really stepped up once again between China and the United States. Are you watching that trade deal that was signed at the start of this year and just hoping it doesn't unravel ahead of the election in November? How focused are you on trade, given we're dealing with the virus globally?
Well, I think that we've seen actually in the last few weeks when these trade headlines have popped up, you've seen some of the bigger market reactions. So that's definitely something we need to keep an eye on. there was hope at the beginning that you'd have more coordinated global support and that it might actually help with the trade relations, that they might ease a little further because we're pretty much all in the same boat. But what we've seen in recent weeks, it's actually been the opposite, and tensions have been exacerbated. So we are keeping an eye on the trade deal. I'm not sure if it's this first phase that was signed that's really in question. And I don't think that tariffs are the way the U.S. would respond and the smartest way for the U.S. to respond, given everything the U.S. economy is already facing. But I definitely think from a sentiment perspective, this trade situation is going to remain on investors' minds, and it could be one of the catalysts that sort of leaves sentiment a little bit more fragile, a little more bearish than what we've seen recently. Because if you're projecting forward, if you're thinking about risks to this trade deal, if you start to think about the U.S. election, granted it's still quite a few months away, but obviously the situation could deteriorate, especially if Trump gets reelected.
I wonder what you think, SD, though, still in terms of U.S. stocks. I mean, the question of the day on the MLive blog is, do you prefer the U.S.? Do you prefer Asia? Do you prefer Europe? And we were talking with Steen Jacobsen earlier, who said the U.S. has the advantage of these mega caps. There's no trillion-dollar companies here. And they're what's driving sentiment right now. What do you think?
I agree. I mean, when you look at the number of stocks that are actually pulling the market up, it is a lot of these stocks. It's a lot of technology. It's biotech. Those stocks, I think, are going to continue because it's going to take a long time to get back to normal. And a lot of these companies were pretty much already set up for this work from home or this stay-at-home spending. So their growth patterns are going to be much more secure, I'd say, than a lot of other areas. So valuations, of course, are rich. That hasn't stopped the rally in the past. So I'd agree, especially on a sort of even medium-term basis, that the U.S. is likely to outperform. And what we're seeing in the short term is you want to maybe be part of this rally. We think it's a bit early. We want to be a bit more cautious still. But if you wanted to be part of this rally, what investors are doing is focusing on growth, focusing on defensive, focusing on quality. And I think that gives an advantage to the U.S.
All right, SD, we're going to keep you with us. More from SD Dweck, Head of Global Market Strategy at Natixis Investment Managers, coming up. Also, open borders are the key to starting growth. I was surprised by this. I asked Austria's Chancellor Sebastian Kurz earlier what he thought was most important when it comes to reopening the economy. A stimulus kick from tax cuts, maybe infrastructure investment projects, or opening the borders between, say, Italy and Austria, Germany and Austria. He said the latter was really the key, and that may hold true for other countries as well. Certainly in the South. We'll hear that interview next. This is Bloomberg. Welcome back to the European Open. Right now, 10 minutes into the session, and you can see there are some mixed markets here with the FTSE MIB in Milan trading higher, the IBEX as well, the DAX and the CAC are trading lower, and the FTSE unchanged. Now in Austria, the economy may take a few years to reach pre-crisis levels, while open borders will be the key to jump-starting economic growth in the country and in the European Union, according to the Chancellor of Austria, Sebastian Kurz. I spoke exclusively to him earlier. Kurz also said Italy can't handle its debt load without EU assistance, as it approaches 160% of GDP, but shared debt is not the answer. Take a listen.
There's a good cooperation on the European level to support countries like Italy, France, and Spain. So there's a package of more than 500 billion euros to support these countries, and I hope that this will be helpful.
Do you think that'll be enough, or is there going to need to be some sort of shared fiscal union in Europe to help your second biggest trading partner?
Well, I think that this package is good, but we are not in favor of ideas like Corona bonds or mutualization of debts in the European Union.
Even if it costs Italy its European Union membership, I mean, how important to you is the membership of other EU countries like Italy?
Well, there's no debate about the membership of Italy in the European Union. We are united in the European Union. There's a good cooperation, and I think that we will manage this crisis, and we will also be able to manage the economic situation. But of course, it will be an enormous difficult year.
Austria, Germany, the Netherlands, all of these countries were well prepared before the crisis hit. But there are other European countries like Italy and Spain, which were already in a bad fiscal situation. How much are you prepared to pay in order to keep the European Union together, in order to save those countries that were hit so much harder?
Well, it's clear for us that we want to support them and that we want to show solidarity. And I think it is good that the ministers for finance agreed on this 500 billion euros package to support these countries. And of course, on a European level, among the heads of states, we are also in a discussion if more help is needed.
So do you think it's possible? I mean, the austerity that you practiced put you in a good position now, but your second biggest trading partner, Italy, has 158% debt to GDP. Is it possible for them to get out of that kind of debt trap? How would they possibly do it without some form of debt forgiveness or shared debt?
Well, they wouldn't be able to handle the situation without the help of the European Union and countries like Austria. But I don't think that the idea of a shared debt is the right answer.
How long do you think, Mr. Chancellor, it's going to take for economies like the Austrian economy to get back to pre-crisis levels? Now that you've earmarked 38 billion euros, you've got more measures to come. When do you see us getting back, or yourselves getting back to pre-crisis levels?
Well, at the moment, it's difficult to say because we are quite dependent on tourism. 15% of our GDP in Austria is tourism. There are some industries like automotive, which have also been hit. So it's difficult to say now, but this year, 2020, will be a very, very difficult year. But we hope that at the next year, in 2021, there will be a positive development again. But probably it could take us a few years.
I know that you're already preparing measures like tax cuts, possibly infrastructure investment, reopening borders with your neighbors. What do you think is going to be the most important move to revive the economy on the post-corona side of the crisis?
For us, for sure, the reopening of the borders is most important because we need the single market of the European Union. We are an export-oriented country, and as mentioned before, tourism also plays an important role in our country. So for the economy in general, but for tourism in particular, reopening the borders is very important.
Austrian Chancellor Sebastian Kurz there speaking exclusively to us earlier. Esti Dweck, head of global market strategy at Natixis Investment Managers, is still with us. And Esti, he makes a good point. You know, I want to go climbing in Kufstein. I want to ride my motorcycle over the Großglockner Pass. I want to buy Tracht at Lodenplankel in Vienna. I can see that they need consumers coming back into the country. Is this important for other countries in the EU? Is open borders kind of holding back an economic, a little bit, an economic revival?
To a certain extent, absolutely. But not that many countries seem as open as Austria at the moment about reopening borders. I think the fears of a second wave and not being able to contain that second wave are still taking precedent. So we're still in May. Let's see in a month or so, as we come closer to school holidays, how different governments approach this. But you definitely need to have this flow. The second question is going to be, how safe do people feel about traveling? So I think it's one of the steps, but this contagion, the second wave, the fears and the confidence are going to remain big hurdles for quite a while.
Yeah, there's plenty to weigh up. How safe do people feel about traveling? How secure do people feel in their employment as well? Esti, I wonder about the unemployment rate. We've seen, of course, US unemployment numbers hit the headlines on Friday. In Europe, do you think we'll end up with a lower unemployment rate because of the schemes in place, or will that joblessness just be delayed in Europe?
I think most likely it'll be delayed. Do tend to see more sticky employment in Europe. It's not as easy to come in and out of jobs. And we also did see the unemployment rate take a lot longer to go down, and it was never as low as the levels we reached in the US. But the flexibility of the US market should hopefully allow it to start quicker when it can restart. And I think the speed of this is going to be the big question. In Europe, a lot of the programs have tried to sort of suspend in time this employment picture and a lot of these jobs, but we don't know how long it's going to take to be able to get back to normal. Clearly, it's months and quarters, not weeks. We don't know what damage we're actually going to get from this crisis. And so I think hoping that you can just pause employment for 3 months and then go back to normal is a little optimistic. So over time, we think that the U.S. will end up on the better side. There will be probably less longer-term consequences. But the fact that U.S. data is a lot more timely than Europe makes it a difficult comparison. So it's more about structures of the business, and of course, consumption in the U.S. Tends to pick up. I wouldn't bet against the U.S. consumer. So if that picks up better, then those are better prospects for jobs as well.
Very good point. And Esti, we had a story out yesterday on the Bloomberg by Carolyn Look pointing out that here in Germany, we think the Kurzarbeit program is going to save jobs, but 1 in 5 German companies has been firing employees in April. So there was an IFO Institute study pointing out that it's not helping as much as maybe you would expect it to. Esti Dweck there, head of global market strategy at Natixis Investment Managers, stays with us. We want to talk when we come back about the Fed jumping into the credit market, the corporate credit market. It's going to buy ETFs. We talk about what that means for corporate debt investors. Next, this is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open right now, 23 minutes into the trading day, and we're starting to see equity indexes turn higher on this Tuesday. The FTSE now up 0.6%, and we see gains in Milan on the FTSE MIB as well. The IBEX 35 in Spain also putting up a gain of 0.6%. Now, let's get the Bloomberg Business Flash. These are the top corporate stories from the Bloomberg terminal today. Saudi Arabia's Aramco reported a 25% drop in first quarter profit as the price of crude plunged due to the price war and the coronavirus. Income for the 3 months declined to less than $17 billion, but the Saudi oil giant says it is still on track to meet its dividend pledge, a full-year payout of $75 billion in U.S. dollars. Ryanair plans to restore around 40% of its scheduled flights, but not until July 1st. The plans are subject to government restrictions and effective health measures being put in place. The airline also says crew and passengers will have to pass temperature checks and wear face masks. Meanwhile, Vodafone kept sales growing in the last quarter, and it's still pressing ahead with plans to spin off its wireless tower collection. Vodafone wants to bring in new investors for the separate company and says it's still on track to sell or list a stake in early 2021. The company also wants to streamline, setting a new goal of 1 billion euros in annual cost savings within the next 3 years. And that is your business flash. Now, today marks the start of a much
Matt, let's talk about what's going on with
from the Federal Reserve. You read my mind.
It does.
Let's
it does.
If
the Fed will start buying corporate debt ETFs, it's a key part of the central bank's emergency coronavirus lending program. Of course, we heard about it in March, but they start doing it today. Today marks the start of a much anticipated move from the Fed then. So let's talk to Esti Dweck, head of global market strategy at Natixis Investment Managers, who's still with us. Esti, so we've seen the Fed support the markets in various ways. You don't think, though, that we'll see negative interest rates from the Fed. Our guest from Saxo Bank, Steen Jacobsen, earlier on in the program said he thought the markets might force the Fed's hand and push the Fed into NIRP, into negative interest rate policy. What's your view?
I hope not. As you said, I don't think it's a plan. I don't think it's needed today. The Fed already cut quite aggressively in February and March. Back down to zero. They had a lot more room to cut than a lot of the other major central banks. We already saw a couple of different Fed presidents yesterday come out and say that it seemed very far from their mind to have negative interest rates. Mr. Powell had said something similar in the past. Now, the reason I say I hope is that the market shouldn't be pressuring the Fed into cutting into negative rates. The Fed has gone above and beyond, I think, any expectation we or the market could have had, covering pretty much every segment of the bond market. You were talking about corporate ETFs at the moment, but they've covered every area possible. I don't think negative rates are the solution for the U.S. We're going to continue to see support across the bond market. They've helped ease funding costs. They've helped ease stress in bond markets. Yields and spreads across corporate bonds have come down quite sharply just on the knowledge that the Fed could step in as needed. So I don't think it's in the plans. I would never say never, but I think there are a lot of other tools the Fed would rather use before they think of that.
Absolutely. Esti, thanks so much for joining us today. Really appreciate your time this morning. Esti Dweck, head of global market strategy at Natixis, is going to join me on Bloomberg Radio at 9 a.m. as well, so tune in for that. Welcome back to Bloomberg Markets. This is the European Open. We've seen a little bit of a turnaround here in terms of equity indexes across Europe. We were looking at mostly red arrows at the open. Now everything is up, being led higher by the periph. We're looking at the FTSE MIB, the IBEX 35 rising the most on the continent in terms of the DAX and the CAC. You only see 0.1% gains. The FTSE 100 in London is up about 0.5% as well. So you can see the Stock 600, the European benchmark index, gaining about 0.3%. If you take a look at the sectors on the Stock 600, you can use the GRR function for that, group ranked returns, and you can see that most are gaining. Telecoms, healthcare, and utilities are up. So it's really defensive stocks. It's a defensive play that's moving higher. On the downside, real estate, travel, and leisure, or leisure, as you may say in England, as well as basic resources that are falling. Let's get the Bloomberg First Word News right now. Here are today's top stories off of the terminal. In the UK, there's continued confusion for, I guess, a third straight day over Prime Minister Boris Johnson's plan to get people back to work. London's Chamber of Commerce is telling people not to change their plans until there's more information on how to keep staff safe. Companies are also asking for guidelines on what protective equipment to buy. The government is promising to outline arrangements for public transportation today, although I have to say I'm getting a lot of email from Bloomberg clients who ride bicycles very large distances in London to get to work and back. So that's an option. The U.S. has won the battle to ramp up its virus testing capacity. That's according to President Donald Trump. More than 300,000 daily tests are being conducted as of Thursday, according to the COVID Tracking Project. His news conference, as often happens, saw a testy exchange with reporters. One reason deaths in the U.S. have now topped 80,000. Federal Reserve officials are pushing back once again on the market view that rates may go negative. Both Chicago's Charles Evans and Atlanta's Raphael Bostic don't see the tool being used in the U.S. It comes as the central bank says it'll start buying corporate debt today. Corporate debt in the form of ETFs, the program coming online as part of the Fed's emergency coronavirus response. Global news 24 hours a day, on air, and a quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Matt, let's talk about what's going on at Standard Life Aberdeen. The company estimating net outflows in the first 4 months of the year were around £24 billion. But the money manager says that factoring in the roughly £25 billion related to withdrawals by Lloyds Bank, it actually saw inflows of £1 billion. I'm very pleased to say, joining us now, Keith Skio, the CEO of Standard Life Aberdeen. Keith, great to have you with us, not in person, as is always the case these days, but great to speak to you nonetheless. You describe the inflows, outflows data I've just been through as an encouraging signal today, the day of your AGM. Why are you encouraged by what you see at the moment?
And thank you, and it's always a pleasure to be here. I think it's encouraging because, you know, during so much turbulence, our clients are remaining, I think, relatively calm. Our performance has held up, and I think to see confidence from our clients of sticking with us and sending us some new money, I think is encouraging.
Why do you think they're doing that? Do you think they want to buy the dip right now? Is that what it's all about? Is there FOMO? Are people worried that they missed it? If we see another dip, do you think you'll get more?
No, I think most of our clients are long-term, and I think they're taking a view to some extent on the longer-term pace of recovery. So for sure, there's opportunity. I think the other thing that's going on is we are seeing a drift, of course, to money market funds, where houses with good performance and strong balance sheets is seen as important. So I think it's about confidence in the long term. I don't get any sense of our client base making short-term decisions. They are thinking about the medium term.
Keith, you also say in your statement today around the AGM that the external environment may impact the phasing of some activities over this year. What impact are you talking about there? What phasing?
I think it's modest. So, I mean, obviously, over the last 7 or 8 weeks, we've moved to outside Asia Pacific, having 99% of our people working from home. We have still got quite a lot of heavy lifting to do. I think that's broadly on track, but inevitably, as you put in different elements of integration and process, you know, that is just going to take a bit of a rework. But I think, as far as I can see today, and 8 weeks into this crisis, that feels like it's going to be modest.
What do your clients who normally would be investing in real estate think about this whole working from home situation, Keith? Because so many companies, I'm sure Standard Life, Aberdeen is among them, have had great success working from home and realize that the overhead of commercial retail may be a little bit too much.
Yeah, so I think one of the things we have learned is that the days, I suspect, of those old business continuity sites where you had a lot of space for disaster recovery have gone, because we, through modern technology and the ability of our people to make that technology work, they can work from home. It remains to be seen, of course, whether that is something which, in terms of the communities that people operate in and the way in which people want human connection, the full extent to which that will have an impact. I do suspect that going forward, as we think about the return to work, the ergonomics of the workplace are going to change. These big dealing room floor plans may change forever. So certainly, you know, we're thinking not just about how we can get our people back, but actually what does that mean for the shape of the ergonomics within a business, and obviously that's going to have a knock-on effect on the demand for property space in the medium term. So we'll see, I think, how this lands over the next few months.
So it has an impact on the demand for property space, Keith. Does it also have an impact then on the real estate funds that Matt was talking about? I mean, what about open-ended property funds? Are we ever going to get sound valuations for those?
Oh, we will. I think eventually, when markets normalise. But as we've seen from news overnight from South Korea, etc., this is going to be, I think, a long haul, and these difficult
Order
times
submitted.
are going
Order
to remain
submitted. Order
in
submitted.
place.
Order submitted.
So
Order
I'm
submitted.
sure
Order
we,
submitted.
the property valuers, are working with the regulators to make sure that we can get the valuation for property funds on a sound basis. And I think, as I've said several times before, I think we will come out of this crisis with some different wrappers for property funds. In the short run, I think this is all about making sure that we do the right thing for clients, and also attempt to do the right thing for tenants in these difficult times.
What do your clients think about fixed income funds right now, Keith? Or what do you expect to happen with fixed income funds?
I think what you're going to see is, we saw quite a strong improvement and a rebound in credit throughout April, and a real focus on the quality names and really strong balance sheets. So I think that's going to be a major differentiator as we go forward. There is no doubt in my mind that one product of the COVID crisis is obviously going to be a recession. You're going to have a prolonged period of very, very low interest rates at the short and the long end, and so there will be a reach for yield. But I suspect that as a result of what happened in March, the focus on quality and resilience of the balance sheet will be of increased importance, and that's going to stay with us for some time.
And Keith, how does all of that play out in the battle of active versus passive? You've talked a lot about your new active business. How is that developing? A broader focus on a broader set of products and regions than maybe traditional active. What about the new active side?
I think now is absolutely the time for new active. And one thing I think that's really important to get across as a message, though, is you will not see the benefit of new active coming through in performance either next month or over the next quarter. Active managers at the moment are spending their time doing the research, looking at the names, working out who's going to be a survivor, who's going to be a winner, who might need a bit of capital to do that. So I think the benefits of active management will reveal themselves over the next couple of years. And active management, in my view at the moment, it is time for high quality stock picking.
As you answer that, it makes me think also of the possibility of M&A for your business. When you look out there and you see competitors that may not be so steady on their feet right now in a business area, you want to bulk up at SLA. Do you see anything you like? Are there, which business areas do you want to improve with M&A now that you have these opportunities? Which regions do you want to beef up?
So the first thing to say is we're really not that interested in bulk. If there's an issue, it's about scale, and it's about thinking about where you can add to your investment capabilities so that you can continue to diversify your revenue streams and support clients. So I think we're in the middle of a bear market rally at the moment, and I suspect that there's a bit more noise and a bit more volatility to come down the track. So the real time to be thinking about what you might or might not do is probably in the second half of the year. I have to say, in the short run, given the depth and the unparalleled nature of this crisis, my focus is really on keeping my people safe, both in the distributed estates and as we think about the return to work, and making sure that if they're safe, they can provide high quality performance and service for our clients, and that's pretty much where our focus is in the short term.
Well, that's good to hear. That's the place to keep your priorities for sure. Keith, thanks so much for joining us. Keith Keogh, there's the CEO of Standard Life Aberdeen. Now, should investors see past the overall market sentiment? Up next, we talk to a behavioral economist from the University of Oxford. He's also the founder of Thorpe Abbott's Capital. Jeff Henriksen joins us. This is Bloomberg.
Order filled. Order submitted. Order submitted.
Welcome back to the European Open, 47 minutes into the session, and we're looking at some mixed markets that really aren't moving very much at all. Let's talk about behavioral economics, fascinating during this crisis. Jeff Henriksen is the founder of Thorpe Abbott's Capital and an associate fellow at Oxford's Said School of Business. And Jeff's philosophy centers on understanding the behavioral factors behind mispricing in order to unlock the core building blocks of the value premium. Jeff, one of the things I saw in your notes that I thought was interesting, you don't think that the market has priced in, has realized the full force of fiscal stimulus coming from federal governments and central banks around the world. Is that the case?
Hey, good morning, guys. Yeah, I think they're pricing it in more now than we were a month ago, that's for sure. But I think when I talk to people that I know, so many people, even despite the rally, are still very bearish. I mean, this is probably, outside of 2008, 2009, the initial rally we had there, one of the most hated rallies that we've seen. And while it's not nearly as attractive as it was at the end of March, I think there's still tremendous opportunities, especially in the smaller, more cyclical type of value names, which is
order filled.
contrarian to what a lot
Order
of people
submitted.
believe.
Order
And
submitted.
I think the reason,
Order
that
filled.
people are
Order
still
submitted. Order
failing to grasp
submitted.
the rally is, they're not taking into account the true impact that I think the policy response will have.
Order filled.
To us, when it
Order
became
submitted.
clear in
Order
late March
submitted.
that the government,
Order
both
filled.
through fiscal and
Order
monetary
submitted.
policy,
Order
here in the US, I'll
submitted.
speak to that
Order
specifically,
filled.
was
Order
essentially
submitted.
going to do
Order
everything that
submitted.
they can to shepherd both the supply and the demand side of the economy across this massive economic black hole that we're currently seeing. To us, that was a game changer, and I still think people are underestimating how powerful that can be. Now, clearly, there'll be long-term consequences to that we should be talking about, but I think there's still an underestimation of what the government, especially monetary authorities, are prepared to do. Absolutely.
Well, it makes me think of something we say back home in the States. I'm not sure if Europeans have this turn of phrase, but Jeff, you can lead a horse to water, but you can't make it drink. What do you think consumers will act like here as these lockdowns start to ease? I mean, even if I'm allowed to go to a restaurant, get in a plane, get a pedicure, am I going to do all of those things?
So there's two parts to that, right? There's one, whether or not you have the financial wherewithal and the income to spend. And then there's the behavioral element, whether or not you would want to engage in the activities that you mentioned. I think on the spending side, we've seen, and we will continue to see the government to support incomes and spending power to the best of their ability. And if we see a reasonably robust economic recovery, the spending power will return over time. Now, whether or not people want to go have a restaurant meal, I tend to be more optimistic on whether or not behavior is going to go back to, it won't go back to 100% normal. That much is clear. But I think that there are a lot of people right now, and I think they're extrapolating and kind of getting bogged down in a recency bias that they're believing that there's this world post-COVID that's going to look nothing like the world before COVID. And I just don't know if that's true. And to take a restaurant meal, for instance, at first it'll be very hesitant, but there's a thing called social proof. When you see other people around you starting to act and behave in certain ways, then it makes it more likely that you feel that okay, it's okay to behave that way. So maybe you go to a restaurant or walk by a restaurant or a bar that's slowly reopening and you see a few people in there and you don't want to go. And then maybe a week later you see a few more and you're like, well, let's give it a shot. And then you go in and you have a meal, everybody's kind of spread further out and you don't get sick. And then slowly people kind of are like, all right, we're kind of coming back out of this. Now, obviously, if the virus is spreading rapidly during all this, that probably won't be the case. But if the virus gets under control and people start to realize that they can go back to behavior, the more that they do it, the more normal it'll start to feel, I think. And so I think if we just look out 2 years from now, I would be shocked if nobody's going to restaurants, if nobody's doing. I think that it'll be a slow process, but I think people want and need social interaction. And so I think we go back to a world that's probably more normal than a lot of people think. And so I think businesses and companies and stocks that are being priced as if the probability of that happening is extremely low, I think there are opportunities in those names, assuming the companies have the financial wherewithal to bridge this economic desert, as we've called it, this economic black hole, and get to the other side.
All right, Jeff, I know you're going to go on Bloomberg Radio, so I'm going to let you go right now, but I'll recommend that our viewers switch over and listen to you on the radio right now. Jeff Hendrickson, founder of Thorpe Abbott's Capital. He's also an associate fellow at Oxford Said Business School. He's a behavioral economist, so I think it's really fascinating to hear what he has to say during this unprecedented crisis. Up next, we're going to get some of your movers in today's market, including ThyssenKrupp. Rising debt is eating into money from the elevator unit sale that the steel giant was hoping would fund its turnaround. This is Bloomberg.
welcome back to the European Market Open. We thought we were going to see a negative session for European equity markets, but things don't always turn out the way that the futures suggest. Right now, we've got European equity markets up by just 0.2%, so a bit of a turnaround there. In terms of what's leading markets, ProSiebenSat in the media space over in Germany, KKR disclosing a 118 million euro stake. That sent that share price up as much as 17% at one point. Vodafone sales growth in the first quarter, also going ahead with some asset sales. That's a positive for them. ThyssenKrupp, losses deepening and debt surging, eating into cash from elevator sales that was meant to fund a turnaround. That's some of the stocks that we've got in focus today. Matt?
And still in focus, coming up on surveillance, Standard Chartered Chairman Jose Vinales. That exclusive interview coming up in just a few minutes' time. I'm headed over to radio. Tune in on London DAB Digital. This is Bloomberg.
Order submitted. Order submitted. Order filled. Order canceled. Order canceled. Order canceled. Order filled. Order canceled. 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 Order canceled.
Prevailed in the battle to boost coronavirus testing capacity. Deaths in the US top 80,000. Staying on pause, the UK Prime Minister Boris Johnson waters down his plan for restarting the economy. We'll speak to the chairman of Standard Chartered on what it will take to reopen. And Austria's chancellor tells Bloomberg that shared debt is not the answer to this crisis. More from our exclusive interview with Sebastian Kurz. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. A lot going on in your market, so let's get straight to your markets and let's have a look at what they're telling us in terms of risk out there, in terms of the hopes out there as well. Overall, the market is really focused on some of the things that we've seen and that we will see. It's not earnings, but of course on the gradual reopening of the economy and what that means for the future. We look at France, Paris restarting since yesterday. A lot of people are also going back to school. I'm also looking at oil actually rising. The U.S. is also moving to block a retirement fund buying Chinese stocks. That's significant because it could lead to more protectionism or will give us more of an idea about, of course, what's going on between the U.S. and China. So we'll have plenty more on your markets. Now let's get straight to the Bloomberg. First one news in New York City is Ritika Gupta. Hi, Ritika.
Hi, Francine. In the UK, there's confusion over Prime Minister Boris Johnson's plan to get people back to work. London's Chamber of Commerce is telling businesses not to change their plans until there's more information on how to keep staff safe. Companies are also asking for guidelines on what protective equipment to buy. The government is promising to outline arrangements for public transport today. The US has won the battle to ramp up its virus testing capacity. That's according to President Donald Trump. More than 300,000 daily tests are being conducted as of Thursday, according to the COVID tracking project. But his news conference also saw a testy exchange with reporters. Deaths in the US have now topped 80,000. Federal Reserve officials are pushing back on the market view that rates may go negative. Both Chicago Charles Evans and Atlanta's Raphael Bostic don't see the tool being used in the US. It comes as the central bank says it'll start buying corporate debt ETFs from today. The program is coming online as part of the Fed's emergency coronavirus response. And German Chancellor Angela Merkel is trying to defuse the growing crisis over a German court's ruling on the ECB. A key question is who should respond to the judges, the ECB or the National Central Bank. Sources tell us Berlin thinks it can be local policymakers, which could prove less controversial.
Order
but the
submitted.
Bundesbank itself
Order
seems to
submitted.
suggest
Order
it will take
submitted.
a support role
Order
with the
submitted.
ECB
Order
taking the
submitted.
lead.
Order
Global
submitted.
news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine.
Ritika, thanks so much. Now let's get straight to our exclusive conversation. Across the world, virus cases have now topped 4.1 million. The Chinese city of Wuhan says it's to test its entire population of 11 million people. Now that's after reported new infections for the first time since its lockdown was lifted. So how are emerging economies placed to rebound from the coronavirus recession? Well, we're delighted to be joined by the chairman of Standard Chartered. He's Jose Viñals. Welcome to Surveillance, Mr. Viñals. When you look, first of all, about your various recovery scenarios, how patchy will the recovery is, and you lay out three different scenarios. What's worst case and what's best case?
Well, good day and great to be talking to you, Francine. I think that what we have now is a situation of very high uncertainty still. So I think it's much safer to think of different scenarios than just a single point forecast. And I think that in all of those scenarios, one constant is that emerging markets are likely to do relatively better than advanced economies this year, and that the recovery is likely to be stronger in emerging markets than in advanced
Order
economies.
submitted.
This is, of course,
Order
partly
submitted.
due to the fact that China is now more advanced in terms of its digestion of the
Order filled. Order
coronavirus
submitted.
crisis.
Order
And
submitted.
it's already
Order filled.
starting to
Order submitted.
sort of increase
Order
the rhythm
submitted.
of economic activity. So what I see is emerging markets, particularly in Asia, taking the lead of in the recovery. But of course, this is not going to be a fast recovery. It's going to be gradual. One can think of different letters in the alphabet to describe this recovery. To me, the one that I think closest to what I think will happen is a Nike-shaped recovery, where you have had a very sharp plunge in economic activity, but the recovery would be gradual with a much gentler sort of exit, and therefore, not a rapid bounce back in economic activity. But again, I think that the difference between emerging markets and advanced economies is important. And yes, there are many risks, and those risks have to do with the potential prolongation of the crisis in some of the economies which are in Europe, in the United States, still feeling the bulk of it, and also with the possibility of a relapse, which would be very disruptive.
Mr. Vinyals, what lesson are you learning for the bank, but also for the economy at large? What lessons are you learning in Asia that the US and Europe could actually adopt in reopening the economy or getting staff back to work?
Well, I think it's very important that the reopening of the economies
order filled, order canceled, order filled, order filled, order canceled, order canceled.
If you try to reopen too fast, it can only lead to a significant relapse and then take you back to a lockdown, which would be very negative for the economy. So I think that operating with prudence, looking at the health situation as the economy reopens, and then always proceeding on a contingent basis. Depending on what happens, then you can increase the speed of the exit, or you can sort of withdraw a little bit. So I think that it's very important to be gradualistic and depend on the data. And that data needs to continue being supplied by the experts, by the scientists, by the health professionals.
What is your biggest worry in terms of what kind of recovery we'll see? How patchy will it be? So you were talking about how you see it panning out. What if we do have a second wave of infection? What does that mean for banks in general, but also the economies at large?
Well, I think that banks, the situation of banks is closely linked to that of the economy. The longer the crisis lasts, the more there is a chance of a relapse. The worse is going to be for everybody, for households, for firms, and therefore the more problematic is going to be for them to repay the debts which they already have and which are non-trivial. So again, the health of the banks and of the economy are closely linked. But one important thing is that banks have started this crisis from a position of strength in terms of much higher capitalization, liquidity, and much better risk management. And this is something which, as we tend to say, makes banks part of the solution rather than part of the problem. But it's very, very important that going forward, banks can continue to be close to their clients and support their clients and customers, but always from the basis that they can safeguard their financial strength. So one needs to be careful in terms of lending decisions. I think that the support measures that governments have put in place and central banks have put in place are extraordinarily important in the economy doing better, in companies having more liquidity, and banks being able to have a better situation. But also the banks have buffers, and these buffers will allow us to continue supporting the economy. But of course, one needs to hope for things to work out in terms of a recovery, because the longer these things, the situation lasts in terms of not having a recovery or having a very weak or delayed recovery, the situation is going to be a lot more dear for everyone, and banks will need to be prepared to weather that situation as well.
Mr. Vinyals, at the moment, we focus a lot on very high unemployment. We focus on the consumer being hit, on bankruptcies. Further down the line, when will we start worrying about debt? When will we start really worrying about this U.S.-China trade war coming back at the forefront?
Well, I think at this time it is not very helpful to have added to the problems that we already have on the health and economic front, the geopolitical tensions that would come from an escalation of disputes between the United States and China. I think that this is something that would be really very detrimental to both countries and very detrimental to the world, given the key role that these countries play. As regards debt, yes, there is a concern. But I think that now the biggest concern is to leave the pandemic behind, and then I think that we will have to do with that to deal with that at the right time with the right measures. And on the one hand, you have the private sector debt, and you have the public sector debt, the sovereign debt. And that already is an issue in a number of economies in less developed countries, which is being addressed by the World Bank and the IMF and the G20. And there are a number of actions in place to help those countries. But I think that beyond that, debt is going to be one of the main legacies of the crisis. That was already a legacy of the global financial crisis, and that legacy is going to be compounded by the COVID-19 crisis, and we will see how we deal with that. And that is something which is not going to be easy. But I think that that is a side effect. The important thing now is to do everything that's needed to fight the crisis and make sure it ends.
Thank you so much. Jose Vinales there from Standard Chartered stays with us. Now, coming up, open borders are the key to jumpstarting growth. That's according to Austria's Chancellor Sebastian Kurz. We'll also bring you that exclusive interview later this hour. This is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the
Order
situation
submitted.
a little
Order
bit, but
submitted.
actually could create
Order
other
filled.
pent-up
Order
issues
submitted.
if you do close the
Order
markets.
submitted. Order filled. Order submitted. Order submitted.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacque here in London. Now let's get more with Jose Vinales. He's chairman of Standard Chartered, who is with us for an exclusive interview. Mr. Vinales, we were talking a little bit about the world economy and what kind of recovery you were seeing. Standard Chartered and you personally are also in a unique position to understand supply chains, how they will change, how they've changed. What will be the legacy of the U.S.-China trade war and then COVID-19 on top of it? Will countries become more inward-looking? Does it change the supply chain?
Well, thank you, Francine. I think that there is going to be a reassessment of global supply chains. So far, I think the perspective has been looking at them from the point of view of efficiency, cost, and sort of the just-in-time approach. And I think we're going to go from a just-in-time to a just-in-case approach, where the resilience of these supply chains are going to be part of the equation, and a more diversified view of the global supply chain, so that you don't have to rely on single producers. So I think that's going to be a very important fact. A second thing which is going to happen, I think, is that there is going to be some reshoring of certain elements of supply chains, particularly in the medical sector, things which have to do with national health security. Also, some parts of the technology, global supply chains, that is something which was in train before the COVID-19 crisis, but now is going to accelerate. And in general, we're going to see a regionalization of global supply chains. So this is going to be a significant shift over time, which is going to compound some of the trends which already were in train before the crisis. So maybe less efficient, but more resilient supply chains, I think, are going to come out from this.
Mr. Viñas, when you look at the banks overall, a lot of them have been working from home. I know you've said that the Standard Chartered working from home has been really successful. How do you think it will change the bank longer term operationally?
Well, I think that the experience that we have had during this crisis, like many other organizations, is going to lead us to draw lessons which are going to change the way that we work in the future. And I will just mention some of these dimensions. Working from home. If you had asked me 3 months ago, 4 months ago, whether we could function adequately with 70% of people working from home, from more than 90% of people in our global business services centers, the nodal places where we have a lot of control functions for the whole group, I would have said, well, that's extremely impossible. That's extremely difficult. Well, fast forward a few months, and we have been able to keep all the trains running on time with very good productivity levels, with 70% of our staff working from home. And in some countries, nearly 100% of the staff working from home, like in the UK and the US. China at some point also had extremely high rates of people working from home, like Hong Kong, Taiwan, and other locations. So this is something which is very important. We're going to rethink our work practices going forward and give a bigger role to working from home. Another thing that we have seen in the crisis is how critical it is to be agile. And already a couple of years ago, we started introducing more horizontal work practices in the organization, more end-to-end processes, and that led to a lot more agile ways of working. And this is something which has been put to excellent use during this crisis. And now we need to make sure that this is something that gives us the impetus to keep enshrining these agile work practices in the organization. Third thing is digital. We have seen that, of course, when people work from home, they need digital. We need to be very, very secure in terms of our cyber environment. Our clients are also working digitally. Many of our products, which are digital,
Order
have
submitted.
had tremendous
Order submitted.
sort of demand
Order
during this
submitted.
crisis. So
Order
we're all
submitted.
going to come out
Order
of this being
submitted.
a lot more
Order
digital, not only
submitted.
in the way we work, but also in the way that we serve our customers. And I think that we'll also draw lessons regarding the skills that we need in our workforce, given what we have learned in the crisis. So accelerating all the processes we have in place about the skills of the future workforce and what we need in terms of recruiting and in terms of training the people we have. I think that this is likely to be an important consequence going forward. So lots of things, interesting things happening from the point of view of the way that organizations are run as a result of this crisis.
Mr. Viñas, how concerned are you about bad debt exposures that have hit the bank in recent months? Some of them are also, fraudulent cases.
Well, we have published our loan impairments for the first quarter, and we have tried to be very, very prudent because I think that problems need to be recognized as soon as possible. And of the loan impairments that we have taken in the first quarter, which have been, by the way, as much as all the loan impairments we took last year, so this can give you an idea of how proactive we have been. Of these loan impairments in the first quarter, nearly $1 billion, half of it have been responding to loans that have gone bad, to non-performing loans. But the other half has been taken as a preventive measure, as a forward-looking measure regarding what may happen in the future in terms of the economic outlook. So as the year advances, we will see whether some of those sort of potential problems become real problems, or whether these provisions that we have made are unnecessary. So it's too soon to tell. It very much depends on how the economic situation evolves in our nearly 60 markets. But I think that you need to err on the side of caution in these times and be ready for prepare always for the worst, but do it in a very balanced manner.
Mr. Viñals, thank you so much for joining us today. He's Jose Viñals, and he's the chairman of Standard Chartered. Now, coming up, Elon Musk reopens his California plant, defying the rules. Details on Elon Musk next. This is Bloomberg.
Order filled. Order submitted. Order submitted. Order filled. Order submitted. Order submitted. Order filled. Order submitted. Order submitted. Order filled. Order canceled. Order filled. Order filled. Order canceled. Order canceled.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the Tesla chief executive Elon Musk is daring authorities in California to arrest him. Musk has restarted production at Tesla's only U.S. car plant, which has roughly 20,000 employees in the San Francisco Bay Area.
Now, health officials had ordered that the plant remain closed. Musk tweeted that he would be on the assembly line with everyone else. He also asked that he be the only one arrested. Now, this is a picture for your markets. This is what I'm seeing in terms of oil. There was a lot of headlines on Saudi Aramco this morning, so we'll get more on that. The oil giant keeping on track for its $75 billion dividend. That was the big story of the day. If you look at oil, it's actually rising. I'm looking at European stocks. They're swimming from a loss to a gain. There are a couple of things that we need to look at. First, the Trump administration moving to block investment in Chinese equities by a government retirement savings scheme. That could have wider implications. And then European government bonds dropping, treasuries drifting. Now, coming up, open borders are the key to jump-starting growth. That's according to Austria's Chancellor, Sebastian Kurz. More from that interview next. This is Bloomberg.
Order filled. Order submitted. Order submitted. Order filled. Order submitted. Order submitted. Order filled. Order submitted. Order submitted. Order filled. Order filled. Order filled. Order canceled. Order canceled. Order canceled.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg. First word news in New York City is Ritika Gupta. Hi, Ritika.
Hi, Francine. In the UK, there's confusion over Prime Minister Boris Johnson's plan to get people back to work. London's Chamber of Commerce is telling businesses not to change their plans until there's more information on how to keep staff safe. Companies are also asking for guidelines on what protective equipment to buy. The government is promising to outline arrangements for public transport today. Boeing sees a rocky road ahead for U.S. airlines. Boss Dave Calhoun says it's probable that a major carrier will go out of business this year. He told NBC the recovery is going to be slow, with demand depressed for months. He doesn't think air travel will return to pre-virus growth levels until the middle of the decade. China's factory deflation deepened in April, with consumer price gains slowing. It's a signal of ongoing weakness in the world's second-largest economy. Falling factory prices are a concern to policymakers. They make it hard for companies to generate profits and expand their businesses. Global news, 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine.
Ritika, thank you so much. Now, Austria's economy may take a few years to reach pre-crisis levels, while open borders will be the key to jump-starting economic growth in the country and the European Union. Well, that's according to the Chancellor, Sebastian Kurz, who spoke exclusively with Bloomberg's Matt Miller. Well, Kurz also said Italy cannot handle its debt load without EU assistance. Here he is.
There's a good cooperation on the European level to support countries like Italy, France, and Spain. So there's a package of more than 500 billion euros to support these countries, and I hope that this will be helpful.
Do you think that'll be enough, or is there going to need to be some sort of shared fiscal union in Europe to help your second biggest trading partner?
Well, I think that this package is good, but we are not in favor of ideas like Corona bonds or mutualization of debts in the European Union.
Even if it costs Italy its European Union membership, I mean, how important to you is the membership of other EU countries like Italy?
Well, there's no debate about the membership of Italy in the European Union. We are united in the European Union. There's a good cooperation, and I think that we will manage this crisis, and we will also be able to manage the economic situation. But of course, it will be an enormous difficult year.
Austria, Germany, the Netherlands, all of these countries were well prepared before the crisis hit. But there are other European countries like Italy and Spain, which were already in a bad fiscal situation. How much are you prepared to pay in order to keep the European Union together, in order to save those countries that were hit so much harder?
Well, it's clear for us that we want to support them and that we want to show solidarity. And I think it is good that the ministers for finance agreed on this 500 billion euros package to support these countries. And of course, on a European level, among the heads of states, we are also in a discussion if more help is needed.
So do you think it's possible? I mean, the austerity that you practiced put you in a good position now, but your second biggest trading partner, Italy, has 158% debt to GDP. Is it possible for them to get out of that kind of debt trap? How would they possibly do it without some form of debt forgiveness or shared debt?
Well, they wouldn't be able to handle the situation without the help of the European Union and countries like Austria. But I don't think that the idea of a shared debt is the right answer.
How long do you think, Mr. Chancellor, it's going to take for economies like the Austrian economy to get back to pre-crisis levels? Now that you've earmarked 38 billion euros, you've got more measures to come. When do you see us getting back, or yourselves getting back to pre-crisis levels?
Well, at the moment, it's difficult to say because we are quite dependent on tourism. 15% of our GDP in Austria is tourism. There are some industries like automotive, which have also been hit. So it's difficult to say now, but this year, 2020, will be a very, very difficult year. But we hope that at the next year, in 2021, there will be a positive development again. But probably it could take us a few years.
I know that you're already preparing measures like tax cuts, possibly infrastructure investment, reopening borders with your neighbors. What do you think is going to be the most important move to revive the economy on the post-corona side of the crisis?
For us, for sure, the reopening of the borders is most important because we need the single market of the European Union. We are an export-oriented country, and as mentioned before, tourism also plays an important role in our country. So for the economy in general, but for tourism in particular, reopening the borders is very important.
Well, that was the Austrian Chancellor, Sebastian Kurz, speaking exclusively to our Matt Miller. Now, joining us now is Thanos Vambakidis. He's Global Head of G10 FX Strategy at Bank of America. Thanos, good morning to you, and thank you so much for joining us.
Good morning.
A number of questions on Italian bonds and just this rift that seems to not being able to heal in Europe. Is this, one of the most crucial moments for the unity of the euro?
It is absolutely a very important problem. The periphery countries, particularly Italy, had a serious debt problem even before the crisis, but now it will become much worse because of the severe recession, because of the negative impact on the fiscal balances from this crisis, because of potential bailout of the private sector, and because of what is likely to be a very quick recovery. Therefore, we are in a situation in which a number of countries have debt that is clearly unsustainable. And so far, what we have seen from the Europeans do not address the problem.
How would you address the problem? And actually, if we don't address the problem head on, which I don't know if it's debt mutualization or some kind of corona bonds, even if called something else, then what does that do to euro?
Now, after the previous crisis, the Europeans managed to muddle through, kick the can down the road. I think now this is impossible because we're talking about much higher debt levels. In Italy, it's going to be at least 160% of GDP. In Greece, more than 200% of GDP. Now, when we look at historical evidence, how countries managed in the past to reduce excessive debt, either they grew or they inflate their way out of it, which now I think is impossible given that we are in a deep recession and we didn't have inflation for the last 20 years, or you had debt restructuring, which was primarily in emerging markets. I don't think this is an easy option for the periphery countries, and this could lead to euro exit. Or you had monetization by the central bank, which is, for example, what we see in Japan with the Bank of Japan, which again is not an option in the Eurozone given that countries don't have their own central bank and legally basically cannot do it. So I really believe the only option to address this problem is a Eurobond or a Corona bond, which would be large enough in order to make the debt in the periphery countries sustainable. Anything else is just postponing the problem and actually could make it even worse.
Make it worse how? Does it actually impact solidarity? Does it give rise to populist movements, or does it actually impact the level of the euro?
I think without a Eurobond, after this crisis, many periphery countries will be forced to many years of massive fiscal austerity based on the fiscal rules of the EU. This is politically impossible and could lead actually to an even weaker economy. We have seen
Order
this in
submitted.
Greece.
Order submitted. Order submitted. Order submitted. Order submitted. Order submitted.
So the risk in this scenario is that not only the debt will not be reduced, but it may actually increase further in the future. This is definitely a negative risk for the euro. Right now, I think the market is not really pricing these risks to a large extent because the ECB is offering a backstop, but the ECB cannot continue supporting insolvent countries long after this crisis. I think if there is not some kind of a permanent solution, the long-term outlook for the euro is very negative.
All right, we'll talk a lot more about some of your calls. Thanos, thank you. Thanos Vambakidis from Bank of America stays with us. Now, coming up, profit slumps while the world's most valuable company sees profit drop 25%, but will still pay a dividend. We talk Saudi Aramco shortly. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Saudi Aramco is still on track to pay shareholders $75 billion this year with an almost $19 billion first quarter dividend payout. That's despite reporting a 25% drop in first quarter profit after a price war with Russia, and of course after the coronavirus sent prices crashing. Well, for more, Bloomberg's Anne-Marie Hordern joins us from New York. Anne-Marie, it's pretty bold sticking to the dividend.
Yeah, it is, Francine, but we do know the dividend is crucial for all big oil companies, but especially for Saudi Aramco. And that's because the kingdom's government has about 98% of the stake in shares in Aramco. And the government certainly needs that dividend. And yesterday really was a testament to that and the depths of the financial crisis we were seeing in Saudi Arabia. They had this slew of austerity measures on the fiscal side from the finance ministry, as well from the energy ministry, cutting another 1 million barrels a day, bringing their production below 7.5 million barrels a day. And following that Aramco result, Credit Suisse was out with a note talking about the fact that, bottom line, times are tough globally, but including for Saudi Arabia. And by their calculations, they say oil prices being low, the government will generate about $133 billion in receipts from Aramco. They say that is a far cry from and insufficient to cover the original government budget of north of $250 billion. And Francine, while more than $16 billion for the first quarter sounds like a lot, it's still 25% lower from this time last year. And of course, that has to do with everything facing the oil market, a twin supply shock and demand destruction. And it's going to weigh on earnings, Aramco says, this pandemic for the rest of the year, Francine.
Anne-Marie, thanks so much. Anne-Marie Hordern there with the very latest on Saudi Aramco. Now, still with us, Thanos Vamvakidis from Bank of America. Thanos, first of all, when you look at the price of oil, is it symptomatic, the fact that it went negative, of something very, very ugly out there in the world economy, or is it more market functioning?
I think it is both. Clearly, the global economy is collapsing. It is the first time that a large share of the global economy is effectively in an induced coma. Before that, we also had the price war between Saudi Arabia and Russia. And at the same time, as demand has collapsed, storage becomes a huge issue, particularly in the U.S. There was also illiquidity in the market because of some contracts expiring. So it was like the perfect storm. We have seen oil prices now stabilizing at positive levels, but historically still very low. I think today low oil prices reflect the severe global recession.
What kind of severe global recession would you see, Thanos, and what does that mean for dollar?
Now, we expect a global growth at -3% this year. This is well below the consensus. The consensus forecast is only -1.5%. I would argue that the risk is actually for a more severe recession and a weaker recovery. Even as economies open up from the lockdown, they are not going back to normal anytime soon. Many sectors will continue operating well below capacity. Investment, hiring will remain depressed given the very high uncertainty. Usually when the global economy does badly, this is positive for safe haven currencies. So we expect that this will be positive for the US dollar. The dollar is overvalued by about 10%, but we believe it can appreciate it further in this environment as long as the threat of coronavirus remains and the global economy remains weak.
Thank you so much, Thanos Vamvakidis there, Global Head of G10 FX Strategy at Bank of America.
Order filled.
Now coming up,
Order
the
submitted.
Fed negative, we'll discuss the U.S. economy and what to expect from the world's most important central bank. That's coming up next, and this is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Hey, anybody else? Please, go ahead in the back, please.
I have two questions.
No, it's okay.
But
We'll
you
go over
pointed
here.
to me. I have two questions, Mr.
Next,
President.
next, please.
But you called on me.
I did, and you didn't respond, and now I'm calling on
Sorry, I just
the young lady in the back, please.
I just wanted to let my colleague
Okay.
finish. But can I ask you a
Ladies and
question?
gentlemen, thank you very much. Appreciate
But
it.
you
Thank you very much.
Well, that was President Trump ending a White House news conference on the coronavirus outbreak. That scene followed an awkward exchange over China with an Asian American reporter. Now let's stay with the U.S. and the Federal Reserve officials are pushing back on the market view that rates may go negative. Both Chicago's Charles Evans and Atlanta's Raphael Bostic don't see the tools being used. Well, it comes as the central bank says it'll start buying corporate debt ETFs from today. The program is part of the Fed's emergency coronavirus response. Still with us, Thanos Vamvakidis from Bank of America. Thanos, when you look at the Fed, how much more can it do? How much, are we going to see treasuries really going negative? And what would that mean for the U.S. economy?
I think the Fed has already done a lot. The fact that they announced effectively QE infinity, unlimited, open-ended, when they did that mid-March, this was a game changer for the market. Now, looking forward, they can change the program at the margin. They can reconsider what they buy. They can keep monitoring markets for potential blind spots. But I think since they did that, liquidity pressures have been addressed. I think it would be a bad idea to go with negative rates. We have seen in countries that they've introduced them that they have not really led to better economic outcomes or inflation, and it is extremely difficult to get out of the negative rates once you have introduced them, and they cause many distortions. So I think the Fed is taking the right decision to stay out of it. I don't think we're in a situation in which we can expect the Fed to do much more. I think the Fed should continue to make sure that markets are functioning properly and there is available credit. I think it is much more up to fiscal authorities to take advantage of the cheap liquidity that the Fed is providing to support the economy.
What does it mean, Thanos, for if you look at the U.S.-China trade relationship, if this gets worse, if we go back to what we had 12, 18 months ago, what does that mean for the U.S. economy?
Now, this is indeed a huge issue. One would have expected in the middle of a global crisis, actually all the countries to liberalize trade. In an ideal scenario, countries should actually eliminate all tariffs in order to support the global economy. However, if anything, the risk is that we may move in an opposite direction. Already global growth has collapsed because of the crisis we're experiencing, but there is a risk that countries will focus to support their own economy, so they will tend into protection, and particularly between US and China, there is the risk that the blame game of who is responsible for this crisis could actually lead to trade protection, which will be exactly the wrong policy in this environment. If the US or China are to abandon the trade deal that they reached last year and the increased tariffs, they will be shooting themselves in the foot in the worst possible time when they're in the middle of a very severe recession.
What kind of severe recession do you predict, Thanos, and what does that mean for emerging markets and therefore emerging market currencies?
We have
Order filled.
a
Order
recession
canceled.
almost everywhere, which is a big difference compared to 2009. Back in 2009, for example, China was growing by 9.2%. Now every single economy is going to have a recession this year. In the US, we have growth at minus 5.6%. In the Eurozone, it will be worse. We have growth at minus 7.6%. Now, and most likely the recovery is not going to be a V or U shape. It is very likely to be L or inverted J, so a very weak recovery compared to past crises. In this environment, macroeconomic policies can help, but they are not as effective as in past crises because the real economic shock is actually what is driving the recession.
What do you worry about the most in terms of this recession? Is it the legacy? Is it the debt that will come out of it? Is it the impact on fixed income? Is it consumer? Or is it just the sheer number of horrific unemployment figures that we're seeing?
I think the first question in the next few months is whether countries will be able to gradually open up their economies and whether number of sectors will have to continue operating at below full capacity. There is also a risk that as economies open up, infection rates could decrease, in which case we may have backward steps. So because when we look at the consensus forecast, they expect a strong recovery the second half of this year, whether the data actually will improve and to what extent this will be extremely important. Obviously, whether there is some medical progress, a vaccine, which will be a game changer, is extremely important. Beyond that, the debt issue is, I think, the most important, and how countries will deal with a sharp increase in debt, both in the private and public sector in the years ahead, will be the main market driver. We started this crisis with already very high debt levels, both in the public and private sector, and getting out of this in an environment of low growth and low inflation is going to be very challenging. We see a Japanification effectively of the global economy with permanently high debt, permanently large central bank balance.
Thanos, thank you so much. We'll have to get Thanos back to talk about this inflation versus deflationary pressures for Thanos Tsanvakidis. Surveillance continues. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Interesting times. President Trump says the U.S. has prevailed in the battle to boost coronavirus testing capacity. Deaths in the U.S. top 80,000. Staying on pause, the UK Prime Minister Boris Johnson waters down his plan for restarting the economy. And Austria's Chancellor tells Bloomberg shared debt is not the answer to the crisis. More from our interview with Sebastian Kurz shortly. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua in London. Tom Keene is in New York. Tom, the markets are seeing a bit of a lift. They actually started the day lower, and they're now creeping up very slowly to the green. The focus today is also on what Saudi Aramco said, with that dividend, huge dividend still being played out. And then, of course, we look at countries such as France and Paris reopening their economies slowly.
Yeah, people adapting, Francine, is how I'd put it today. Absolutely extraordinary how each nation has a different story. We saw in America, probably missed in Europe overnight, the president exiting a press conference. This morning, Dr. Fauci will enter the Senate chambers, at least virtually, and testify before the Senate. So there's a lot of dynamics here around this word, lockdown.
Yeah, and Tom, of course, Wuhan is seeing infections come back, and so they will test the whole population of 11 million people. We'll have plenty more on that, but now let's get straight to the Bloomberg. First word news in New York City is Ritika Gupta. Hi, Ritika.
Hi, Francine. Hi, Tom. As you were mentioning, a stern warning from Dr. Anthony Fauci. The U.S. infectious death chief will tell the Senate today the country risks needless suffering and death if the economy reopens too soon. That's according to the New York Times. Fauci says there's a chance of more outbreaks if states reopen without following White House guidelines. President Trump says, quote, "We have met the moment and we have prevailed." The president spoke at a press conference as U.S. deaths exceeded 80,000. He later said his remarks pertain to testing for the infection. The administration says the U.S. should soon be in place to conduct 9 million tests per month. The Federal Reserve is launching its long-awaited backstop for companies today. It will begin buying ETFs invested in corporate debt. The program was announced in March, and it's played an important role in keeping financial markets relatively calm since then. And in Wuhan, China, all 11 million residents will be tested for coronavirus. The city where the pandemic began has reported new infections for the first time since its lockdown was lifted. 6 locally transmitted cases were found in people already under quarantine. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thank you so much. Equities, bonds, currencies, commodities. As Francine mentioned, a churn to the market. It was amazing yesterday to see the tech stocks, the FANGs, the Nifty 5, if you will, really pick it up and go, even as others struggle. But I don't want to overplay the struggle that's out there. There's a grinding risk-on feel. You see it in higher yields as well this morning. No question about that in the 2-year space. And I really want to point out the unraveling of Brazil. I don't know what it's around, whether it's the virus or maybe it's just simply the economy and the global slowdown. But Brazilian real, very, very difficult. Francine?
Yeah, it's, I think, a wise thing, Tom, to spend a lot more time on emerging markets. If you look at European stocks, they're edging higher. A couple of things that I wouldn't underestimate, Tom. And one is, for example, the Trump administration moving yesterday to block investments in Chinese equities by a government retirement fund. Now, that actually could be significant and have wider implications. And then I'm looking at most European bonds actually slipping and treasuries drifting higher. Now, to talk about your markets, joining us now is Rick Okai. He's State Street Global Advisors Global Chief Investment Officer. Rick, as always, thank you so much for coming on. How do you see the recovery phase? And how will that dictate where you see value in assets right now?
Yeah, well, we think the first stage of the recovery will be quite a sharp rebound, because when you're going from almost no activity to something, you're getting quite a big bounce. We're seeing that already on the way. If you look at, for example, fuel consumption in the US, gasoline consumption's up. But the second stage might be a little bit slower, so ultimately it'll be a long road back. But I think there are sectors where there is both profitability and growth. And that's why I think a lot of investors have used the sectors, for example, sector ETFs, to move money into healthcare and tech that have been potential beneficiaries both in the short term and the long term.
What do you do with something like gold at the moment? Do you see inflationary risks out there?
I think we don't have gold from an inflation risk, but more of an overall portfolio hedging perspective. So we're overweight equities a little. We like US. And we recognize that risk on's got quite a lot of risk attached to it. So we're a little bit overweight in cash and gold as well in the balanced portfolio.
Rick, I look at the Nifty 5 and particularly the extraordinary performance yesterday, the separateness of it all. Describe how you see the separateness of this desire for revenue growth.
Well, I think it's visible revenue that investors are valuing, although the valuations say that all the values in the out years, future cash flows, it's the current attractiveness of revenue and profitability that I think is attracting attention. Now, that will shift ultimately to, in a sense, more value-seeking opportunities. But at the moment, when you've got a constrained economy, I think investors are narrowing their focus and shortening their time horizon.
What is interesting to me is within Amazon or Apple, the free cash flow generation over 4 years is just extraordinary. It's a double and down the income statement, Rich, with operating leverage. It's almost a triple in value. Is the stock market in general, and particularly on these Nifty 5 stocks, are they looking out 1 year or 6 months, or are they looking out 5 years?
Well, the value of the company suggests they're looking a long way, but I have a suspicion people are focused very much on the short term. And I think it is a risk that investors repeat what they've always done, which is extrapolate the short term too far into the future. Now, when we look at those stocks that you've named with a kind of fundamental lens on, we see they do have, in some cases, very strong long-run growth potential. But the risk is always you end up overpaying. And I think there'll come a point where we've got to draw back, and we have drawn back.
Order canceled. Order canceled. Order canceled. Order canceled. Order canceled.
In a way, long-run sustainable, but not so expensive.
Rick, how much difference do you do between emerging markets, or at least the Asian economies that are recovering from this quicker, and European and U.S. economies, and therefore the assets associated with them?
Yeah, I think EM looks at a typical kind of value story at the moment, and I hesitate to say value flat. We're actually overweight in emerging market equity. And from a currency perspective, we think some are worth buying on the dips, like the ruble, South African rand, and Indonesian rupee. But I think that they still have long-run growth potential. And I guess that's expressing a confidence in globalization 2.0, whatever you want to call it, that they will be the beneficiary of a better form of globalization. But there are a lot of risks attached, and that's why, again, we've got gold in the portfolio to hedge against some of those risks.
But Rick, what's the biggest risk is what exactly? The debt generated, or is it actually these supply chains being upended?
I think there's a variety of risks. You mentioned Brazil before. Political risk is quite high in countries that are being damaged by the pandemic, and it's putting a lot of stress on the political system. You see with the resignation of Moro and the health minister. So I think political risk may come back to bite investors in some cases, and in other cases it's the risk of deglobalization. And in the sort of third category, you've got the risk that the dollar remains high, and you've got a pretty ugly currency mismatch, both from a revenue but also balance sheet perspective. And I think that will capture some of the other countries like Colombia. There are others that are in that more fragile category.
Rick, what are the signals to know when to overweight international equity investment? It's been miserable for a long time. State Street is a great leader here. What are the signals you need to observe to know it's time to overweight international stocks?
Yeah, well, we're not. We're overweight U.S. equities relative to international. If I look at the world through a U.S. client base or a global client view. And the reason for that is that value, although it is there in emerging Europe and elsewhere, it needs more of a catalyst in order for non-US equities to outperform. So you need to see more convincing growth momentum as the catalyst. It's not enough that the US is expensive. You need to see growth momentum both in economies and in earnings to really make a difference. And I think that will in a sense, be accompanied by a weaker dollar.
Well, right, but which is the horse and which is the cart? And folks, this morning we've got stronger dollar again with DXY out over 100. I mean, in my camp, the currency follows the emotion, follows the belief, if you will, in a better international economy. Is that the way you look at it?
Yeah, absolutely. Currencies will oftentimes lead, but in this particular case, it would have to be growth first, leading to, in a sense, strong yield curves outside the US, more upward sloping yield curve, more confidence, more investment. Now, there are many things that could do that. Post-pandemic, coordinated fiscal stimulus, reform in Europe, many of those things could happen that would stimulate growth. But we're not ready to, in a sense, speculate on them before they're unfolding in front of us.
Rick, thanks so much. Rick Lakai there of State Street Global Advisors stays with us. Now, coming up on Leadership Live with David Rubenstein, the Carlyle co-founder, speaks with the Nasdaq chief executive, Dina Friedman. Find out how she is helping markets function amid the turmoil. That's today, 4:30 p.m. in New York, 9:30 p.m. in London, and this is Bloomberg.
Good morning, everyone. Bloomberg Surveillance from London, from New York. Again, later today, Dr. Fauci before the Senate. It'll be most interesting to see the tone of the senators and the responses from Dr. Fauci of Holy Cross and obviously the NIH working with the president on this pandemic. Right now, Rick Lakai with us with State Street Global. Rick, I look at the entire mix of equities right now. I look at the belief in long-term investment, clearly something that State Street is focused on. Great. What's the actuarial assumption of equities given the new yield that we have? Do you have to pull that ever down lower, or can you stay in middle or even high single digits?
I think you've got to be low. I don't think you're in high single digits in terms of long-run returns. And I think it shows through in the yield curve. Real rate expectations are low. There's dividend cuts on the way. So I think we have to be modest, but that's still a big premium. I mean, relative to risk-free assets, it's a premium worth having. So I think long-run investors should keep that in mind. The compounding power of even 3 or 4% risk premium is very valuable.
Chief executive officers will struggle to find whatever their measurement of success is, given mid or lower single-digit equity return. Does that force combinations in the future, as we saw in other times of crisis like the 1930s?
Well, we've had plenty of combinations already that have created value. And I think crisis, in whatever sector it is, but it's not a crisis in all sectors, forces people to reappraise how they can add value. And if top line is hard to come by, then I think it makes sense. Now, there's obviously policy issues about competition. We need to be careful that we have a very, very competitive economy, and that remains the case. But coming out of the pandemic, I would expect people to draw breath and say, how are we going to make progress? And I think, smart mergers will make sense. And by the way, cross-border mergers make sense.
Rick, when do we expect the consumer to come back? So I was having a conversation with the Standard Chartered chairman earlier on, and he was saying, look, he's expecting a Nike-shaped recovery, which is, the kind of slowdown and then an uptick that's slowly up. But, are people going to be fearful in spending? Is there going to be almost too much saving?
Well, has been the pattern so far in China, where manufacturing, in a sense, the supply side of the economy has ramped up, but the demand side a little bit less so. And if you look at other, developed economies, US in particular, were very consumption orientated, it won't get back to where it started. Now, the lesson of the GFC is savings ratios did rise, but not nearly as much as people thought. So people had a shock then. This is a different type of shock, but it'll take a while for consumption to return to prior levels.
What lessons can we learn in terms of, the recovery and the pace of it from China?
I think what you learn is that the early stages are very rapid. I mean, in percentage terms, maybe that's obvious. And you get up to supply side of the economy ramps up to 70, 80, 90% plus relatively quickly. And it's really the confidence measures that you put in place for consumers as well as workers that get you to the next stage of a full recovery. And I think that's why, this question of risk tolerance for the pandemic and health measures are very important, because the more confident consumers are, the more quickly they'll come back. And I think you're seeing that now in China with footfall in malls recovering.
Rick, what's fascinating here is not so much what we do, but what we try to avoid. There's going to be a huge desperation out there from State Street clients and frankly across the entire industry that I don't have enough, I've got to put away more, and my returns are going to be subpar. That's clearly the tone from you and other guests as well. What do I avoid right now? To me, that's the hardest question. What do I not invest in?
Well, if you don't have a need for liquidity or absolute safety, then obviously avoid the safe havens. We have them in there because at the portfolio level, they can be good balancing items. But essentially, it's a message about risk. If you've got a risk tolerance from a liquidity perspective and a time horizon, then taking a little bit more liquidity risk, extending in credit and in equities, means you avoid those very, very safe haven assets, which have to be bought by people. I mean, there are some people who have to buy safety, but if you're not one of them, those are the things to avoid.
Okay, but what sectors in equity would you suggest avoiding? I'm having real trouble getting this answer from anyone, folks. I mean, I get I'm supposed to buy more Amazon, I'm supposed to buy more Microsoft, Netflix, and the rest of them. I want to know what not to buy.
Well, there's always a price where things are worth buying. I think you need to look in the long run at the fossil fuel industry and ask yourself, how much risk do I want from that whole sector turning into a runoff? And so I think there's a price that's right for integrated oil and resources more generally. So that may be a place where you think, well, I can fund from that, from an underweighting there, more interesting value opportunities. So banks are in that position. Some parts of less glamorous healthcare are not in that position. So I think there are some really interesting value opportunities that are funded by those sectors that are overvalued, in some cases glamour, the glamorous parts of IT, or areas like resources and oil.
Rick, I can see the marketing coming now, the State Street Global Glamour Fund. It just has a ring to it. Rick Lakai, thank you so much, the CIO of State Street, for the briefing this morning. We look for the Glamour Fund out around July, maybe into August as well. Coming up later today, David Weston in conversation with a gentleman. His eyes are trained on Saudi Arabia and Aramco, the challenges that the Kingdom of Saud is having. That would be the U.S. Secretary of Energy, Mr. Bouyette, with David Weston in the 12 o'clock hour. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. The CEO of Boeing predicts that a major U.S. airline will most likely go out of business this year. Dave Calhoun spoke in an interview with NBC News. Air travel has been all but shut down by the coronavirus pandemic. He says something will happen when September comes. That's when the U.S. government's payroll aid to the airline industry ends. Toyota warns that profit will plunge 80% to a 9-year low. Japan's biggest automaker predicted it could take another year before global car sales return to pre-virus levels. Toyota is caught up in the pandemic that has forced automakers to shut down factories and showrooms. PNC Financial Services is cashing out of one of the industry's most lucrative bets ever. It's selling its $17 billion stake in BlackRock. PNC holds 22% of the shares of the world's largest asset manager. The sale will allow the bank to potentially make another major acquisition. And that's your Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. This is what your markets are doing. So European stocks are actually edging higher together with the U.S. equity futures. So U.S. equity futures are slipping, but Europe is holding strongish. Oil rising, and then the one thing I also would point to is European bonds slipping and treasuries drifting higher, Tom.
Francine, thank you so much. Yeah, I would look at that. I'd also look at Brazilian real week up. Brazil is very idiosyncratic, but I'll tell you, the vector of the virus is really difficult for Mr. Bolsonaro. Coming up, I'm really looking forward to this, a conversation with the laureate Michael Spence of New York University. Of course, his work on signals that we see during this pandemic. Stay with us. This is Bloomberg. Bloomberg Surveillance. Good morning, everyone. Greatly appreciate your attendance this morning. There's a headline across the Bloomberg. I'm not sure Francine Lacroix is still with me in London, but let's give it a test, folks. Francine, I see Mr. Hancock out with a headline that holidays in the United Kingdom may be foreign holidays unlikely this summer. You okay, Francine?
I mean, I'm okay. I don't know if my kids are okay, Tom. I'll be discovering the English countryside. But, Tom, this goes back to what happened on Sunday with Boris Johnson saying that anyone coming back to the country will have to be in quarantine for 2 weeks, right? So if you need to get to work or if you need to even go to the shops, unlikely that foreign travel will really be allowed at this point. But again, Tom, I guess we'll see. I think my kids are on Valium right now to try and make sure that they don't go and see the Italian or French family.
Absolutely, and this brings in perfectly our next guest. We are thrilled to bring you folks a Nobel laureate of New York University and working with General Atlantic always as well, Michael Spence. Michael Spence is one of our great thinkers. It's 60,000 feet, and he has the intellectual courage to come down to 6 feet where it is appropriate. His book, The Great Convergence, was really formative, particularly his focus on China, and he joins us today from Italy. I loved your essay before the pandemic, Michael, for Project Syndicate, What My Younger Self Never Expected. Your younger self never expected a pandemic, and particularly one that was so formative in Italy. What is your observance of how we move on from this pandemic?
Well, Tom, I think, and Francine, it's nice to be with you. I think, first of all, we have to be prepared for very, very slow economic recoveries. I mean, I've taken a look at China, and their recovery is slower than anybody really expected. And we've got, I just read a detailed report on Korea, similar things. Consumption is being held back, even for opening economies, by risk aversion, and major markets for the big exporters are closed down because of the pandemic. So we'll make it back, but it's just going to be very slow.
You are expert at the theory of the unobservable and what's called the type 2 risk, the thing that's out there. L-Arian would say the unknown unknown. What is the unobservable right now to you that has your maximum attention?
To me, the most important thing I think to understand is that with a pandemic and in the absence of effective testing regimes, basically you have markets that are clogged up by imperfect information. Basically, everybody out there that you run into is a risk. And the only way you can get rid of that risk, as far as I can see, is with an effective vaccine, which we just have to wait for an unknown period of time, or for a massive regime of testing. If we manage to do either one of those things, then that will materially speed up the recovery, because once it's communicated, it will lower the risk and take away the principal brake on consumption. In America, that's 70% of the economy. So that's kind of where we are. I'm focused on missing information at a very micro level in markets because of our inability to sort between the people who are infectious and the people who are not.
Michael Spence, I don't know if there's data to show us what's the optimum time of reopening an economy. I mean, at the moment they're reopening slowly, but really just tracking new infections in real time. Is there a better way of doing it?
Yeah. Well, there was a better way to do it, which is to invest. I mean, a lot of places, including where I sit, you didn't invest fast enough in, getting ready for an opening up. So there's two things I think that need to be said clearly. One, you can't lock down an economy for a very long time without producing an excessive amount of economic destruction and pain and suffering unrelated to the virus. It's just not possible. And the second thing is that, dealing with the health problem effectively is an accelerator for the speed of opening up, precisely because it deals with this risk issue. So we're all behind the curve in one way or another and doing the best we can. On the question of when to open up, that's a decision that has to be based on values, and our leaders, our politicians and policymakers have to make that choice. I don't have any problem with that. I'm not one of these people that think that experts and scientists should make this choice. They should provide inputs, and then the people we elect have to make the choice. And they're uncomfortable choices at this point, because we're taking risks that in an ideal alternative scenario we wouldn't have to take to the same extent.
Michael Spence, what do you worry about most in the recovery phase? Is it the number of unemployed, and how long will it take us to get those people back into a job in the U.S.?
Yeah, it is. I think that's the core of it. I would say it's unemployment and the destruction of businesses that won't be able to come back at the end because they've been knocked out. And I'm hoping that these massive stimulus efforts, are complemented by essentially debt forgiveness and other things, so that we minimize that dimension of the damage to the economy.
Let's come back with Michael Spence of New York University. Really thrilled he could be with us today. With our news in New York, here's Ritika Gupta.
Thanks, Tom. President Donald Trump says America has met the moment and prevailed on coronavirus testing. The president spoke after 2 known cases were reported among White House staffers. He said that everyone who wants a test can get one. Officials later revised that to everyone who needs a test. The Trump administration has taken another move that may raise tensions with China. It's blocking investments in Chinese stocks by Government Retirement Savings Fund. The Thrift Savings Plan was scheduled to transfer about $50 billion to mirror the MSCI All-Country World Index. That index captures emerging markets, including China. House Democrats are still drafting their plan for another round of economic stimulus, but the bill won't be ready for a vote until Friday. The price tag for this one could be more than $2 trillion. The centerpiece of the legislation is money for states and cities, but President Trump and Senate Republicans have said there's no rush to spend more. Prime Minister Boris Johnson has watered down his plan for rebooting the British economy. On Sunday, he said people should go to work if they can't work from home, but employers and labour unions pushed back, saying many workplaces are not ready yet. So now Johnson says go back to work, but only if your place of business is secure and you can travel to work safely. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thank you so much. Now coming up, an exclusive conversation on healthcare and COVID-19 with the Sanofi Chief Executive Officer. He's Paul Hudson. That's at 12 p.m. in New York. That's 5 p.m. in London. And this is Bloomberg.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. With us, the laureate Michael Spence. Michael, you wrote a brilliant essay years ago on Hurricane Katrina. I would suggest, Professor Spence, that the political dialogue of disaster changed with Katrina. The immediacy of social, the immediacy of all that media technology, step by step. How do the politicians become unconstrained from the Katrina effect so they can find disaster preparedness, resilience in this crisis?
Well, that's a very interesting question. So I think that this shock may be big enough so that at least in some dimensions, on the healthcare side, on a number of dimensions, we actually make investments that have otherwise been shunted aside. So, for example, we had this huge stimulus package that and a huge spike in unemployment claims. In a number of states, the unemployment claims simply overwhelmed the computer systems that were required to be online, causing distress and so on. That, with cloud computing, that's an entirely fixable problem. And I expect that, there's going to be more attention to resilience. Going back to the type 1 and type 2 errors, Tom, normally, we commit the error of not reacting quickly enough. There's one area where we normally do the opposite, and that is actually hurricanes, where we get ready for a hurricane which may or may not hit us in advance. But in most other areas, we sort of let it wash over us, and then we try to react with limited options. Yeah,
Michael,
go ahead.
This is absolutely brilliant what you're talking about. Are we treating this pandemic like a natural disaster hurricane, impinging massively on our growth to take us back to a second Great Depression?
Well, we're struggling against that right now, but I mean that's the situation we're in. I think that the thing it's easy to forgive, people for making mistakes, all of us making mistakes when we encounter something genuinely new. When we look back at it, the fact that this thing started in China and didn't produce a very rapid response in a wide range of countries where we probably should have seen it coming, is, I think, going to be, the historians will say that was the big mistake. So we lost the ability to contain it in the early stages in most places, not all, but most.
Michael Spence, how do you view all of this extra debt that we've now actually put in place in the world? When will it come back to I guess, hurt certain countries?
So it's gonna hurt fairly immediately in the sense of constraining options, especially on the public sector side. So my best guess is we've got a mountain of debt building up all over the place. I think a fair amount of that will gravitate to the sovereign side. That is, it will be, absorbed as public debt. So the principal question is, what does that do? As you know, Francine, in Italy, we started out at 135% sovereign debt to GDP ratio. We're going to get to, I would guess, at least 160%. So even with a long period of accommodative monetary policy that makes that sort of not fatal, there's no question that there's going to be two things. There's going to be constrained fiscal space in the future, and there's going to be increased vulnerability to additional shocks. I don't have any doubt about that. Having said that, I have to say, if the alternative was not to create all this debt and simply, let the pandemic wash over the economy, I would have chosen the debt. I mean, it was just a tough choice to have to make, but I think we took the right one in these massive fiscal programs.
Do you think that Italy, at the end of it, will need a bailout?
Well, lots of industries are going to need bailouts, and some countries, that are A, vulnerable and B, relatively weak, are going to need debt restructuring. I don't have any doubt about that. The thing that worries me about the longer term, Francine, is that, people revert to the World War II example, when we built up debt to finance the war effort. And then we recovered from it. We basically grew out. Nominal growth was high enough to grow out of it. Now, I look at the current situation, and there are question marks about real growth, and there are question marks about inflation, and the sum of those two is nominal growth. So I think these debt overhangs may be with us for a longer period of time than we would ideally like.
Professor Spence, thank you so much for joining us today, advising General Atlantic, and of course, with New York University, the laureate, Michael Spence. Please stay with us through the day. It's an extraordinary off-the-jobs report of Friday and as well, but interesting economics this week, including inflation and retail sales on the back end of the week in America. From New York and from London, this is Bloomberg.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. Tesla CEO Elon Musk is daring authorities in California to arrest him. Musk has restarted production at Tesla's only U.S. car plant. Health officials had ordered that the plant remain closed. Musk tweeted that he would be on the assembly line with everyone else. He asked that he be the only one to be arrested. Hertz has cast doubt on its ability to continue as a going concern. The car company has been working with lenders to stay out of bankruptcy. It says it may not have enough cash on hand to pay them. Hertz had been hammered by the travel shutdown, and it missed a lease payment on some of its cars last week. Oil giant Aramco is staying on track to pay out $75 billion in dividends this year. That's despite reporting a 25% drop in first quarter profit. The dividend is crucial for Saudi Arabia's government, which owns 98% of Aramco. It's facing its worst financial crisis in decades. And that's your Bloomberg Business Flash. Tom, Francine.
Ritika, thanks so much. Now, Austria's economy may take a few years to reach pre-crisis level, while opening borders will be key to jump-starting economic growth in the country and the EU. That's according to the Chancellor, Sebastian Kurz, speaking exclusively to our Matt Miller. Kurz also said Italy cannot handle its debt load without EU assistance. Take a listen.
There's a good cooperation on the European level to support countries like Italy, France, and Spain. So there's a package of more than 500 billion euros to support these countries, and I hope that this will be helpful.
Do you think that'll be enough, or is there going to need to be some sort of shared fiscal union in Europe to help your second biggest trading partner?
Well, I think that this package is good, but we are not in favor of ideas like Corona bonds or mutualization of debts in the European Union.
Even if it costs Italy its European Union membership, I mean, how important to you is the membership of other EU countries like Italy?
Well, there's no debate about the membership of Italy in the European Union. We are united in the European Union. There's a good cooperation, and I think that we will manage this crisis, and we will also be able to manage the economic situation. But of course, it will be an enormous difficult year.
Austria, Germany, the Netherlands, all of these countries were well prepared before the crisis hit. But there are other European countries like Italy and Spain, which were already in a bad fiscal situation. How much are you prepared to pay in order to keep the European Union together, in order to save those countries that were hit so much harder?
Well, it's clear for us that we want to support them and that we want to show solidarity. And I think it is good that the ministers for finance agreed on this 500 billion euros package to support these countries. And of course, on a European level, among the heads of states, we are also in a discussion if more help is needed.
So do you think it's possible? I mean, the austerity that you practiced put you in a good position now, but your second biggest trading partner, Italy, has 158% debt to GDP. Is it possible for them to get out of that kind of debt trap? How would they possibly do it without some form of debt forgiveness or shared debt?
Well, they wouldn't be able to handle the situation without the help of the European Union and countries like Austria. But I don't think that the idea of a shared debt is the right answer.
How long do you think, Mr. Chancellor, it's going to take for economies like the Austrian economy to get back to pre-crisis levels? Now that you've earmarked 38 billion euros, you've got more measures to come. When do you see us getting back, or yourselves getting back to pre-crisis levels?
Well, at the moment, it's difficult to say because we are quite dependent on tourism. 15% of our GDP in Austria is tourism. There are some industries like automotive, which have also been hit. So it's difficult to say now, but this year, 2020, will be a very, very difficult year. But we hope that at the next year, in 2021, there will be a positive development again, but probably it could take us a few years.
I know that you're already preparing measures like tax cuts, possibly infrastructure investment, reopening borders with your neighbors. What do you think is going to be the most important move to revive the economy on the post-corona side of the crisis?
For us, for sure, the reopening of the borders is most important because we need the single market of the European Union. We are an export-oriented country, and as mentioned before, tourism also plays an important role in our country. So for the economy in general, but for tourism in particular, reopening the borders is very important.
Well, that was the Austrian Chancellor, Sebastian Kurz, speaking exclusively to our very own Matt Miller. Now, this is what your markets are saying. This is European stocks actually edging a little bit higher than where they were when they opened. Investors weighing an uptake in coronavirus infections in several nations, but also signs of fresh trade tensions. Oil is rising, and then I'm also looking at the fact that the Trump administration moved on Monday night to block investments in Chinese equities by our government retirement fund. That sent a bit of shivers in Asia, Tom.
Really good, interesting, Francine. There's all sorts of things going on in the background, really not front and center, maybe not market driving. And one of them, of course, is finally the Federal Reserve of the United States will be buying exchange-traded funds. There's a little bit of mystery to this today, but nevertheless, maybe we will see that historic moment where they take on at least bond ETFs today, some of that giving buoyancy to the market. We're going to drive forward this conversation. Many things to talk about here, including the important testimony of Dr. Fauci. We'll see that in, I believe, the 10 o'clock hour this morning in New York. But first, before that, we speak on the linkage here of the equity markets and particularly to beleaguered commodities. We do that with Michael Shaul. Stay with us. This is Bloomberg. Good morning. This morning, all bid the dollar and the Nifty 5 as risk is grindingly on. Will Apple, will Microsoft prevail to $2 trillion market caps? Meanwhile, Bolsonaro of Brazil is against any and all lockdowns. He says, quote, millions already feel like they are living in Venezuela. As well, President Trump, he exits a press conference stage right, entering center stage this morning. Dr. Fauci will speak to the Senate. And, well, there are sure signs this will end. Baseball under discussion at some point. John Farrow notes the Premier League in June, and Ryanair will fly in July. Good morning, everyone. Bloomberg Surveillance. I'm Tom Keene in New York. Francine Lacroix in London. Francine, the lockdowns that we've been talking about and all the different permutations that we see are extraordinary. And there's Ryanair trying to get 40% of their flights back in the air by July.
Yeah, so Tom, a couple of things on Ryanair. First, it might be a way also of securing slots, because if you don't fly airplanes and you use your slots at very lucrative locations, right, such as some of the UK airports. The other thing, Tom, is that if you have a quarantine, right, which Boris Johnson has said that anyone coming back from the UK, although there may be an exception for France, needs to quarantine for 2 weeks. The airlines may be able to get, planes in the air, but people may not want to fly. So watch out for that. They certainly were under pressure in the last 2 days after that Boris Johnson speech.
And we see all sorts of headlines here on the major airlines, the struggles they will have to keep it going through this May. We've got lots more coming up today, some good conversations, particularly on the market and what we see with those select stocks moving ever higher. Michael Schul will join us here in a moment. Right now, with our first word news in New York City, here's Ritika Gupta.
Thanks, Tom. A stern warning from Dr. Anthony Fauci, the U.S. infectious death chief, will tell the Senate today the country risks needless suffering and death if the economy reopens too soon. That's according to the New York Times. Fauci says there's a chance of more outbreaks if states reopen without following White House guidelines. President Trump says, quote, "We have met the moment and we have prevailed." The president spoke at a press conference as U.S. deaths exceeded 80,000. He later said his remarks pertain to testing for the infection. The administration says the U.S. should soon be on pace to conduct 9 million tests per month. The Federal Reserve is launching its long-awaited backstop for companies today. It will begin buying ETFs invested in corporate debt. The program was announced in March, and it's played an important role in keeping financial markets relatively calm since then. In Wuhan, China, all 11 million residents will be tested for coronavirus. The city where the pandemic began has reported new infections for the first time since its lockdown was lifted. 6 locally transmitted cases were found in people already under quarantine. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities here, and it's a little bit red on the screen, but I don't want to overplay it with a relative Nasdaq performance here as tech and the futures market continues to sustain. Yields are higher, curve a little bit steeper, then goes flat, but the 2-year yield elevated a little bit this morning. And really front and center, as Francine mentioned in the last hour, dollar strength. We see that not only in the major currencies, the DXY index, but the really fairly sophisticated math of the Bloomberg Dollar Index called BBDXY. BBDXY folds in a lot of EM currencies, and even there we see strength this morning. Francine?
Tom, European stocks are moving higher a touch. Again, they're looking out for, ticking up in coronavirus infections in several nations, but also signs of fresh trade tensions, oil rising, and then I'm looking at treasuries, and they're pretty much drifting, Tom.
Very good. We'll begin this discussion, and we have so many times with whither the market, but it's actually the markets, and someone who's wonderfully interdependent is Michael Schul. He is at Market Field Asset Management, and we get perspective of him today, not only with his good expertise on commodities and more of an authentic view of the tangible commodities away from oil, but of course also on the equity markets. Michael, have you ever seen the divergence we see besides 5 or 6 or 7 glory stocks in the rest of the stock market. I mean, it's absolutely historic. Let's go to the why. Why are we seeing this divergence?
Well, I mean, part of it's the legacy of these stocks doing extremely well since, really since about 2013 is really when they started to dominate the market. And I think part of it is simply when, people liquidated in March and wanted to get back in and rebuild positions. These were stocks people felt comfortable with. And it's also the fact, I think, that there's a recognition that the disruption from this virus has really changed the way or increased the way people need to use technology. And people feel that whether it's Apple with cell phones or Google and Facebook with their platforms, or Amazon obviously with its unique delivery capabilities, there's an understanding that they are net beneficiaries from this. Maybe only on a relative basis, maybe there's enough economic damage out there, but if you have to start somewhere, I can understand why these are the stocks people have gone back to.
To me, Michael, the critical philosophical question here, and this goes back to Michael Mauboussin in his wonderful essay, I'm going to say 15 years ago now at Credit Suisse, on the survival of the few, and that with technology and the internet dynamics, only a few would succeed. Do you perceive these stocks as discrete, or can other stocks join them in relative excellence?
Well, I think they're going to be uniquely dominant as far as an index like the S&P 500 is concerned. But it's not that nothing else is going up. And within technology, there have been plenty of successes amongst the chip makers. Anything to do with communications is kind of doing okay. And actually, some of the economically sensitive groups outside of technology, have had strong rebounds since March. They just don't have the market cap to affect the S&P 500.
When you look, Michael, at some of the things out there, is there anything that you want to stay away from? Is there anything that you either want to stay away from because they'll think they'll be adversely affected in terms of either liquidity or actually solvency?
Sure. I mean, I have no interest in understanding when global travel is going to get back to normal. That seems to me to be a hard way to make money. We're quite negative on urban commercial real estate, particularly New York City commercial real estate. I think that this virus is uniquely disruptive to the city that I live in, and its sort of daily way of life. So I think that's something that we would want to avoid. We're, I wouldn't say optimistic, but, we're hopeful that sort of general economic activity, can rebound, particularly in the sort of global industrial sector.
Rebound how quickly?
The best guide we have is Asia. With China is probably, it's always hard to use their data, but China is showing a reasonably quick rebound with its domestic demand. It's now going to have to absorb a collapse of its export activity. Same you could say for places like Korea and Taiwan. So, the big question is how quickly are the various states in the U.S. going to reopen the business? I think manufacturing is going to be treated as something like a special case, but I would hope that late third quarter, fourth quarter look very, very different to late second quarter, early third quarter.
Michael Schill with us, and always with some real insight that makes you go to the next section, and we will do that with him and talk about what matters. And to him, it's clearly this idea of commercial real estate. We'll come back and address that with Mr. Schill. Really must listen for all of global Wall Street. Speaking of must listen, David Rubenstein, always in good conversation. David Rubenstein with Ms. Friedman of the Nasdaq. Look for that tonight. This is Bloomberg. Good morning.
This is Bloomberg Surveillance. I'm Francine Lacqua in London. Tom Keene in New York. Tom, we were having a great conversation about valuations with Michael Scholl, Market Field Asset Management. Michael, when you look at regions, will the U.S. be harder hit than Europe? And do you see value in some of the more unloved regions?
I'm more interested in Asia than Europe. Asia has had ultimately much less disruption to its day-to-day life from this virus, and is at least as cheap as Europe. Europe has been a relative value play for most of this cycle, and I haven't seen any real sort of rays of light coming out of Europe. I don't know whether it's had a better virus crisis or a worse virus crisis. I think you have to compare country by country to state by state in the US. But Asia does stand out. You really haven't disrupted the relationship between the private and the public sector and the relationship between governments and citizens in Asia to the extent that we have in the US and Europe. Most of the major Asian nations have been actively reopening their economies for several weeks now. So I think that if you're looking away from the U.S. and you're looking for a part of the world to perhaps play catch up, Asia makes much more sense than Europe.
Is this despite trade wars? Do you worry that there's going to be a U.S.-China trade war around the corner?
It wouldn't be helpful, obviously. China's domestic market it's not entirely insulated from the trade war, but it's certainly dominated by its local investors. Korea, Japan, Taiwan, certainly were hurt by the trade war in 2018. I have a hard time believing that the U.S. and China will be going head-to-head in a trade war in the middle of all of this. But I think that is a risk. But I think it's outweighed by the fact that they are better positioned, certainly than Europe, from the disturbance and the virus.
Michael, I want to go back to your very important comments on commercial real estate that we had moments ago from you.
Sure.
Like the bankruptcies that are out there right now, do you presume that there'll just be a constructive workout of these properties where there will be huge markdowns, losses taken, cram downs of debt holders, et cetera, and that we'll move on to a new pricing of commercial real estate? Or do you look at it as almost technological change?
Well, I think kind of both. I do think that this remarkable period that we're going through is ultimately going to lead to a demand deficit for office space and perhaps for multifamily in key urban cities. And it happens that the sort of bad luck of it is that the supply-demand dynamic was already, to our view, quite dangerous. You were already overproducing multifamily, particularly at the high end, and to some degree, office space. So you had a bad supply-demand dynamic, and maybe you've shifted demand critically lower. So again, it's a relative story. I would much rather be a home builder in suburban America, well away, particularly from the East Coast. And I would not want to be a New York City landlord. I mean, I am personally a New York City landlord. I don't want to be me right now.
You don't want to be you. We'll use that as a surveillance break exclusive. Michael, that's right where I wanted to go.
Exactly.
If you're talking about a major change within the urban landscape, people have to go somewhere. If it's not urban commercial real estate, where is the opportunity?
I think the builders would be the big beneficiaries of this, and be a big switch from where you were 10, 12 years ago, where ultimately multifamily landlords were one of the big winners of the housing crisis. I think this time around, again, I should stress, I don't see a major financial crisis coming out of this. I do see a significant reduction in commercial real estate values where cap rates are really quite low, and I do see distress at the at the equity level. As I say, it's an industry which has done very well out of the last cycle and will pay a price, I think, going forward.
Michael Schull, just brilliant. Thank you as always with Market Field Asset Management. Coming up, really looking forward to this. Willem Botter will join us, of course, with decades of experience, particularly on the European dynamic. Willem Botter as well on the transatlantic back and forth. He is with the Council on Foreign Relations. He is at Columbia University. Stay with us. This is Bloomberg.
Bloomberg surveillance, Tom and Francine from London and New York. Now, Tom, Saudi Aramco is still on track to pay shareholders $75 billion this year with an almost $19 billion first quarter dividend payout. Now, that's despite reporting a 25% drop in first quarter profit, and that's also after a price war with Russia and, of course, coronavirus taking a hit on oil demand. Well, joining us now to discuss all of this is Javier Blas, Bloomberg's chief energy correspondent. Javier, this seems like a really bold move from Saudi Aramco. Do they feel like they need to do it to keep shareholders on side?
Well, I think that Aramco is a new listed company, and therefore they really want to make sure that they reassure investors that the dividend is going to be there. It was the big selling point of Saudi Aramco IPO, the big fat dividend of $75 billion. Obviously, most of that goes to the Saudi government. Only about $2 billion go to minority shareholders. But I think that for Aramco, it's very important that on these very few quarters as a public company, they are seen as keeping their promises and not cutting on the dividend.
How will they balance the books?
Well, that's going to be complicated as the year goes, because when you dig deeper into the cash flow of Aramco, it's very clear that the free cash flow in the second quarter is not going to cover the dividend that they have to pay to keep on track for that $75 billion. So Aramco is going to have to take on debt, but the starting point is very much a very good starting point for Aramco. It's a company that is long cash. It has no debt on a net basis, and therefore is in a much easier position than, say, Royal Dutch Shell or Exxon, who have significant leverage to try to borrow money to keep paying the dividend.
Javier, what's your measurement right now of the strength or existence of the cartel? Give us the cartel meter right now.
The cartel seems to be reasonably strong. I always say, and I borrow from Robert Mavro, the late Robert Mavro, who was an OPEC watcher, and used to say that Saudi Arabia or OPEC are like a tea bag. They only work in hot water. And Saudi Arabia and OPEC, the cartel, is in really hot water because prices are low. So you see a strong compliance so far with the production cuts, and Saudi Arabia doing it double the amount. They are cutting even more than they needed to cut. So at the moment, the compliance is strong because every country knows that a lot of it is at stake. I think that the key question is going to be when the demand starts to improve, perhaps after the summer, and prices are a bit higher. Everyone then is going to have the temptation to relax on compliance, and then that OPEC meter will start to come down.
Who is most likely at the margin to join Saudi Arabia in these production cuts?
Well, we have seen that Kuwait and the UAE have already said that they're going to also cut beyond what it was agreed at the OPEC meeting, so they're cutting even more than they have agreed. We have seen Russia surprisingly implementing very, very large production cuts, particularly targeting the European market. I think that if you look at who can be the laggards, you have to look at countries like Kazakhstan and Iraq, which probably are not going to be cutting as much as the Saudis and the Russians.
What is the one thing that you would worry about, Javier? I mean, we saw Saudi Arabia take some drastic measures. What happens in 2021 and 2022 if the oil price doesn't recover?
Well, I think that the biggest kind of problem for OPEC is if we have a second wave of infections, and therefore the demand for oil doesn't recover as much as everyone is expecting. At the moment, the market is working on the assumption that the worst of the demand destruction is over, that the market is still oversupply, but slowly will get less oversupply and potentially reach a balance perhaps in June, perhaps in July. But if we have a second wave of infections, that gets pushed out into the later part of 2020 or even in 2021. And that is when you need to start thinking about how countries like Nigeria, Venezuela, or Iran can survive with very low prices for such a long period of time. And I think that Nigeria will be a country to watch if the situation really goes with low prices into 2021.
Javier, thank you so much. Our chief energy correspondent, Javier Blas, as well. We're going to continue forward this conversation. The Secretary of Energy will be with David Weston. Look for that in the 12 o'clock hour. We've got a reversal, a little bit of green on the screen here. Again, Nasdaq leading the way. No question about that. Brent crude, $30.35 a barrel as well. Please stay with us another hour of Bloomberg Surveillance.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg First Word news. President Donald Trump says America has met the moment and prevailed on coronavirus testing. The president spoke after 2 known cases were reported among White House staffers. He said that everyone who wants a test can get one. Officials later advised that to everyone who needs a test. The Trump administration has taken another move that may raise tensions with China. It's blocking investments in Chinese stocks by a government retirement savings fund. The thrift savings plan was scheduled to transfer about $50 billion to mirror the MSCI All-Country World Index. That index captures emerging markets, including China. House Democrats are still drafting their plan for another round of economic stimulus, but the bill won't be ready for a vote until Friday. The price tag for this one could be more than $2 trillion. The centerpiece of the legislation is money for states and cities, but President Trump and Senate Republicans have said there's no rush to spend more. Prime Minister Boris Johnson has watered down his plan for rebooting the British economy. On Sunday, he said people should go to work if they can't work from home. But employers and labour unions pushed back, saying many workplaces are not ready yet. So now Johnson says go back to work, but only if your place of business is secure and you can travel to work safely. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Now, in the middle of a spat between Europe's top courts over the limits of ECB monetary stimulus, President Christine Lagarde may do even more. Lagarde says her institution is undeterred by the legal tussle over its asset purchase program and will do what's needed to support the economy. Well, joining us now to talk about the global economy, but also the European economy, is WMBoT, adjunct senior fellow at the Council on Foreign Relations and a visiting professor at the School of International and Public Affairs at Columbia University. Willem, thank you so much for joining us. How worrying is it, this decision by the German Constitutional Court? Does it actually deter the ECB to do more with its PEP program, for example?
It is extremely worrying because it means that if the European Central Bank does not satisfy within 3 months the German Constitutional Court that it is doing things properly from the perspective of the German Constitutional Court, then the Bundesbank will no longer be able to participate in the financial operations of the Euro system. And that effectively could mean the end of the Euro system. In theory, you could go ahead without the Germans, but that's like having Hamlet without the prince. So it is extremely dangerous, not just from a technical perspective, a monetary policy management perspective, but it risks the very existence of the European Union.
I mean, we've said that the European Union is under threat for a long time. Why is this time, more at threat than in previous crises?
Oh, because so far, in its previous rulings, statements, the German Constitutional Court has never been this aggressive. Basically, given the ECB 3 months to come up with a to them satisfactory containment exercise that makes the asset purchases consistent with the German Constitutional Court's view of what is limited, targeted, and legitimate, proportional monetary financing.
Professor Bauder, we celebrate 70 years of the miracle of Robert Schuman and his efforts towards a European coal and steel community which was goods. Is the European experiment of Lagarde and of Merkel, of Macron and the others, is it undoable now because we moved on to such technological advancement in a true service sector economy?
I don't think that the fact that the economy has shifted in terms of value-added composition from traditional goods to modern techy goods and services is a source of unsurmountable problems. It is the screwed up design of the Economic and Monetary Union, the unwillingness to create a sovereign debt restructuring mechanism, the unwillingness to create a mechanism for mutualizing sovereign debt, that Corona bonds in this particular case, that really makes the construction more vulnerable today than it has been at any time since the 50s.
It was remarkable a few weeks ago to see Mr. Rutte stand up and really stridently say he stood with Germany. What would you suggest your Netherlands do? Stay with Germany or find a more independent voice?
Well, I think that the Netherlands' position is 2 standard deviations in the extreme direction from the one taken by the German Constitutional Court. Right? The Dutch are the real hard hats of no burden sharing, limits to the extent to which the ECB can, through, say, Italian sovereign debt purchases, keep Italian sovereign spreads under control. It is quite extraordinary to see that it's not the Germans, actually, at least the political Germans, that are at the extreme end of the spectrum, but it's the new Hanseatic League, as it's known. List of smaller, mostly Nordic countries, including the Baltics, some of the small Scandies, Ireland, and the Netherlands, that really are unwilling to engage in the next step of burden sharing and institutional innovation necessary to make this construct viable for the next decade.
Willem, thanks so much. Willem Bouter there of Council of Foreign Relations. Now, coming up later, an exclusive conversation with the Sanofi Chief Executive Officer. We'll be talking COVID-19, of course, some of the medication and possible vaccination with Paul Hudson. That's at 12 p.m. in New York. That's 5 p.m. in London, and this is Bloomberg.
Okay, anybody else? Please, go ahead in the back, please.
I have two questions.
No, it's okay.
But
We'll
you
go over
pointed
here.
to me. I have two questions, Mr.
Next,
President.
next, please.
But you called on me.
I did, and you didn't respond, and now I'm calling on
Sorry, I just
the young lady in the back, please.
I just wanted to let my colleague finish.
Okay.
But can I ask you a
Ladies
question?
and gentlemen, thank you very much. Appreciate
But
it.
you call-
Thank you very much.
Absolutely extraordinary. I would attempt to translate it for our global audience, but someone who can better do that is our chief Washington correspondent, Kevin Cirilli. Kevin, what did we observe yesterday? What's the backstory in the Rose Garden?
Well, I mean, I think from the administration standpoint, it's just a continuing escalation of their criticism of the media's handling of this. I mean, he was asked about why he feels it's a global competition for the distribution of masks, and he said he didn't like the question. I mean, we've seen this, the president push back against the media for several times, and it was no different yesterday.
Well, it was no different yesterday, but something's changing here, and what that is Mr. Fauci will be on the Hill today. What will you listen for?
Well, there's two things. First and foremost, absolutely correct in how the president now has changed those daily press conferences, and this was a return to normal in many ways of the combative nature of the president taking on the media that we saw yesterday. But secondly, yes, Dr. Fauci will be attending a virtual hearing today in the Senate. This is going to be a virtual hearing, and it will be quite interesting to see how this functions and how this serves. Expect Democrats to question Dr. Fauci on whether or not states are ready to reopen, and expect Republicans to press him on the same issue, but from a different perspective, and saying, you know, where is this data that you're suggesting coming from about why we should be more reluctant to open states? So Republicans going to be pushing for a more quick reopen, Democrats going to be urging more caution.
What's the plan right now, Kevin, in terms of the reopening of the economy?
Well, I think it varies from each state, and there's been, I think, 9 states by the end of this week will be scheduled to reopen. Utah and other states in the central part of the country. This, as again we continue to cover this story of reports that the coronavirus has taken has penetrated more close to the president's inner circle. The president was asked about that yesterday at the press conference. He said that they're taking every precaution and following guidelines to prevent that. But it's varied on a state-by-state basis. The president, for his part, it was just announced that he is going to be traveling to a key battleground state of Pennsylvania later this week in Allentown, a more Rust Belt portion of Pennsylvania. And he's going to be touring a plant there. So this is the second stop the president has made. The previous stop was in Arizona. Now he's headed to Pennsylvania. So the campaign stops, though not at rallies, but the campaign visits to states now continues for the president.
Kevin, how's Joe Biden doing? We don't really hear about him that much.
We don't hear from him at all, and that's been quite interesting, because as the president travels to Arizona, to Pennsylvania, former Vice President Joe Biden has not been, really traveling anywhere. And his supporters would say that he's following the CDC guidelines and the advice of Dr. Fauci and waiting for this thing to subside, the health concerns. But even Democrats are starting to wonder where the long-term plan is. This, as both campaigns have had to really re-strategize in the closing months, or in heading into the summer.
Is there evidence, Kevin, that the president can garner support right now beyond the Allentowns of America?
You know, that's a great question, because even when you look at a state like Pennsylvania, Biden is leading President Trump. And that's being fueled by support amongst the suburbs, and that microcosm can be played out in other battleground states, Michigan, for example. But for the president to win re-election, he's going to need to overperform in Allentown, and he's going to need Biden to underperform in the suburbs. I think that's why you've seen some more new voices coming out of the administration, including the new press secretary, that are a part of that broader strategy on behalf of the administration to reach back out to those suburbs, not necessarily to win them back or to win them, but to have Biden underperform.
Right. Kevin, I think I can state for global and international audience and those watching us coast to coast that the polarization now within this pandemic has reached a level no one really thought it would. It's just absolutely extraordinary, just the last 24 hours alone. What does that do to any proposed legislation?
It makes it very difficult to advance, and I think whether on an economic front, as Speaker Pelosi tries to push through an economic stimulus and bolster funding for states and workers and hospitals, and Republicans saying, "Hey, not so fast. Why should we be having to pay for?" This is the conservative argument for fiscally, in their minds, irresponsible states, and so that makes it more difficult. But it also makes it interesting from a national security perspective to see how the United States is going to be able to push back against China. Yesterday, I was at the State Department. I interviewed the Undersecretary for Economic Affairs, Keith Kroc, and he said that he views this as a longer-term strategy of disentangling Europe, for example, from China's 5G ambitions. And the United States has been working, and this is a bipartisan area, has been working to create standards for the international community, most notably Europe, to disentangle them from China relating to 5G, energy, and other financial services international sectors. So all of that, I think, remains a nonpartisan issue, but on the stimulus front, that remains a partisan issue and a domestic one.
Kevin, thank you so much. Kevin Cirilli, their Bloomberg chief Washington correspondent. Now, up next, Michelle Patch, Johns Hopkins School of Nursing assistant professor, will talk about some of the testing out there and, of course, medication. This is Bloomberg.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. Tesla CEO Elon Musk is daring authorities in California to arrest him. Musk has restarted production at Tesla's only U.S. car plant. Health officials had ordered that the plant remain closed. Musk tweeted that he would be on the assembly line with everyone else. He asked that he be the only one to be arrested. Hertz has cast doubt on its ability to continue as a going concern. The rental car company has been working with lenders to stay out of bankruptcy. It says it may not have enough cash on hand to pay them. Hertz had been hammered by the travel shutdown, and it missed a lease payment on some of its cars last week. Oil giant Aramco is staying on track to pay out $75 billion in dividends this year. That's despite reporting a 25% drop in first quarter profit. The dividend is crucial for Saudi Arabia's government, which owns 98% of Aramco. It's facing its worst financial crisis in decades. And that's your Bloomberg Business Flash. Tom, Francine.
Ritika, thanks so much. Greatly appreciate that this morning. Right now, Michelle Patch is with us. She's at the School of Nursing, the Johns Hopkins University. Any number of themes to talk about. Michelle, I want to go medical on you here. All of this has been a huge technological medical curve, a learning curve as well. What have you learned about ventilators? A month ago, 6 weeks ago, they were front and center is a desperate need. What have you learned in the last 2 months about ventilators and this pandemic?
Well, good morning, Tom. Ventilators have been absolutely critical as we fight to help individuals survive this illness. And we have seen improvements in the availability of them. And as some individuals are recovering and able to be extubated, we then, of course, would have those ventilators available for others. They truly are remarkable. They're interesting too, though. There's been some discussions as well behind the scenes as we're trying to think bigger about how do we make the best use of our technology while also protecting our staff and protecting our PPE. So there has been some work by engineers, by nurses, by others. How can we maybe be using those ventilators maybe from a distance? But again, there's so much that we still need to do and far that we need to go. So right now we're pretty stable, at least I can say in the Johns Hopkins system, our ventilator situation is stable at the moment.
Michelle, there are a number of worrying reports about blood clots being formed because of the virus. How much do we understand about the linkage between this? Right, that too. There are more questions than answers, I think, at this point. Again, many are studying what is this connection. Is it a direct result of the virus itself? Is it really more a correlation of the level of inflammation, the damage to our blood vessels throughout the body? To what extent does fever play into this? But there are some people who may be more susceptible to developing clots. We certainly do treat individuals prophylactically and watch very closely, but we're still gathering evidence to really understand the specific risk within COVID as maybe opposed to other illnesses. I mean, what do we know about, other symptoms that actually persist once the infection clears? Are patients no longer, be able to pass it on, but could still be sick for many weeks or months?
Certainly, the convalescent time can be long. A lot of it depends upon, the underlying circumstances of each individual person. in terms of being able to pass the virus, there is a time frame for the most part where you would be able to pass that and for others to contract it. Again, really not clear. That seems to be for a few weeks while that viral load is high. And unfortunately, our challenge is that some people do not show symptoms, but can be carrying this virus and can be sharing this virus unknowingly with others, which is why there is all of this very
Michelle?
thoughtful and discussion on this.
Yeah.
Yes.
Michelle, thank you so much. Michelle Patch there from Johns Hopkins. This is Bloomberg.
He leads the company that operates 4 of the most popular cable channels for women, producing a wealth of content distributed around the world. After helping to create MSNBC and CNBC, David Zaslav took the helm at Discovery in 2007, where he moved quickly to streamline the company and relaunch channels so he could take it public all within the span of a year. Since then, Discovery's market cap has quadrupled. And now, Discovery is coming to terms with a new world, one where viewers increasingly turn to streaming services for their programming and are moving away from Discovery's core business of traditional cable channels, leading Zaslav to make the biggest deal of his life, betting once again on content. On this edition of Bloomberg Big Decisions, David Zaslav.
David Zaslav, thank you for joining us. Great to have you.
Great to see you.
So you've just completed the biggest deal of your career, I believe, $12 billion for Scripps. Why did you do it?
Well, it's interesting. There's a financial reason, and there's also a strategic drive that we think could really work for us. Here, we're in the cable and free-to-air business. Scripps is in the cable and free-to-air business. And so we both do the same thing. It's what we do for a living. It's what we know how to do. It's what we do every day when we come to work. And so we feel that we're quite comfortable in putting these two companies together. And the synergy gives us the opportunity to, we think, have a target of doubling our free cash flow. So we generate about $1.4 billion in free cash flow. Scripps generates about $8 billion. And we think we can get to 2, 8, or 3 through revenue synergies by coming up with a lot of cost synergy, mostly cost synergy. And so in a turbulent time, if we can emerge with almost $3 billion of cash, it creates like a moat in a turbulent time. We're different than most media companies in the world, and there are a lot of great companies. But whether it's Disney or whether it's Rupert or Comcast, NBC, CBS, they're mostly in the scripted and movie business. Netflix, Amazon, that whole side of the business is focusing on, as if it was a soccer field, the ball is scripted series and scripted movies. So it's very crowded, it's getting very disrupted, and you know, the number of scripted series have gone from 200 to over 500. And Apple and Amazon and Netflix alone are spending almost $20 billion on top of these companies. So we look at that and we say that we're not that. Well, we're on the other side of the business. The other side of the business is we own all of our content. It's real-life entertainment. We see ourselves as a global IP company, whether it's with Oprah, with Discovery, with Animal Planet, with ID and crime or science or cars. And with Scripps having food and HG and cooking and travel, we put it all together now, and we're on a different area of the field. And so we say very good luck to them. I think there's a lot of great companies. It's going to be very disrupted. And our game is to take those great brands around the world, and as people over the next few years look to pull content onto devices and phones, we think the functional value of food, home, cooking, science, cars, that we'll do better, or we have a chance to do better, than if somebody was going to pay to watch The Crown on a mobile phone. So a lot of it is about owning IP and figuring out a way to get to mobile where people will pull your content.
Well, let's talk about getting to mobile, because that's the big disruption everybody in media is talking about as a practical matter. How will this help you get to scale, as it were?
Well, we're about 20% of the viewership in the U.S. at any given time. And we have 4 of the top 6 or 7 cable channels for women with HG, Food, ID, TLC, and then we have OWN that's #1 for African American women. So I think we have a great menu to offer to an advertiser. Discovery is in 220 countries. We have an average of 10 channels in every country in the world. So we're kind of a factory machine of driving IP all around the world. And so we could do what very few media companies could do. We could do a global offering of food. We could do a global offering of all of our content.
In this new world of streaming, will viewers be watching for platforms like HGTV or Discovery, or will they be looking for programs like The Crown, like Game of Thrones?
Well, it's hard to tell behaviorally exactly what people are going to do. But by doing this deal and generating free cash flow and taking a look at the assets that we have, by owning science globally, by owning every piece of IP that we own effectively, except for sports, we're long IP. We've spent a lot of money to own it on all platforms. And that gives us the opportunity. If Amazon said, I'd like to do an offering globally, the only other media company that could do that would be Disney, and it would be in the kids space. And so we would raise our hand and say, terrific, we have a great family offering. And so for us, it's about the long tail. And we think in the end, people that love food are going to pull it. We're not sure exactly how it's going to work, but we think the fact that we own all of our content and we have passionate viewers that they love us like they love a sports team. They'll come home and they put on HG all day long, or they'll put on food. And so we have a sustainable growth business with our synergy. And then we have all this IP that we could take direct to consumer, and we've started to do it.
Can you win in streaming without going through the bundlers? I mean, do you have to be on Hulu? Do you have to be on YouTube? Or can you do it directly? Is your product strong enough?
You know, we don't know. Everywhere else in the world, we're on almost every skinny bundle. Here in the U.S., we're in most of them. We're not on Hulu, and we're not on YouTube, but we're on most of the others. And people love our channels. And so, one, we think that over time we'll get on those skinny bundles. We hope to. We'd like to partner with our distributors because they helped us build our business. And in many cases we are. We're partnering with AT&T on DirecTV Now. We partner with Brian on Comcast on his offerings, with Charter. So that's the best way to do it, kind of regionally. But there is an opportunity for us to go direct to consumer ourselves, which we're already doing in a number of areas, in cars and in sports. But we could also go to those big companies. If you take a look at what NBC, ABC, CBS, and Fox spent 3 years ago, and how much is being spent by Amazon, Netflix, Apple, and Google, you know, there's a massive amount of share shift that's going on there. And these are real global companies, the likes of which we've never seen before. So if any one of those companies wanted to offer for $5.99 a compelling family-friendly service,
Order submitted.
We would either be
Order
most
submitted.
of it, we would argue we'd like to be
submitted.
most of it, or we could be all of it and see how it goes. Because anywhere you go in the world and you say Discovery or Animal Planet or ID or Oprah, people know our brands and they value them.
How will you make that decision about whether you go direct to consumer or you go through middlemen, essentially? How do you make that decision as CEO?
Well, look, right now it's not a fair fight because the direct-to-consumer businesses, the Netflix, the Amazons, we in media used to trade at about a 14 multiple because the view was that this great dual revenue stream cable and free-to-air business would go on forever. And the view now is that it's getting disrupted by some of these direct-to-consumer platforms that are global. There's a question of who's going to emerge and be the winner. We think, looking now, it's only the second or third inning, but we've carved out a very compelling spot of quality brands that people love, that we can offer globally, and we could offer them ourselves.
You stepped up big time on sports. That was a variation from what people had expected from you. Why does that make sense for you? talk about disruption in media. There was a time not too long ago when you were the disruptor in chief, in some sense. I watched you from Capital Cities ABC across the street as you created MSNBC and NBC. You created CNBC. How does this compare with that disruption when you disrupted broadcast? Basic cable came in and really disrupted it. How does it compare? What did you learn from that experience you can apply now?
Patience. In that case, Jack Welch and Bob Wright were committed to try and take the broadcast business into cable. For people that were around at that time, it was pretty unusual. And it's important because the business that you think you're going to launch that's going to work is never the business that works. The audience is always going to tell you what they get nourished by. And that's what our business is about. That's what most businesses are about. When we launched with Oprah, the Oprah Winfrey Network, we had a dream, Oprah and I, that it was going to be about living your best life. And we looked strategically at the space and said, we can do this. But when we went out with the content, Super Soul Sunday worked terrific, but a lot of the other stuff was too earnest and the audience went away. And we had to figure out, what are they going to come back for? And it took us a lot of years, but we started to listen, what do you like? That's what our business is about. We don't want everyone to watch, but the Oprah Winfrey Network now is the #1 network for African American women. So for us now, we've broken our company in half, essentially. We got half the company that's about growing our channels, doing what we believe we can do as well or better than anyone in the world. Then there's a whole group that has to figure out, okay, how do I get over the top? What do people want when they consume content over the top, you know? And I think you have to be willing to recognize failure and use it kind of optimistically. Good, we know that now.
And you can do it without the blockbusters.
The way people watch our channels, they don't. It is hit driven if you're a broadcast network. The way people watch our channels, they come home and HG gets me. Discovery is my channel. TLC in Middle America is the channel that I love. I love Oprah. That's the channel that I watch. That's how they curate. Where do I get nourished? That's the business that we're in. We think that's going to be sustainable, and we think that ultimately they could either pull one of those really big, expensive platforms, or when they're looking to pull something that they want that's family friendly, with brands they know, characters they know, everywhere in the world, for a lot less than they would have to pay for that, we look different. And we got to, over time, we'll see if it's an aggregated offering, if it's an individual offering, but I think we got a game. But the first thing we got to do is execute on this.
You stepped up big time on sports. That was a variation from what people had expected from you. Why does that make sense for you?
Well, first, we're in every country. So when I say we're in every country, we have a sales team, we have a distribution team, we have creative people, we have marketing people, and we have strategic people. So we kind of know each country. And so when we looked at sports, Eurosport was not being individually fed into every country across Europe. So when we bought Eurosport several years ago, we looked and said, we can use our sales infrastructure. We could use our distribution infrastructure to drive more carriage. We could use our sales and marketing people. And it was a little bit of a leap, but it was driven by the idea that content used to be about getting inside of the television box, that rectangle. And even if you had content that was just okay, second or third choice, you did okay. When we launched our direct-to-consumer sports player 3 years ago in Europe, so we reach across 750 million people in Europe. We have the tennis, we have the cycling, we have the winter sports, we have summer sports, we have the Olympics. So we figured we have a great offering, 750 million people, $8, we should be able to do terrific. And we wrote 10 things that we thought we knew for sure. 8 of them were wrong. And the users told us. They said, okay, you know, we tuned in for the French Open, but we didn't want to watch Tour de France. We love tennis. Or they told us that maybe the most interesting takeaway that we applied to the Olympics is that when people consume content on a device, they expect to hit the device when they get up in the morning and see content. And then they expect a few hours later to hit that device. You need to multiple publish. So if speed skating is starting at 2 o'clock in the afternoon, the people that love speed skating have to get up in the morning and see a 1-minute video or 2 1-minute videos or some information about, and we downloaded 700 pieces of short form content in 21 languages every day to our Olympic player. And that's one of the reasons why we were able to aggregate about 500,000 subscribers. They love the sports IP, but they really, when people look at content on a device, they expect to be entertained and nourished whenever they hit it. And if you hit it and nothing is new, you're disappointed.
Can you do that and not step up into the really high-priced sports projects? Because that, to some extent, sounds a little bit like ESPN in the United States in the early days. They had lesser sports, and then they had to get in the NFL, they had to get in the NBA, and that, as you know, costs enormous amounts of money. Can you have a strategy that stops short of that?
Well, opportunistically, we have taken football. But we haven't taken football where we get in a bidding war with anyone. If you want to offer your content on a pan-European basis, there's only one place to do it, us. Or if you're a federation, if you're the Speed Skating Federation, you could sell it in every country. And the difference between the U.S. and Europe is in the U.S., it's one culture, one language, and everybody likes the same four sports, essentially. 90% of viewing, 80% of viewing is football, baseball, basketball, hockey. In Europe, there's a lot of sports that are number one in Northern Europe that are number 10 in Southern Europe. And if you're a federation, you know, we're the one stop. And we've been very effective about getting a lot of content. And all the sports content we have with Eurosport, we've, as much as we can, we've gotten it long term, and we own it on all platforms.
You have scripts, as you say, you need to execute on that now. But is that enough for Discovery? Are you on the outlook for further acquisitions?
This is news, but not as you know it. This is TikTok by Bloomberg, the first and only global news network built for Twitter. 24/7 news streaming live on Twitter.
You have scripts, as you say, you need to execute on that now. But is that enough for Discovery? Are you on the outlook for further acquisitions? Do you need to get bigger scale?
Well, look, as I said earlier, we're in a different place of the soccer field than everyone else. So we think if we could execute on this, own all those passion brands globally. Scripps never took food and HG and cooking and travel around the world. So we have an opportunity to take all that IP, we'll convert it into 48 languages, and we'll start to spread it around. So that'll be a revenue synergy if viewership increases, and we think it will. In Latin America, we've bought some of their content. But I like our hand here. We got some work to do. We got to pay down some debt. We got to prove out that we're going to generate that free cash flow and that we really did build a moat. But at the same time, we're going to be working really hard about learning how consumers consume content on devices. And we're talking to every distributor, because we're better off if somebody that's already in business with you and you're already paying a $100 bill can then have a chance to check a box and pick us. Today in the U.S., there's probably 25 or 30 million subscribers that are broadband only. The one service that's being marketed to them heavily is Netflix. And the industry built us, we built them, and together I think we're going to come up with something that's going to be pretty compelling in terms of a skinny bundle, because it's not sensible to have Netflix have all that field without us on it.
You said you need to pay down some debt because you do have more debt on your balance sheet than a lot of other media companies do. You said you're going to save $350 million a year on Scripps. How are you going to do that? That's a lot of money, as you and I both know, to save in an operation.
Well, look, as we've looked at putting these businesses together, and it's early days, it's only been 5 weeks, but we've been working on it very hard for 6 months going up to it. We think that's rather conservative. These are 1-over-1 companies. We have 12 channels in the U.S., they have 6. So we're in the same business. We have 220 research people, they have 140 research people. We have 650 salespeople, they have 550 salespeople. And their people are really good. We put some of their people in charge in our new structure. And the idea is, who are the best and the brightest? Because when we looked at it, we said when it comes to nonfiction, who are the best 2 producers of nonfiction content, and who is best at monetizing it? And we looked and we said, in some areas they're better than us, in some areas we're better than them. We put these 2 together, and we will spend $3.5 billion on content, maybe growing to more than that. This is a hard business. We're in the business of creating stories and characters and getting people to turn on their TV and love it.
You've referred a couple of times to John Malone, who's a shareholder, doesn't control your company by any means, but you know him well. What is it like to have John Malone as somebody you can call up and say, should we do this, should we do that? What do you think about what's going on?
Well, I think about my last 30 years in this business, and it's sort of like what you want for your children. You are who you hang out with. And it really helps define you, the narratives that you hear, the questions that you hear. And so I look back over the last 30 years and 15 years listening to why Jack didn't want to do an acquisition that we brought him, or what we need to do with cable, or how we need to do it. Bob Wright, one of the most successful guys running NBC, the Newhouse family, Donald and Cy Newhouse, and Bob Myron, who's a genius and has been in the cable business and built Bright House, and John Malone. And so when I think about where people should be spending their time, yes, you'd like to get the right job. Yes, you'd like to think that you're going to make some money. But I took a 50% pay cut to go to NBC from a law firm because I thought I can get to hang out with the guys at the Peacock, and maybe someday I'll get to meet Jack. And a lot of the way I see the world, I still talk to Jack all the time. So I'm hearing Jack's voice, I'm hearing Bob Myron and Donald Newhouse's voice, and I'm hearing John's voice. And so for that alone, I'm one of the luckiest guys.
It strikes me that you're now running Discovery, which really appeals in the United States to a lot of the middle of the country. People that the President of the United States probably wouldn't object to. In fact, I understand the President of the United States is a fan of Shark Week. Actually, I read that someplace.
I hope he's a fan of a lot of our stuff. I think, I hope.
You helped create MSNBC. That is a channel in a very different place. What do you think about the media landscape today in the United States in terms of politics? Because it seems to become much more polarized.
Well, I can just say that the business changed. When we launched MSNBC, Brokaw and I and Andy Lack and Tom Rogers, there was a group of us, and Jack said, we're going to launch the best news network in America, and we're going to use the #1 news division in the world to do it. We had this amazing library. We structured a deal with Microsoft to get them in. They wanted the library at the time, and that was our ambition. I'm not going to game out the different news networks in America, but we have to be practical and recognize that at least some of them are following that model, because you on the one hand you want to do the best journalism possible. On the other hand, you want people to watch you, and you want them to watch you for as long as possible. And part of the way we as human beings determine our success is, are we in third place? Are we in second place? How many people are watching us? How many people love us? And so I think that's the journey. And luckily, I'm not going to be one of the guys to figure that out.
Well, but let's talk about how you keep score. That leads us exactly to a great conclusion here. How do you keep score? I mean, I see that now you've jumped up in the rankings, actually, including broadcast and cable. Big step up with Scripps. Is that the way you keep score? Is that how you just tell whether you, David Zaslav, are succeeding?
No, because there's lots of books that have been written about, more scale tips you over. So we're staying in our lane, and what's going to be successful for us, and we've made this decision. On every one of our channels, we've said, if you don't love us, if you're not one of the passionate viewers that loves survival, if you're not one of the people that love science or that love crime, go find some other channels that you love. When we're creating content for our channels, we want global audiences that really affiliate and have a passion for our characters and our message. And a big piece of that is we're not going for the best rating. We're going for the most potent audience that says, they get me. When I go there, I see something that I love. And if we put something on any of these channels that looks like we're going for ratings, they'll immediately say, what's this doing on here? And so they're quite clever, and you just got to continue. This is what we do for a living. Figure them out on TV, and try and figure them out in terms of the devices as to what they're going to love and what they're going to pay for.
David Zaslav, thank you so much for spending time with us today.
Thanks, David. Good to see you.
Coca-Cola, a 130-year-old iconic brand and a dominant force in the $800 billion soft drink industry. Synonymous with globalization, Coca-Cola operates in over 200 countries worldwide. The beverage behemoth now has a new CEO. James Quincy spent the last 2 decades rising through the ranks at Coca-Cola. Now, as head of the company, Quincy aims to win over a new generation that shuns sugar, and to show the world that he takes the environment seriously, even as he adapts to a new world of technology. James Quincy sat down with us for an extended conversation. We wanted to understand how he plans to use innovation to transform every aspect of Coca-Cola, attempting to change its culture while managing a global checkerboard of regulations and tax regimes.
Coca-Cola operates in a lot of different countries, which means there's a lot of different regulatory systems, a lot of different legal schemes that you have to really adapt to. Let's talk about a couple of those. First of all, the United States. The tax cuts, how does it affect Coca-Cola?
Yeah, we're still working through the numbers. I mean, our tax rate last year effectively was about 24%, so it's not the biggest change to us. Because we're an international company, the absolute rate hasn't affected us as much as perhaps some of the more domestically focused enterprises. But we're positive on moving the territorial system. So we think the simplification is positive in the long run. To the extent that it helped create more demand, that will be good news too. We're still working through the numbers that we'll lay out on our earnings call. Of course, we're part of having some of the money overseas, but in the end, if it generates more economic growth, that will lift all the boats.
Does the expensing of capital investment affect you at all?
Not in a great amount. I mean, it will make some difference. We'll lay that out, but that's not the biggest moving piece for us.
And if there is significant incremental cash available to Coca-Cola, have you decided yet, does it go into capital investment? Does it go into buybacks of shares? Does it go into dividends?
I mean, we weren't short of cash at the end of the day, so, you know, we've been a successful company. We've got the resources we need to invest in the marketplace. We're still working through exactly how the puts and takes work, because obviously you've got to pay tax on the cash first, or in addition. So we're looking at how we use all that and how we make the right capital allocations.
One of the really big issues for the United States right now is the so-called dreamers. These are the young people who were brought here as children. And the question is, do they get to stay as adults, essentially? Do you have at Coca-Cola people who are really uncertain about whether they can stay or not? There are about 700,000 more or less nationwide.
Yeah, we have some people in our company and in our bottling partners who fall under the Dreamers or the Dakar program. You know, we would love government to find a way to make proper underlying immigration reform, and including finding a solution for the Dreamers so that it's not so disruptive and that they can stay. So hopefully they'll find a path to that. Of course, partial solutions may be necessary, but we would love to see fundamental reform.
You ran Mexico for Coca-Cola at one point, so you have seen this issue on both sides of at least our southern border. Do you see a path forward, a constructive path forward on immigration?
I think there's a path forward, but I think it also is connected, and it can't be completely disassociated when you think about long-term fundamental reform from getting both economies to grow. In the end, part of what drives the informal immigration is the disparity in the economic outlook. So having a community of North America where all the economies are growing actually helps solve that problem too. So I think, you know, leadership from the United States to drive growth will help solve some of these other issues too.
You've also seen NAFTA from both sides of the border. You've seen that issue, which is another hot issue right now in the United States. Has NAFTA overall been good or bad for the United States?
My view would be that free trade deals are good overall for all participants, and I think it's been good for North America and all the countries in it. Doesn't mean it's perfect. Very few free trade deals are perfect. So can it be made better? Yes, I hope they can make it better. But I don't think we should start deconstructing global trade. I think it's been a powerful engine for lifting all boats. It doesn't mean it's solved all problems. There are questions of income inequality. There are questions of not all the rules were perfect and need to be improved. But let's go forward, not backwards.
So when President Trump first came in, he was very closely allied with many people in business. He consulted and he had panels that he talked with as well. Do you get to talk, either President Trump or the administration, about things like NAFTA? I mean, do they consult you, or do you make your views known to them?
When there are things where we have a view or it affects our business, we make our views known either directly to the administration or through many of the business forums, like the Business Roundtable. There are enough points of intersection collectively and individually with the administration.
Order canceled.
They know what
Order
they know
canceled.
what we think.
So from that, do you have any sense of where we're headed with NAFTA? Because there's conflicting reports. I mean, the Canadians seem to be preparing for actually U.S. withdrawal. There are a lot of people in Washington who say, no, we're not going to withdraw. Do you have any sense from your point of view of where we're headed?
My view on negotiations is you've got to let the negotiators negotiate. And if you're not in the room, you don't know what the answer is until it comes out. So I think the important thing for those that aren't in the room is to keep saying what they believe to be true, what they believe to be the areas where things can be made better. And then the negotiators have got to get in the room and thrash it out, and trying to work out what color the smoke is coming from the room doesn't lead you anywhere until they come out and tell you what the answer is.
Your native country has voted in a referendum to leave the EU. And I won't ask you what you think about that, but tell us how that's developing. I mean, is there a soft landing there that you can see? How would we get to it?
It does a bit go back to my point about negotiations. You're never really sure until till the cake is cooked. I think the logic of the economics is a softer rather than a harder Brexit. I think in the end, whilst it won't be a catastrophe one way or the other, life will be better. There'll be more economic growth if it's a softer Brexit, but there's a lot of details and a lot of different points of view to work out, because in the end, the referendum wasn't between do you want this or that. It's like, do you want this or not want this? It wasn't a referendum around the version of the exit, which is kind of where we're trapped at the moment. And of course, there's a lot of negotiations going on. It's very important to get it right for the UK and to some extent for Europe as well.
Whether it's Brexit or whether it's NAFTA, how do these trade issues affect Coca-Cola's business?
I think one of the great benefits of the Coca-Cola system is we're global, but we're extremely local. I mean, we manufacture in every country virtually that we sell in. Virtually everything that's sold in the US is made in the US. Virtually everything that's sold in Mexico is made in Mexico. Virtually everything that's sold in the UK or France is made in that individual country. So the global trade restrictions or openings don't tend to affect us heavily in the moment. To the extent that they reduce or increase total economic growth, that's what matters to us. And so I think philosophically, we're pro global free trade because it drives economic growth. Therefore, let's focus on making those deals better because it will provide the wealth to then solve a lot of society's problems.
You came in and took over Coca-Cola and really trumpeted innovation as critical to your future. I believe you have a chief innovation officer, but maybe you're the chief innovation officer in some sense. How do you innovate in a 130-year-old company that's so well known around the world, has been there for so long, has such an entrenched perception of people's views?
It's hard. I mean, any institution that's been around a long time, whether it's a company or a government or any organization, it's going to be very hard. So I think from my point of view, if I'm not the chief innovator, I'm certainly the chief agitator for innovation. And what that means is, driving the culture to try and do a few things upon top of everything else we do. Stay curious. If we're not curious about the outside world, about the consumers, about the customer, about what's changing, how will we innovate? But curiosity just leads you to an insight. It's very passive. You need to drive empowerment so people feel they can go and do something, that they're not waiting for head office to make the decision, that they can get up in the morning and go and do something. And I think the next thing is you've got to be inclusive. You've got to try and connect the pieces because we've got a tremendous global knowledge and tremendous global system. Sometimes your idea has already been tried somewhere else. So connect to the other parts of the system. And lastly, we probably fell into the trap of trying to make things perfect before we did anything in the past. No, we need to learn from some of the software companies, have version 1.0, 2.0, 3.0. That gets us both innovation and speed. And if we keep pushing those four things, I think we'll make progress.
And how do you know? How does James Quincy know whether you're getting the innovation job done? And I mean that in the sense you're sitting atop a very large organization, a lot of people spread around the world. How do you judge whether the word's getting down and people are already changing their behavior?
It's hard to know, but the only way forward is to look for multiple signals. No, there's no one number or one metric that's going to give it the answer. So we have employee surveys where we ask people. We can look at the sales number and measure the success rate or the number and the success rate of the things we put into the marketplace. We can look at what our research and development pipeline is generating, and are we really getting new patents? Are we really making progress? So I think one has to have a dashboard to look across and say, is there progress?
How is technology changing the way you do business, and for that matter, your workforce?
This is news, but not as you know it. This is TikTok by Bloomberg, the first and only global news network built for Twitter. Objective reporting that you can trust. Curated comments that provide insight. TikTok by Bloomberg. 24/7 news streaming live on Twitter.
Technology. It's disrupting just about every company that we know of today. How is it affecting Coca-Cola? And first, talk about how it's affecting your relationship with your consumer. How you deliver to your consumer, things like e-commerce, how you market to your consumer.
Yeah, I mean, we kind of look at it in three buckets. How we engage with consumers, you know, there used to be TV advertising, now there's social media. The ways of engaging with the consumer are changing rapidly. Who the customer is and how the shopping actually happens is changing rapidly. And of course, internally, it's changing rapidly. With the consumer, around the world, you know, TV is still the biggest vehicle, maybe less so in some of the developed economies, but around the world, it's still the biggest vehicle. But a lot of it's going into social media. We work closely a lot with a lot of the new tech companies in social media, trying to find ways to, you know, continue to have a brand role. I mean, in the end, someone's got to pay for the content to be developed, whether that's through advertising or sponsorship. So I think there's a lot of change going on. We're adapting. I think we feel we're kind of towards the front end, but what I'm totally clear of, it's going to be different in 5 years, and it's going to be very different in 10 years. And we're going to have to keep investing in innovation and keep evolving to stay close to the consumers.
As you look around the world, which markets do you see the fastest innovation when it comes to e-commerce? When you just sort of get on your app and you order something up, it gets delivered, for example. Is it China? Is it the United States? Is it Europe?
I actually think that places like Shanghai and some parts of Western Europe are on the cutting edge, along with some of the bits of the U.S., but really at a par. I mean, you know, the U.S. in many respects, there's a lot of advanced e-commerce, but I can tell you it's very advanced in places like Shanghai and Western Europe as well, and the penetration of e-commerce in aggregate is even higher in some of those places than even the U.S. So, you know, when you want to learn what's going on, I would be just as tempted to tell you go to Shanghai as stay in New York.
And how do you market in that circumstance? I mean, we're used to going to a fast food restaurant, for example, and there's a Coca-Cola there. It's on the menu.
Yeah.
So let's have that Coke or that Diet Coke.
Yeah.
You don't have that when you're on your app.
No, but you have to get it. I mean, you know, if you went back even 2 or 3 years in China, for example, when a lot of the apps and the mobile payment systems came in, we weren't on the menu. Actually, even worse, we were trying to sell perhaps a returnable glass bottle to the restaurant, which had no way of being in the delivery system. So we've had to re-engineer our business system very quickly to both be present on the app. So what's the virtual representation of what you'd normally see in the store? And how do we change the packaging portfolio so that we can be part of the delivery system? And you have a lot of places in Shanghai where food ordered on apps and delivered is 30–50% of the restaurant sales.
That's the relationship with the consumer.
Order
Talk
submitted.
about Coca-Cola
Order
as
submitted.
Coca-Cola.
Order
How is technology
filled.
changing
Order
the way
submitted.
you do business, and
Order
for that matter,
submitted.
your workforce?
It's changing it in lots of profound ways. I mean, in simple terms, you know, you go back 10, 20 years, we were a large company and we're one of the few that could afford to invest in expensive IT systems and do our own stuff, our own programs, our own server farms. You wind forward to today, that's no longer the model. We've had to move to the cloud. We've had to move to standard programs that whole industries use, and we had to use the mobile. The one thing I always say to the IT department is, just put it on the phone. Everything can be done on the phone. Let's just move everything to mobile on the phone. The old days of IT had training budgets. Why? Everyone knows how to use the apps on the phone. So it's profoundly changing the way that we work, and I think it's going to continue to flow through the organization. We have a big program of digitizing the company.
Does that translate into fewer employees as a practical matter because of the efficiencies from digital?
I think for sure it changes into a different profile. I mean, people are having to adapt to doing things in a different way. We've actually made a lot of changes in our IT departments to move to a different skill set. So it's certainly changing the nature of employment and the sorts of profiles you want. Whether we buy the services ourselves or we buy the services or do it ourselves makes a difference as to where the employees are. But net, more employment's being generated in the economies.
So can Coca-Cola compete with Silicon Valley and the digital startups when you're trying to recruit the young computer scientists?
Well, Atlanta is a very fast-growing economy. The state of Georgia has been ranked, you know, top 1 or 2 place to do business in the U.S. for many years in a row. The local political system has done a great job. So has the city. So it's a very competitive economy there, and we do very well in it. We're happy to see Atlanta and Georgia growing, and they've done a lot to invest in tech startups and the media industry in and near Atlanta, and it's being very successful.
As you look toward really substantial growth in these new beverage categories, are you looking at acquisitions? Are you looking at organic growth? I mean, you have been inclined, I believe, to look for smaller brands, startup brands, bringing them along. Is that the future path to a significant degree for Coca-Cola?
I think it's going to be both. I mean, we have grown organically, but we have made these bolt-on acquisitions, as we call them, the little small ones, the niche brands. I think where we see that something is a really good idea, we invest in them. Sometimes we buy them, sometimes we just invest with them. But there's a quid pro quo. They get the capital that we inject, yet we can introduce them to the globe, not just the country that they've launched in. And that's helped us double the number of billion-dollar brands that we sell around the world. So I think it's going to be an and strategy rather than one or the other.
It's interesting. It's a total beverage company. It's not a food company. I mean, there are some competitors who said, let's become a food company, at least in part. Why did you make that decision? And does it make you any more vulnerable, forgive me for saying, but even to acquisition? I mean, you're what, $200 billion market cap? It's a pretty big acquisition. But there are some pretty big consolidations in the food industry out there.
I think firstly, you know, we're focused on beverages because that's where the greatest synergy and the greatest application of our know-how and our fabulous global bottling distribution system is. It's the thing that can be most synergistic with what we've already got. And the market for beverages is one of the best growing markets in the whole of the supermarket or in the other stores. So it's a great market. We have a good position. We can create a lot of synergy. So it's a question of choices. I sometimes say never say never, which then causes confusion because people say you haven't ruled anything out. I say no, it's a question of what's most logical. And beverages are the most logical thing for us to do first because we stick to our knitting. In terms of how we think about the consolidation, in the end of the day, I'm pretty convinced that investors, gold star goes to those that grow with expanding margins. Growth is the name of the game. If the category's got no growth, then optimize the margin. Okay, but that's still silver prize largely over the long term. So I'm pretty clear. If we focus on driving top line growth, which we believe we can with our strategy of total beverages, we will attract an investor base that will be very happy with us over the long run.
By 2030, you want to be getting a bottle back for everyone you put out there. That's a lot of bottles for Coca-Cola. How are you going to attract all that plastic? World without waste. Great goal. You have a big new packaging announcement. Why is it important to Coca-Cola, not just as a corporate citizen, but as a business?
You know, it's important to us for a very core part of our values. We've always believed that to have a healthy business, you need to be operating in a healthy community. And one of today's biggest problems is packaging waste. We've done a lot on making things recyclable. We've actually invested a lot of R&D in making progress on reusing it. What we need to do is collect it. So this announcement is about the big missing piece in generating a world without waste, which is collecting back the plastic and creating a market economy for that collected plastic. And I think that's going to do great things to help us grow into the future without creating waste, which is good for us and it's great for communities.
How are you going to attract all that plastic? By 2030, you want to be getting a bottle back for everyone you put out there. That's a lot of bottles for Coca-Cola. How are you going to attract all that plastic?
Well, to give you an idea of the dimension, we need to bring back, every person in the world, if they bring back 2 bottles a month, we bring back all our bottles. That's our objective. 2 bottles a month for every person. We collect every bottle we put out. How are we going to do it? Well, there'll be different systems in different countries. You know, every country needs a solution, but it won't be the same everywhere. There are kind of places where it's reasonably advanced in Europe to more informal economies where the collection happens. So there's going to be different solutions everywhere. We're going to have to work with NGOs, other industrial companies and governments to put in place these solutions. But it's absolutely doable. And I think that's what's exciting about setting the objective.
We're very conscious of this in the United States, but what about in other places, like China, for example?
Yeah, look, I think the emerging and the developed countries are where more of the problem is than the US or Europe, which is probably at the leading edge. So we need to do more there. But recognize that in a lot of these countries, there is some informal collection system already going on across a wide range of waste. What we need to create is the circular economy. We need to create value for that. So often in the case, and we did this in Mexico, for example, you go back a little more than 10 years, it was less than 10% of the plastic was recycled. Now it's 60%. How? The informal economy was collecting the waste, but there was no market for it. No one wanted to buy it. So we went into the marketplace and bought the plastic, invested in factories to recycle that and reuse it in our bottles. So I think there's a model there for the Chinas and other parts of the world on how to create value out of plastic and get it reused.
You've laid out a bold strategic vision for your company called Total Beverage Company that includes things beyond Coca-Cola and even beyond Diet Coke. It goes on beyond that to these 5 categories. What's driving that? Is that basically to get away a bit from sugar drinks?
Actually, you know, we're following the consumer. When you look at what's happening around the world, as the world is urbanizing, as people have got more disposable income, they're spending more money on a range of things, including beverages. So what's important within that growing market of beverages is they want more choice. Different people want different things. So if we really want to be able to serve the customer, serve the consumer, we've got to follow them. We've got to get into more categories. Coke is likely to remain the heart and soul of the company. It's the world's biggest, fast-moving consumer good brand. But we need more. We need to offer consumers what they want all day long. We have to offer choice. And I think that's what's going to guide us forward. And in a way, it goes back to where we started. If we pay a lot of attention to what the consumer wants, they will take us to where the business needs to grow. And then it ultimately ends up in growth for the business.
I understand that on average around the world, people consume about 8 ounces of a beverage per day. And Coca-Cola, I was told, is about a half an ounce. What is your goal? How much of the market share of total beverage can you really take globally?
I mean, I don't think there's a end of history moment when we reach nirvana. I think what we're looking to do is gain share every year. I mean, it's a competitive marketplace. We have a lot of well-funded competitors doing a lot of exciting things. So we're focused on is can we serve the consumers and gain a little bit of share each year and generate a growing business system. Our objective is to create value for everyone who touches that business system, whether it be the economics of the people who are in the value chain like the customer, or even society with initiatives like the packaging one, you know, which I think builds on our heritage of creating shared value in the world. You know, 10 years ago or so, we set ourselves the objective of being water neutral by 2020, and we achieved it a few years early. So we return to the environment all the water we use, which is one of the things that gives us confidence that we can achieve this packaging objective. So we get business growth and doing it in the right way for society.
Okay, thanks very much. We're wrapping up there. This was terrific. Thank you so much. That was really fun.
Thank you.
Welcome to Bloomberg Daybreak on this Tuesday, May 12th. I'm Alex Steele. Here's everything you need to know at this hour. Let's take it right from the top. Saudi Arabia tries to stabilize the oil market with more production cuts, while Saudi Aramco's profit plunges 25% in the first quarter.
they did talk about the fact that in the earnings report that the pandemic is going to weigh on the future profits. Already for this quarter, they came in $16 billion, just north of that. It's a lot of money. This is still the world's most profitable company.
The company will pay a dividend of $18.75 billion for the first quarter. That would leave it on track to meet its full-year goal of $75 billion.
You should now think about going to work, provided you do it, provided your workplace is COVID secure.
Boris Johnson waters down his plan for rebooting the UK economy after employers and labor unions said many workplaces are not yet ready for people to return. This comes as governments struggle with reopening, more debt issuance, and stimulus. In the U.S., House Speaker Nancy Pelosi is working with Senate Democrats pushing for another massive aid package. The White House is pushing for a pause.
And Republicans saying, hey, not so fast. Why should we be having to pay for, this is the conservative argument, for fiscally, in their minds, irresponsible states?
Dr. Anthony Fauci will testify before a Senate committee today and plans to warn of danger of trying to reopen prematurely.
China would like to reopen negotiations on the trade deal to make the terms more favorable to them. Is this something you'd be interested in doing?
No, not at all. Not even a little bit, no.
President Trump stands firm on China, waiting to see if the country lives up to their promise in the Phase 1 trade deal. He also said he was very unhappy with China over the spread of COVID-19. Meanwhile, the Fed will start buying corporate bond ETFs today.
Order canceled. Order
If you
canceled.
look back, it was
Order
announced
canceled.
on March 23rd, and March 23rd was the low of the stock market. After that Fed announcement, the market has been rallying ever since. So it really had a major effect.
Another facility to buy debt directly from issuers will launch in the near future. All right, let's get a quick check-in here on the markets. If you came in a few hours ago, we were actually down for S&P futures as well as over in Europe. Not a lot of conviction either way, but now we're sort of getting a little bit more steam to the upside. The Dow Jones futures, for example, up by 119 points. Maybe part of that is the corporate bond buying ETFs from the Fed, but it's hard to get any sort of real conviction. What we do know is that we're going to see $32 billion worth of 10-year notes auctioned off at 1 p.m. today. The 3-year yesterday was pretty strong considering the amount of issuance that we've seen, and overnight we had China data potentially throwing some cold water on the V-shaped recovery as factory deflation continues and consumer prices also seem to roll over. None of that echoing, though, in the markets. So now let's get more on the markets. Joining me is Christopher Zook, CAS Investments founder and CIO. I want to start with China because the rhetoric of that weaker PPI data overnight was that we will not have a V-shaped recovery globally. What letter are you subscribing to the economic recovery versus the equity market recovery?
You know, it's interesting. I actually would go away from the letters and would go more towards the swoosh that has become a commonplace term. I think we will see a recovery that feels a little bit V-ish at the beginning, but then it's going to flatten out. The long-term ramifications of this are pretty significant, and so it's going to take a lot more of the economy really showing and proving to people after that initial first wave, thus the swoosh.
So is that enough to make you want to buy equities, though, at this point, that looks very much like a V-shape?
You know, Alex, we started our year at the 1 on the CAS scale of 1 to 5. 5 is the back up the truck number. 1 is the most cautious. And it's not a market timing tool, but it's where risk reward is. And so we upgraded our rating from a 1, where we started the year at, to a 2 in early March. And then on March 22nd, we upgraded to a 3. And we just lowered that rating back down to a 2 because the market has gotten very much ahead of itself. But at the same time, things are going to get better. So again, not a market timing tool, but the risk from 2,800, 2,850 on the S&P 500 is a heck of a lot higher than it was at 2,300. So what we have to be sure that people understand is that there's just so much already that's been baked into the recovery, into stock prices right now. It's going to be tough for the economy to deliver on those expectations.
So how do you distinguish then between the small caps, which should benefit in a recovery, will benefit from the Fed buying corporate bond ETFs if it pushes investors down into buying high yields, versus the tech large caps that continue to be sort of the strength that holds up the equity market?
You know, it's a really interesting dynamic because of the fact that the strength of the market is on that which they can really count on and feel visible earnings and visible cash flow growth is going to be there. Obviously, the large cap tech is right at the front of that because they're much less impacted by whether or not the stores reopen or they don't in a direct way. Obviously, the small caps have been the biggest beneficiaries, but they also are the ones that got hit the hardest. So the ramp up that we've seen from the lows have been really dramatic in the small cap world. And to your point, they've been the biggest beneficiary of the governmental intervention, and that is going to begin to taper. And not necessarily that they're going to stop doing what they're doing, but just the benefit those stocks are going to receive is going to taper. And what's going to happen is we're going to actually have to see the consumer become strong again. We're going to have to see businesses be able to function at 100% capacity for an extended period of time. So small caps, we feel like, have probably got as much headwind right now as tailwind from the levels that they are today. So I think that we're going to have a tough time to make really good returns in the small cap range unless everybody is surprised by the economy being so much stronger than people think that it will be in in the second half of 2020.
So the other issue I think that now we're having to contend with is U.S.-China trade battle. So overnight we learned that there is now a formal request for a state-run pension fund to not buy Chinese investment vehicles. You had Robert Lighthizer, U.S. Trade Representative, an op-ed overnight. Here's what he had to say. He said the era of reflexive offshoring is over, and with it, the old overzealous emphasis on efficiency and the concomitant lack of concern for the jobs that were lost. After we have defeated this disease and reopened our economy, we cannot forget the hard lessons learned from this misguided experiment. Does that speak to you of the risk of trade wars, protectionism, supply chain retrenchment, etc.?
Yes. Easy answer, yes. I think that is going to be the biggest impact long-term from this, is onshoring, whatever term we want to use, is people are going to recognize that the heavy dependence on one country, any country, is really dangerous to the overall supply chain of an economy and of a business specifically. So whether or not they completely leave China, that's a very different discussion. But I think there's going to be a backup plan and then a backup plan of the backup plan as a result of realizing how travel and basically overall economies can be shut down in almost the blink of an eye because of something like this.
So based on that, how do you then value an equity? Because if they're international and they say get cheap labor from China and then they're going to move that to some place that's more expensive, and this much more of a catalyst in some ways than the actual U.S.-China trade war, how do you value?
It's really hard. And the answer is that I think profit margins here in the U.S. and for any of the global companies, they may have seen their peak for a very long time, if not permanently. And that's a bold statement, but I do not know how profit margins are going to continue to march higher. They were already at peak levels prior to the virus. And so as a result, if people are going to have to diversify their supply chain, if they're going to have to go into countries that don't have as favorable labor costs, it's going to impact their expense structure. And so as a result, it is really hard to value equities right now for very, very vast majority of businesses. But that's another reason why you see money flowing into those that become a little bit more predictable, i.e. software companies, that don't have that same kind of elasticity to their cost structure that you have in a manufacturing company or an import company.
Yeah, that's a really good point. And let me throw one other wrinkle into the whole thing, and that's the elections in November. We're starting to see a lot of hedging in terms of volatility picking up around the elections. I'm assuming part of that's going to be about trade, but the other part that we're starting to talk about now is a rise in corporate taxes. There's also a big pushback against buybacks. We've seen dividends wind up getting cut. What's your base case for what a company is going to look like on that front, say in December of 2020?
Well, it's something to where if you take government money, you're going to take government impact, maybe not control, but certainly influence on your business practices. So, any industry that has accepted aid is going to be subject, similar to the banks have been, to rules and regulations from the government. And so the buyback is going to change, and dividend practices are going to change. Corporate tax rates are really tough to say because The last thing that I would hope either party would want to do is to derail an economic recovery by all of a sudden, really, increasing rates in such a way that affects job growth. But at the same time, it's no secret, and everybody knows we got to pay this money back somehow. And so corporate tax rates are likely to be under pressure to go higher regardless of who wins the White House. But it's going to hopefully be a 22 conversation, not a 21 conversation, to where we can at least get, exit speed, exit velocity out of this recession.
But to your point, the profit margin and the sort of the structural shift there. All right, stick with me, Christopher Zook of Cass Investments. Coming up, we'll break down oil. You got a 25% profit plunge at the world's most valuable listed company, how Saudi Aramco plans to keep its appeal to investors. We'll break that down next. This is Bloomberg. So Saudi Aramco keeps its massive dividend despite a 25% plunge in profits. We want to get more now with Bloomberg's Anne-Marie Horton. Anne-Marie, walk me through sort of the quarterly results for the company and then the importance of the dividend here.
Good morning, Alex. Yeah, so they had north of $16 billion for their profit. Sounds like a lot of money, and it is, but that was still 25% lower than this time last year. And of course, this comes as the oil market and the industry just deal with this twin shock of the price war and the demand destruction we're seeing due to the pandemic and the lockdown of economies around the world. And then, of course, the dividend. This is really the big draw for Saudi Aramco. This was the massive draw to get people to want to buy into the IPO in December. And, of course, it's huge for the kingdom because they own 98% of the company. So the dividend, what they're paying out for the first quarter, means they are on track to remain this $75 billion payout for the year. The question becomes, and what was interesting about the free cash flow for the first quarter was at $15 billion. The dividend for the first quarter was north of $18 billion. So already you can see money starting to dry up. So for the second quarter, the big question is, when we have especially a lot of profits are going to come under pressure for the entire industry. April's when the market really imploded for the oil market. The question becomes, do they borrow to keep that dividend, or will they have to cut it? They have low gearing. They'll likely be able to tap the markets to maintain that dividend is intact.
Why is the dividend so important? And it obviously is for big oil in general, but we've seen, say, Shell, Equinor make adjustments to their dividend. For Saudi Arabia in particular, though, it feels very important.
Yeah, it is really important. And But part of it is that attraction that for the IPO that was just in December to ramp up this support, to buy into this IPO, which pretty much became just a domestic listing. This was so attractive, but also the kingdom relies on Aramco. 98% they own in Aramco, and those royalties and those dividends, all of that goes to the kingdom. And we've already seen a lot of financial pressure on the kingdom due to the collapse in the oil price as well as the pandemic. What we saw overnight, Sunday evening into Monday morning from Riyadh was really astonishing. They had a slew of austerity measures, tripling the VAT from 5 to 15%. Now that's going to be controversial for everyday Saudis. They are just getting used to that 5% VAT from 2018. Then on top of that, they're also cutting the bureaucrat spending, what the government workers get spent. So they are doing these slew of austerity measures, and then on top of that, yesterday, Alex, we heard from the ministry, and they're cutting deeper as well when it comes to production, taking their production below 7.5 million barrels a day. Alex, just a few months ago, you and I were both talking about Saudi pumping 12.3 million barrels a day. So you can really see the strain that is on the kingdom right now.
Totally. I mean, that is a staggering jump in just a few months. Thanks so much, Bloomberg's Anne-Marie Horton. Still with me, Christopher Zook of Kaz Investments. Christopher, do you like anything related to oil right now?
We do. There's the old joke, which is that the cure for low oil prices is low oil prices. So, we have seen the bottom, I would guess. Obviously, in pricing, it's always hard to predict the front month. But when you look at the back end, it's really unlikely that we're going to see demand destruction like we have seen, and also this price war with a significant increase in supply. Back to Saudi Aramco, I mean, my view is they will cut production dramatically to drive prices significantly higher before they will cut that dividend. It's too important to them. And I think that is true in so many other areas of energy, that they're going to do what it takes, energy as a whole, in order to get prices to stabilize. So when you look at that, there are multiple pockets of energy that we do like. We particularly like infrastructure. We like infrastructure close to the wellhead with low leverage. We also like some of the things that are happening in the E&P world, just simply the companies that have the ability to acquire some of the assets from those that just are not going to survive this. Estimates are between 20 and 40% of companies will go bankrupt during the cycle. And if that is the case, the strong will definitely survive and thrive on the other side.
Is now the right time to be buying?
That's always the hardest question to answer. And the answer is yes, but make sure you have some other powder available, because of the fact that this is a very volatile sector. And if you have another shutdown or you have another, significant drop in demand, then these prices will go lower. They've recovered dramatically already, in some cases more than 100%. So if you're going to be a buyer today, be sure that you're in a position to take advantage of lower prices. I would strongly encourage people that have the capability to trade options to be able to sell puts and take advantage of the massive premiums that are available there. You want to own a company, that's great. Buy some of it, but sell some puts against it in order to be able to buy some more if it goes lower, and get paid very well if it just stays the same price or goes higher.
So in this thesis, is a dividend important to you? And I ask that because in the big oil case, that's like all you want to own them for is a dividend, and even that's going to get cut on some basis. And I just wonder how you look at that for the energy space.
I mean, I think in the integrateds, and it's certainly got to be part of your overall total return modeling. So yes, it's very important, but at the same time, the long-term cash flow growth is going to be what really matters the most, whether it comes to you in the form of a dividend or it comes to you in the form of earnings growth. In the case of the vast majority of the rest of energy, when you accept, of course, the MLPs that are designed for an income stream, when you look at the rest of oil and gas, the dividend is much less important. Right now, what matters the most, by far, with no exceptions, is the strength of the balance sheet. If they have a great dividend and a lousy balance sheet, you really don't want to own it. If they have a great balance sheet and no dividend, it may be the best thing to own. So balance sheet is where people should be paying the most attention right now, because they're the ones that are going to be able to buy really good assets at very good prices.
And that brings me into a broader dividend question. We talked about sort of structurally lower margins in the previous segment. It's hard to know what cash flow is going to be for companies in the next 18 months. Do you have a strategy around the dividend story? Therefore, futures are showing they're not going to recover to pre-crisis levels for years. Does that change your investment strategy?
It does, and you have to become much more reliant on multiples, which, as we talked about, is so hard to figure out what the E is going to be, so therefore what price you should pay based on an unknown E. So you really, really, really have to be confident in the valuations and what the cash flows of those businesses are going to be, because most likely dividends are not going to be a major source of return. They have been a reasonable source of return for the last decade, but most of it has been multiple expansion. Almost all of 2019 was multiple expansion. So if we're not going to get growth of earnings and we're not going to get good dividends, you just have to really believe, which is really hard, that the multiple's just going to continue to grow and grow and grow. And that's just not a great bet, which is why right now we think a trading range or a reasonable band is what people should expect. And so how can someone make a great return during that kind of environment, which again, using options, we think there's some really good ways to do that, but you should not expect that, you know, the 21 forward multiple that we have right now on the S&P is going to grow back to 30. It's just not going to happen with this kind of uncertainty. So be sure that you anticipate what the cash flows are going to be. Buy the companies where you can model it well, and then from there, feel really comfortable that you're going to benefit from the growth of the business, not the growth of the multiple on that business.
All right, that's a great point. Thanks very much, Christopher. Appreciate it. Christopher Zook of Kaz Investments. Always a pleasure to chat with you. Coming up on the program, signs of hope are actually coming from underground. New Yorkers starting to take the subway again. We'll talk more about why that is important coming up next. This is Bloomberg.
This is Bloomberg Daybreak. I'm Ritika Gupta with your Bloomberg Business Flash. The CEO of Boeing predicts that a major U.S. airline will most likely go out of business this year. Dave Calhoun spoke in an interview with NBC News. Air travel has been all but shut down by the coronavirus pandemic. He says something will happen when September comes. That's when the U.S. government's payroll aid to the airline industry ends. PNC Financial Services is cashing out of one of the industry's most lucrative bets ever. It's selling its $17 billion stake in BlackRock. PNC holds 22% of the shares of the world's largest asset manager. The sale will allow the bank to potentially make another major acquisition. And Toyota warns that profit will plunge 80% to a 9-year low. Japan's biggest automaker predicted it could take another year before global car sales return to pre-virus levels. Toyota is caught up in the pandemic that has forced automakers to shut down factories and showrooms. And that's your Bloomberg Business Flash, Alex.
All right, thanks so much, Ritika. So staying of automakers here, they may be taking a hit now, but here in New York City, where most people take public transport, it wasn't really an issue to begin with. But there appears to be some signs of hope now underground. Readership on the subway and commuter trains has actually started to rise. Now, the increase is not much. The total number of daily riders is still just a little more than 200,000. But after that big drop-off in the middle of March, when the coronavirus pandemic took hold, it is a promising signal for many here. I don't know. I think I'd be a little too scared to take the subway just yet, but maybe in a couple weeks. All right, coming up, we're just moments away from the latest read on U.S. inflation. We're going to break down just how far consumer prices have fallen with Mike Schumacher, Wells Fargo Securities head of macro strategy, and take a look at the 10-year auction coming later today, another record amount. This is Bloomberg. Welcome to Bloomberg Daybreak Americas. I'm Alex Steele. We're just a few seconds away from the latest read on inflation here in the U.S. through CPI. Quick check on the markets. It still feels like a cautious rally. Not a lot of conviction, I feel, in the market overall, but you are seeing positive screens for your equity indices for Europe here as well in the U.S. Switch up the board, and it is a weaker dollar story that's sort of reversing in the last few hours. You also still have the bond market, though, going nowhere, despite the fact you had a lot of issuance on the 10-year coming down later on today. So the latest read is out. So this is for April Consumer Price Index on a month-on-month basis. It's down by 0.4%. If you back out food, you back out energy. If you don't, you're down by 0.8%. That was pretty much as expected. On a year-on-year basis, the core, backing out food and energy, you're looking at 1.4%, sequentially lower and also missing estimates. This feels like it echoes a little bit the data that we saw out of China overnight, where you saw continued deflation in the factory sector, but also you had consumer prices there up, but less up than they were before. So all speaking to that just lower inflationary world. Joining me now is Michael McKee, Bloomberg International Economics and Policy Correspondent. Okay, so is this worse than we thought? What's your first take read on this, Mike?
Definitely worse than we thought in terms of the core rate, Alex. This is the lowest core month-over-month reading in the history of the CPI data, which goes back to 1957 when they created that core rate. So a huge drop, 21 basically percent decline in the gasoline index is the largest contributor to the headline drop of 0.8%, and that of course will go away a little bit as oil prices have firmed, but we are really seeing the impact of the shutdown of the economy, because a complete lack of demand has prices falling tremendously. Apparel down 4.7% on the month. Motor vehicle insurance, airline fares down big because nobody is flying at this point. Used cars and trucks were down 0.4 on the month. So a sort of shocking number that the markets are going to totally ignore. The question is, how far do we go into deflation? Right now we're at 0.3% year-over-year rate. We haven't been below zero since 2015, when we had that sort of mini recession brought on by the oil industry contraction. It looks like we're heading that direction. We could probably get there next month if we don't see a big rebound in gasoline prices. The Fed probably going to look through it, though, because they know that anything below zero is going to be temporary. It's really only a question of how far and how fast does it rise back towards the 2%. And you look at the kind of numbers we have here, and you don't think that's going to happen anytime soon.
Yeah, and Mike, I have to wonder, you mentioned that it's the lack of demand. So if demand winds up coming back and there's a big snapback, do we just get to sort of normal prices, or do we have to start talking about inflation? I know you always poo-poo me here and you say, not yet, not yet, not yet. But this kind of data says to me, but when?
Nobody knows, but it's going to be a year or two before you would even have that issue. First of all, oil prices are going to have to rise significantly to really affect the headline. And then you're going to be working off a lot of inventories for a while. If demand were to be V-shaped, then you would see prices start to rise at a more rapid rate. But remember, they weren't rising close to 2% anyway. We were still under it. So the Fed has a lot of cushion, a lot of runway before they have to worry about anything. Now, people point out that the book says you should see inflation with this much stimulus in the economy, but it's going to be down the road some. It's not going to be a story for 2020 and probably not 2021.
Yeah, good point about that inventory. And it looks like the equity market cares a little bit. We now only have equity futures for the S&P up by 0.2%. So off the highs of the session. Want to bring another Mike here, Mike Schumacher, Wells Fargo Securities head of macro strategy. So Mike Schumacher, we saw sort of a worse decline for core as well as overall CPI. What's your take?
Yeah, at this point, I agree with Mike, Alex. The Fed would be thrilled, frankly, if inflation became a problem. Is that going to happen today? No. Later this year, doubtful. Next year, maybe, but that's not today's issue for the Fed or for the policymakers in general.
So, Mike, Schumacher, does this give the Fed actually more cover to do more stuff because they don't have to worry about any sort of big inflationary risk?
They probably weren't too concerned about it to begin with. It really corroborates their view that inflation is going to be subdued for quite some time. So I don't know that it changes the tune at the Fed, but it's just one more data point. So from that standpoint, Alex, their confidence probably increases a little bit.
I got a question for Mike Schumacher here. And, we're looking at housing prices, real estate basically coming to a halt. Housing is a big part of this index. Do we see it start to come back? Do we see prices firm, or are you sort of forecasting that we are going to see prices for housing really weak going forward?
Yeah, a tough call at this point, Mike. You've got these countervailing forces, right? Unemployment, massive number. That's usually an enormous negative for housing. At the same time, mortgages are super cheap. So we suspect over time you'll get some stability, but I wouldn't call for a huge move either way at this point.
Mike Schumacher, I'll pivot off of that also, just sort of when we do get a recovery, which letter do you expect? And I guess a better question going forward is, in what areas do you expect what letter of a recovery? Like, you're going to have a very different scenario in hospitality than you might in manufacturing, which will then also dictate sort of where prices go.
Yeah, the letters are getting interesting, Alex. V, W, now I'm hearing about a swoosh, all kinds of weird things. But our take on it is our economics team initially expected, I think what most people did, a pretty dramatic V, pretty sharp recovery. Now it's likely to be more elongated. The damage on the business side is becoming more clear. You've had a number of bankruptcy filings in the last week or two. If that continues, or probably more likely as that continues, it makes the recovery seem slower. So the market implication is the Fed keeps policy rates super low for a very long time. If you look at the Bloomberg WIRP screen, it's basically flat at this point for really most major economies, and we think it does take a while to dig out.
Alex, I want to point out one thing about this report today, and we've seen this sort of with other data as well. Because so many companies are closed, the Bureau of Labor Statistics, which gathers this data, says that the numbers are not necessarily going to be as accurate as they ordinarily would be because they don't have the same sort of sample size. And I haven't run across any yet, but they do say a small number of indexes normally published will not be this month because they could not collect enough data. They do think it's statistically reliable, but you're going to have a much wider error band around the prices if you're looking at anything in particular.
That's a really good point. We have to remember that when we break all the data sort of going forward, really. Let's move to what the Fed's doing today, Michael Schumacher, and that is buying corporate bonds ETF for the first time. Two questions for you. One is, how much is the Fed going to buy now, considering that they've already done so much by just saying that they're going to be buying? And how long and how much do you think they wind up buying for the next few months, Schumacher?
Yeah, too many mics. I actually played on a softball team one time called Lotta Mics. We could probably invoke that here. But as far as the Fed goes and corporate,
it's
amazing, Alex. Yeah, it's interesting, right? Too many mics for sure. But the Fed's corporate activities, it's worked out perfectly. I mean, you heard years ago the talk about a bazooka. Simply, if you mentioned you would do this, you didn't really have to follow through. And that's what's worked out for the Fed and corporate bonds so far. So we don't have a firm forecast in terms of X number of billion this week or next week or 2 weeks out. But I suspect as long as the Fed is in on a fairly steady rate, the market will probably accept that as really good faith evidence the Fed will follow through. So the corporate program seems like it's working like a champ right now for the Fed.
Do you expect, though, that they need to get in there? If you've already seen sort of investors front run them and say, like, oh, what ETFs are they going to buy? Let me go buy them. Corporate borrowing costs have not fallen, but they've actually opened. You can actually access the market even if you are paying a higher yield. Do they need to be in it specifically?
Oh, yes. I want to be clear about that, Alex. We do think the Fed needs to be in it. In fact, we thought the Fed would have come in sooner than it has. So waiting until May 12th is a little bit late, but at least the Fed is getting in. If it waited a few more weeks, I suspect the market would start to smell something a little bit funny and might be a bit more concerned whether the Fed would actually follow through. So, yeah, it's important for the Fed to be in. The exact size is less critical at this point.
Mike, I was going to ask one last question here. I was just discussing this off camera with Anne-Marie Horton, who was reporting on oil for us. What is the impact going to be when we come back of oil on the economy and on prices? Because there's going to be a real question about what demand is going to be. At the same time, you have an area where there's a non-COVID supply overhang.
Yeah, the oil story has been incredible, Mike, and it's got so many facets. So you've got the Saudi oil war, if you will, coming in at the same time of the COVID-induced economic slowdown, and it's been very, very tough to read on that standpoint. We've seen big damage on the equity side, obviously a lot of concentration in the energy sector. But as far as what it means for the broader markets, I would say that if oil is somewhat stable, let's say plus or minus $5 in WTI, you probably don't see a massive impact on the bond market, or in risk assets in general. But if people get the sense that oil is gapping down or maybe up someday, that has a pretty big impact on treasuries and equities and follows through. So at this point, I would liken it to your point about economic data. People figure there's a lot of noise in the markets, a lot of noise in the data. They can tolerate some of that, but outside of that band, to call it $5, there's nervousness.
And last question for you, Michael Schumacher. The supply today coming online, $35 billion of 10-year notes. Good opportunity to buy or what?
No, we think it's not a good opportunity to buy, Alex. We think that yields are going up, and it's pretty tough to really make an appealing case to buy a 10-year Treasury yielding 72 basis points. That doesn't seem like your phenomenal long-term investment. But we look at it and say a lot of investors have to buy, whether it's people coming in from overseas or institutional investors. So the supply probably gets absorbed pretty well, but our view on yields is to go up dramatically between now and year end. We've got the 10-year Treasury well above 1% at the end of the year, for instance.
All right, Mike Schumacher, appreciate it, of Wells Fargo Securities and Bloomberg's Michael McKee, thank you very much for helping me break down that data. For the quick recap, CPI on a year-on-year basis core is 1.4%, so sequentially down a lot and missing estimates. We do want to give you an update now. It's making headlines outside the business world. Here is Ritika Gupta with First Word News. Ritika?
Thanks, Alex. A stern warning from Dr. Anthony Fauci, the U.S. infectious disease chief, will tell the Senate today the country risks needless suffering and death if the economy reopens too soon. That's according to the New York Times. Fauci says there's a chance of more outbreaks if states reopen without following White House guidelines. In Wuhan, China, all 11 million residents will be tested for coronavirus. The city where the pandemic began has reported new infections for the first time since its lockdown was lifted. 6 locally transmitted cases were found in people already under quarantine. The Federal Reserve is launching its long-awaited backstop for companies today. It will begin buying ETFs invested in corporate debt. The program was announced in March, and it's played an important role in keeping financial markets relatively calm since then. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex?
All right, thanks so much, Ritika. So coming up, keeping Main Street afloat. We're going to take a look at community banks that are lending to mom and pop companies. We'll break it down with Frank Sorrentino, Connect One Bank CEO, in today's Bottom Line. And Bloomberg users, go ahead and interact with our charts. Check them out. GTV Go on your terminal. All the charts we use throughout the 2 hours at GTV Go. This is Bloomberg. All right, time now for Bottom Line. We focus on companies or sectors worth watching this morning, and today we're going to focus on community banks. In the latest NFIB data, the sales expectations for the next 6 months plummeted 30 points in April, all the way to minus 42. That's the lowest in the group's monthly data all the way back to 1986. Clearly a big need for some of these businesses to get some loans. So let's talk to someone behind a lot of those loans. Joining me now is Frank Sorrentino, Connect One Bank CEO. Frank, great to have you on the program. Give me some perspective of how much you've loaned out under the payroll protection plan from the government.
Good morning, Alex. How are you? Great to be back. And certainly Connect One was a major player in this PPP program for the benefit of our clients and also for our communities. In round one, we lent approximately $400 million to approximately 1,300 businesses in our local communities.
And what is demand like now versus, say, just even a few weeks ago? Give me a perspective of the types of businesses coming to you and the trajectory.
So there was a very large run-up, in the very beginning with the first phase of the program. There were businesses of all sizes from everywhere trying to get through the door. There was this constant fear that the dollars would run out, and we saw a lot of large dollar volume loans as well as smaller ones. As we moved into phase two, we're now seeing that it's mostly smaller dollar loans to very small businesses in our communities, and the volume of that has slowed down somewhat dramatically. So we think the vast majority went out in phase one, and phase two is definitely slowed.
There are some criticisms surrounding the fact that because you can only put the majority of it towards payrolls, that some small businesses in need aren't accessing it because need it for things like other overhead and rent, etc. There seems to still be a lot of confusion of small businesses if they'd even be eligible for it. Are you hearing any of that on the ground as an explanation for why demand's slow to touch?
We're definitely hearing it. I would say the vast majority of the larger borrowers, many of them are actually repaying their loans. We're actually seeing that. And I think there's a lot of confusion relative to the various programs that are out there. You have competition between this PPP program, whether or not companies are able to reopen their doors, the unemployment benefits that employees are getting that is competing with whether or not companies should pay their employees. So I really think that all of this needs to be settled out. There are a number of bills that are moving their way through Congress right now to modify the program to allow for small businesses to change that percentage you mentioned, that 75-25 percentage, as well as allow companies to utilize these funds for a longer period of time. I think it's unfortunate that that 8-week line in the sand was drawn when the program was first initiated. It's very hard to spend the dollars that you're getting through the program if your business is being mandated to be closed. And I don't think that's what the intention of the program was.
So as the House Democrats in particular are working towards a next stimulus package, and a lot of that's going to be for state and local governments, but if there was another sort of more money for the small business program, what would need to be in it? What would you want to see to help you facilitate faster, better loans to your customers?
Well, I don't think it's a question of faster or better, right? The program was announced on April 3rd initially, and by the second week of April, money was already going out the doors. You know, Connect One was one of the first banks to make one of those PPP loans. So I don't think it's speed that's the issue here, and I'm not even sure that it's the volume of what's out there. The second phase of the program, which had $310 billion allocated, is only up to about $175 or $180 billion as we sit here today after 2 weeks. So I don't think either of those issues are what's the problem now. I think business needs to reopen so that they can actually utilize the funds. I think that's what they should be focused on right now. Let's not focus anymore on what else does business need other than to be open in order to utilize the benefits that are being provided.
In your first quarter, you sort of laid out the loan loss provisions that you were looking at and the areas that you were exposed to. Going forward, like taxi medallion loans, for example, going forward, what are the areas that are most risky for you, that you're most concerned about defaults or just not repaid at all?
You know, Alex, it's very difficult sitting here today to make determinations about the future and what part of the portfolio is mostly at risk. There are the obvious candidates, the businesses that are completely closed: restaurants, hotels, casinos, bars, salons. Those things clearly present a high level of risk, and we outlined in our, in our research that we had very low exposure to a lot of those industries. But looking forward at the general economy, until we know a date when businesses will be back on and how much damage was really done and how consumers will change how they do business in the future, it's going to be difficult for banks to assess the actual risk that they have in their portfolios. And I think most banks took a more conservative approach in this first quarter.
Yeah, and I feel like it's going to be a similar answer to this next question that I'm going to ask you, but how are you thinking about retooling your workforce, your branches, i.e. spending more on tech, maybe less on your physical footprint, et cetera? How are you looking at reshaping your business because of this?
You know, it's funny. I think that we are looking at it the way we looked at it even before the COVID virus, right? We were looking to provide digital channels for our clients to be able to access in a better and more efficient way. We are one of the most efficient banks in the country with one of the lowest efficiency ratios, and a lot of that comes from our utilization of technology and digital tools. And I think businesses across the country are going to have to adapt to different ways of doing business. And I think all that the COVID virus did was reinforce that these things were coming anyway, and that businesses were changing anyway. We saw that in the taxi business. We saw it in the hotel business. We even saw it to a certain extent in the food business with fast casual and other types of opportunities. So I think this has just been an acceleration of trends that were already in play prior to this. And we've been on the forefront of that here at Connect One Bank.
So does that mean that you're not anticipating any sort of layoffs and, say, rehiring in the tech field, for example, or you're just going to continue?
We were making hires in those areas, and we had one of the smallest branch footprints of any community bank in the nation. So, yeah, I think that what we were doing before will continue in the future. We may be doing a little bit more of it. I think our clients have now become more accustomed to interfacing with the bank in a more digital fashion, and so we'll put more effort behind that as well.
And then last question, this is a conversation that's percolating within the political sphere, is that the amount of debt and stimulus that we're seeing in the market is going to have to be paid for by higher taxes on the wealthy and on corporations. Are you preparing or thinking about at all a higher corporate tax rate come 2021?
It's hard to assess today whether or not and what the slope of our growth curve is going to be, right? Because the two ways you pay this back: one, higher growth, and two, higher taxes. Higher taxes today would only enhance the depressive effects that are in the economy. And so I don't think that that's something we're going to be dealing with in the next year or two. But certainly, as we look out a little bit further, some of that incentive is going to have to be paid.
All right, Frank, thanks a lot. Really appreciate it. Frank Sorrentino, Connect One Bank CEO. This is Bloomberg. right, that does it for me here at Bloomberg Daybreak Americas. Coming up on the Open with John Farrow, Megan Green, Harvard Kennedy School Senior Fellow will be joining him as to recap consumer price inflation in the U.S. for April, coming in much lower than estimated, just 1.4% for the core. The deflationary scenario continues to take hold. This is Bloomberg.
From New York City for our audience worldwide, good morning, good morning. The countdown to the Open starts right now. 30 minutes away from the open and bow. Your Tuesday morning price action shaping up as follows. Equities positive. In the last couple of hours, a real lift. Your S&P 500 looking like this. We advance by 12 points on the S&P, up by 0.4%. In the bond market, inflation coming in soft. Yields not doing much at all. 0.71% is your yield on a US 10-year. And a quick snapshot of foreign exchange. G10 stronger against the weaker dollar. Euro dollar advancing by 0.4%. From New York City this morning, good morning to you all. Let's start with our top story. The President of the United States looking to get this economy back open for business.
Of our citizens and our aggressive strategy, hundreds of thousands of lives have been saved. In every generation, through every challenge and hardship and danger, America has risen to the task. We have met the moment, and we have prevailed.
The President of the United States says he's met the moment, looking to reopen this economy, albeit reopen it safely. A little bit later this morning, Dr. Fauci at 10 a.m. Eastern Time will testify to the Senate, and he's set to add some caution to that, telling the New York Times the following: if we skip over the checkpoints and the guidelines to open America again, then we risk the danger of multiple outbreaks throughout the country. This will not only result in needless suffering and death, but would actually set us back on our quest to return to normal. Kevin Cerulli joining us from Washington, D.C. Kevin, you know, I'm not one to look for division and tension where there isn't any. But on this particular issue, I wonder if there is.
There's a ton of division, especially from the political sense. Look, Dr. Anthony Fauci set to testify before the Senate at a virtual hearing. He's going to face a receptive audience from Democrats who are also going to echo his warnings about reopening the economy too soon and the health impact and the lives impact that could have. Meanwhile, Republicans expected to question him for precisely how he's getting his data and trying to weigh the economic cost with the health impact. Meanwhile, the president, for his part, scheduled to be heading to Allentown, Pennsylvania on the second half of this week. This is at least the second trip that he's taken previously to Arizona in a battleground state for the 2020 presidential election. Look for him not to hold a Make America Great Again rally, but to tour a plant, a manufacturing plant. And that's the crux of the political coalition that he needs to put together. Divide on the economic, political, policy sense as where that stands, but a growing consensus, at least in a conversational sense, about where foreign policy stands on U.S.-China relations. The president yesterday at a marathon press conference covering a wide range of topics, but also saying quite pointedly that he has no intentions of restarting U.S.-China trade talks in the short term. Jonathan?
Kevin, thank you. A topic of discussion for later in this program, that tension between the United States and China flaring up again. I think we're all willing to accept that is exactly what has happened over the last couple of weeks. Overnight, more news coming out of China. Wuhan, several cases of viruses. Are we facing another wave? That's a critical issue at this point. The city looking to test all 11 million people in that city of Wuhan. I know a lot of you are keenly watching what happens there for the latest developments. For this economy, the risk of a second wave of infections is something people are concerned about before we even start reopening the US economy. What does that mean for business and consumer confidence in the months to come, and how on earth do you model any kind of forecast about the future with that in mind? To discuss, I'm pleased to say we're joined by Megan Green of the Harvard Kennedy School. Megan, let's just start there, shall we? Modeling the future with the risk of a second wave of infections, a discussion we're having before we even get this economy reopened.
Yeah, look, I mean, there's no line in our macro forecasting models for a pandemic to begin with, let alone a second wave. So, even before you consider a second wave, the Bloomberg survey professional forecasters show that, the range for Q2 growth is from growth of 0.4% to a contraction of 65%. I've never seen a range like that. So that's before a second wave. If you add in a second wave, we know for sure that it will have negative implications on the economy, but we can't really guess how big they will be. I will say that most of the arguments put forward for why it's economically savvy to reopen the economy sooner than later ignores the fact that, there is a cost to, a spike in deaths. There's a huge cost to shutting down the economy again, and so that's often not included in the argument.
Megan, I caught up with the administration on this very issue about what would happen if we had another wave of infections and whether we risked another shutdown. Take a listen to what the National Economic Council Director, Larry Kudlow, had to say to that question.
I asked this person what happens if you get a jump back up in the virus numbers, and the response was simply, look, we won't have to re-shut down because, first of all, we know more, we have more experience, and second of all, we are much better equipped with the right tools.
Larry Kudlow there, National Economic Council Director. Megan, I think he does make a good point that we have more experience. We've built out capacity where we need to build out capacity on the healthcare side of things. From where you stand and from the research that you do, does another wave of infections necessarily have to lead to another shutdown?
Well, we know that extreme social distancing and shutdowns address a spike in new waves. I think that's the information that we have. And so I do think that if it obviously depends on how big the spike is. But it all comes down to the effective reproduction number. And if it moves to over 1, then we know that this virus will spread exponentially. And that could overwhelm health services, even though we beef them up pretty quickly. So I do think that we would end up having to have some kind of shutdown, but more importantly probably is what it would do to confidence, right? So, even if you opened up the economy tomorrow, it's unclear that people would actually go out to restaurants. I wouldn't get on a plane and go on holiday. I'd be suspicious. And if you end up having these spikes in new cases, let alone new lockdowns, I think that will really undermine confidence and it will take even longer for people to eventually get to some semblance of normal.
And Megan, in the meantime, what do we see in the market? We see a market that keeps grinding higher. And a question that I keep getting, and I'm sure you do too, why the divide between the economy and markets? We don't question the premise of that question. Is there a divide as far as you can see? On the surface level, it looks like there is a clear divide, Megan, between ugly economic data and a market that is shifting higher. But let's talk about what is moving higher in this market. What explains it for you?
Yeah, I think you're right. Most clients constantly ask me this, but they ask why the markets are pricing in a V-shaped recovery. And I don't actually think that's what market pricing is reflecting at all. I think there are a bunch of other reasons that the markets are grinding higher. One is to do with positioning. So as investors have to cover their shorts, that pushes the index up, so it provides a tailwind for equities. It also is down to the composition. So if you look at who's actually really rallying, it's sort of the FANGs and Microsoft and then healthcare. And actually, it makes rational sense that investors would bet that those companies would do reasonably well off the back of a pandemic. And I also think that behind the equity rally is a bet on the Fed, right? So, the message has been that the Fed will come in, buy up corporate debt, will have investors' backs. And so it's no coincidence that, the day after the Fed announced it would buy corporate debt is when the market rally began. So I think, investors are channeling don't fight the Fed. And also, where else are investors really going to put their money? If you are a safe haven investor and want to hold U.S. dollar-denominated assets, you can buy up treasuries, but you won't get much. You won't earn much if you do that. So arguably, equities are a better investment, will get you better returns.
Megan, I wanted to turn to the Fed to wrap up the conversation with you. We have seen a ton of issuance on the credit side in anticipation of the buying that the Fed will start doing today. We have had record monthly issuance in March, in April, and we're set to get it again in the month of May as well. The announcement effect has been absolutely incredible, even Chairman Powell acknowledging that. What does that mean for this Federal Reserve as they step in today? How much buying will they actually have to do?
So right now, I'm not convinced the Fed will have to do much buying at all because, as you say, just the announcement has compressed spreads enough, given companies that were in trouble access to the debt markets. But that being said, we're just at the beginning of this credit cycle, I think. We've only had a few companies go ahead and announce that they were filing for bankruptcy or thinking about it, and I think there's a lot more to follow. So I think investors are pretty complacent, actually, about corporate debt because the Fed has said it will come in and buy it. But I do think that this will be a significant credit cycle. And the Fed buying up debt helps if you think there's a liquidity problem. But if there's a solvency issue, then actually the Fed buying up debt doesn't help much at all. And I think that a bunch of zombie firms are solvency issues, not liquidity issues, and that will come out in the wash. And so the Fed will probably have to step in and buy more to calm markets.
Megan, that is the key issue. Megan Green, always great to catch up with you. I hope you're doing well. Up next on the programme, we'll continue this conversation. The Fed finally stepping in. It's announced that it would be buying corporate debt. Later today, it will actually be buying it. Corporate debt ETFs on sale for the Federal Reserve for the first time ever. That conversation with Jim Caron and Morgan Stanley coming up very shortly. There is a huge pile of downside risk in this market. Where do you want to start? The the tension between the United States and China, more infections in economies like Wuhan and elsewhere, and yet still this equity market keeps climbing. Up 10 points on the S&P 500. We advanced by 0.4% in the last 24 hours, led by the usual suspects. If you doubted the dominance of mega cap stocks, well, apparently they just keep on moving. What will stop them? A discussion for later on in this program. From New York, this is Bloomberg.
Order submitted. Order submitted. Order submitted. Order submitted. Order submitted. Order submitted.
I'd be pretty astonished if they went negative, with the danger that it would panic people and scare businesses and cause untold chaos in the banking system. It's completely unnecessary. They've also made the argument many times, several officials, that they can control the yield curve with much more confidence than markets perhaps believe.
Ian Shepperton of Pantheon Macroeconomics in the last 24 hours, weighing in on the great negative rate debate over at the Federal Reserve. Many Fed officials pushing back against this, and we're likely to hear the same from Chairman Powell tomorrow morning, 9 Eastern, when we hear from the chairman himself. It will be interesting to see how he responds to that question if he's asked about it. No sign from the core players at the Federal Reserve that it's something they would even consider at this point. That's the rate debate. Let's talk about the asset purchase side of things over at the Federal Reserve. Wow, did this Fed have a huge effect on this market without doing anything at all? All it had to say was that it would be willing to buy corporate debt ETFs and corporate debt securities. And what happened? The announcement effect was absolutely phenomenal. Spreads tightened aggressively, and the buying started, and the supply came to match it and more some. We had significant amount of issuance in March, April, and again to start the month of May. Just how much will the Fed need to follow up? Can they match what they've already achieved when the buying starts a little bit later? I want to start that conversation with Jim Karen of Morgan Stanley, who joins us on the phone. Jim, it's actually a significant day. We've had a huge rally in corporate debt. We've had a huge amount of supply, and largely because the Fed said it would step in. Today, it actually steps in. What kind of size do you expect to see, Jim?
Well, I think the size is whatever it takes. And effectively, the way that we look at this is, and we've discussed this before on your show, it's a question of liquidity and solvency. So we're right at the point right now where the Fed is addressing solvency issues. So has there been a lot of corporate supply over the past couple of months? Absolutely, there's been a lot of supply over the past couple of months. Now, that has to be met by buying. To some extent, the private sector is happy to buy yield, but they're worried about the virus and the solvency issues, and they're not so sure. But then the Fed, as you pointed out, if they come in and backstop it and they push these yields tighter and lower, they end up forcing in the private sector to also chase these returns. Is really what many of the investors are really chasing, is the returns. And the question is exactly as you put it. If the Fed is going to come in and buy in the corporate sector, are they going to be big enough to keep these spreads relatively tight? So what is that size? We don't know specifically, but it's whatever it takes, because their goal is to get these spreads tighter so that way corporations have the ability to have access to liquidity, and more importantly, they can fund themselves, they can refund themselves over this pandemic so that solvency does not become as big of an issue. And this is the monetary policy reaction function that the Fed is actually invoking right now, in terms of making sure that corporations don't lose access to funding and don't have solvency issues. They don't want to have a liquidity problem turn into a solvency problem. And this is where we are today. And I'm not going to say if that's right or wrong. All I'm going to say is that this is what they're doing, and you don't want to be on the wrong side of this trade.
Well, Jim, let's talk about the liquidity side of things. They've done a tremendous amount there. They can address that issue, and I would argue that they have done. We saw spreads blow out aggressively. We saw them come in aggressively. But over the last 2 weeks, spreads have done a whole lot of nothing, particularly in high yield. They can do something about liquidity, but they can't get rid of credit risk, can they, Jim?
No, they can't. And you brought up the high yield market. The high yield market is a different animal from the investment grade market. The investment grade market is where there is some explicit support in terms of these purchase programs and buying investment grade debt. So the issue here is, we use a phrase within our group at Morgan Stanley Investment Management, which is which assets are inside the tent and which assets are outside of the tent. Most of high yield is outside of the tent, meaning that they are not going to get the full explicit support from the Fed. But as far as the investment grade bonds, if you just look at the all-in yield of these bonds, yes, spreads are wide, but if you look at the all-in yield of these bonds, they're about the same level as they were pre-pandemic crisis in the financial markets. So bond issuers, corporations, are still able to access the markets even today at yield levels almost similar to where they were prior to the pandemic. That's not true for everybody, but broadly speaking, at the index level, that's where the all-in yield is for corporate borrowers to borrow. And they need to have access to low yields in order to make sure that their debt is affordable so that they can be sustainable into the future. And this is a whole issue of solvency.
I think the real risk for a lot of people, and I know it's very cliche, Jim, but I'm sure it's something many people are thinking about, is whether this does become a sound the news event, that the Fed starts buying and people start backing away. Can you speak to that?
Yeah, I can, and I think you're right. I think that there is a healthy dose of skepticism here, and there always is whenever one of these programs start, because they come in and say, look, we're going to buy, and the market wants to
Order
really say,
filled.
well,
Order
let's see.
submitted.
Let's see what you
Order
do.
submitted.
So what's really going to be important is not just today what they do, but if the Fed doesn't get the reaction that they want, do they come in twice as big tomorrow, and do they come in even bigger the day after that? And at some point, you start to remember rule number one, which is don't fight the Fed. And we can argue all day long whether these levels are correct for the markets. And I'm not going to argue whether this is morally correct, this creates a moral hazard issue or not. All I'm trying to reflect is that this is what the Fed is actually doing. And they have a lot of purchase power here. You may not want to be on the wrong side of this.
Hey, Jim, granted, I had that conversation in Europe for the best part of a decade, and I think everyone was left frustrated looking at these yields just grind tighter and tighter and tighter. Right. What we have seen from the Fed, though, is taper their purchases over the last several weeks of treasuries, and we're about to see a huge amount of supply. Question I've been asking, Jim, we'd love your input on it, is whether we're starting to see a few signs of indigestion. Massive supply on the treasury side, on the credit side as well. Any signs for you of that indigestion at the moment?
Yeah, a little bit, and you're right. I mean, the amount of supply that's coming into the markets is absolutely huge, whether it's on the corporate side or on the U.S. Treasury side. So we are starting to see 10-year yields start to tip up about, to 72 basis points right now. I think the range in 10-year Treasury yields where the Fed is okay is between 50 basis points and 1%. I think that as long as we're below 1%, I would argue that the monetary policy transmission mechanism, and when I say that, what I mean is the ability for the Fed to push rates lower, particularly 10 years and in. And this is also very, very critical because most of the corporate issuance, most of the refinancing that needs to be done is going to be done 10 years and in. So those rates need to be down. Beyond 10 years, when you start to look at the 30-year bond, the 30-year bond can become dislocated. The yield curve can steepen a bit, 2s, 30s, 10s, 30s, which is certainly happening. But the 10-year and in maturities, those yields need to be kept low for the Fed's models for what they call their monetary policy transmission mechanism to actually work and keep these rates low so that corporates have the ability to access the markets at an affordable rate and not have to pay a lot to stave off solvency concerns.
Jim, just one final question for me on negative interest rates in the front end of the curve. Quite clearly, at the front end, you can have rates turn negative even if the policy rate doesn't go negative. Let's talk about the policy rate. There's been a massive discussion over the last week about whether the Fed would take it there. No indication whatsoever for me that that's the direction of travel. The St. Louis Fed President Jim Bullard right now saying negative rates are not a good option for the United States. Do you think Chairman Powell just puts this debate to bed tomorrow morning, just draws a line under it and says no chance?
I think that's what he does. I mean, look, this goes into structural issues, even with money market funds, prime funds, money market funds that can't go below, break the buck, as we say, go below $1. Essentially, if you start to have negative interest rates, you have to start to relook at Dodd-Frank, and you have to look at a lot of different legalities and structural parts of the markets to say, yes, if we go to negative rates, well, then that's going to clearly impact money markets. This is not helpful in any way, shape, or form. It hasn't been helpful in Europe. I don't know why it would be helpful here. I think the Fed would do yield curve control before they did negative interest rates, and I don't even think they want to do yield curve control, to be very honest with you. So negative rates is something that is way, way off. I'll never say never, but let's say I think Powell tries to put this one to bed.
I agree with you, but don't underestimate the stupidity of policymakers sometimes. We've been talking about Europe and negative rates for a long time and the negative implications, and they just kept going negative. Jim, I'll let you go before I get in more trouble. Jim Caron there of Morgan Stanley on this fixed income market. As Jim Bullard of the St. Louis Fed rules out negative interest rates, Chairman Powell talks tomorrow morning, 9 Eastern. We'll bring you some coverage of those headlines right here on Bloomberg TV. In your market, 7 minutes away from the opening bell with equity futures higher by 12 points, up by 0.4%. From New York this morning, good morning. This is Bloomberg. 5 minutes away from the opening bell in New York City, your Tuesday morning price action shaping up as follows. Up 13 points on the S&P 500. We advance a little more than 0.4% ahead of the opening bell. Let's get you some morning calls, some of the views from Wall Street, from the analyst community at least. Here's your first call from Wedbush, raising its Apple price target up to $350 a share. The analyst expecting robust demand for the next iPhone, with the coronavirus limiting recent upgrades. We'll catch up with Dan Ives, no doubt, in the next couple of weeks. Your second call from UBS, downgrading Chevron to neutral, a $95 price target. The analyst citing valuation following the stock's 70% rally from its March low. And your third and final call from us this morning from Bank of America, downgrading Stanley Black & Decker to neutral with a 120 price target. The analyst expecting shares to be range-bound due to margin and growth headwinds. There are three of the calls from the street. Up next, the opening bell with futures positive. Our big debate coming up just around the corner. Just how long can the leadership remain this narrow? From New York, this is Bloomberg.
Order submitted. Order submitted. Order filled. Order filled. Order canceled. 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 Order canceled.
"25 seconds away from the opening bell in New York City this Tuesday morning, following a day of gains and I emphasize just grinding out a day of gains on the S&P 500. The leadership coming from the usual suspects, tech and healthcare. In this morning's session, equity futures up by 12 points. We advanced by 0.4%. If you switch up the board in the bond market, a ton of issuance coming your way from the Treasury, a 10-year issue coming a little bit later today. Your yield's higher by a single basis point off the back of some pretty dreadful CPI data coming in really, really soft. In foreign exchange, to round things out for you, Chair Powell tomorrow will be the focus focus right now. The dollar weaker against the whole of G10. Euro dollar advancing 0.6%. That's your cross-asset price action. Let's get to the market desk and get you some movers. Here is Taylor Riggs.
Hey, John, of course, as you just mentioned, it has always been about big tech, not only yesterday, but really in the past few weeks. This theme of big tech's big outperformance relative to some of the other major averages. We're looking there, as you can see, big tech's outperformance in Nasdaq 100 relative to the Dow. That outperformance now the most since 2000. On one hand, the Dow, of course, being hurt by a lot of the industrial and transportation companies that are more susceptible in this downturn. But on the other hand, it really importantly shows the strength and the resiliency of the tech sector. As we know, the Nasdaq is in positive territory for the year in less than 5% from its record highs. Flipping up the board again, some individual movers that we're looking at on a year-to-date basis. This is not surprising. The companies that are outperforming are the things that we're using. Zoom, video communications up 145% year-to-date. Tesla saying that they want to reopen, they want to get back to work. And Regeneron Pharmaceuticals, one of the big outperformers, is biotech, big pharma. Really the big focus here on all of those companies within the pandemic. On the losing side, also not surprising as well, industrials like Boeing and Dow. Even JP Morgan, John, will highlight heavy exposure to the consumer. Also, one of the worst performers is really the strength of this recovery, and the worriness about the consumer also really here still much in focus, John.
Taylor Riggs, thank you very much. We'll catch up with Taylor a little bit later in the day. Around about 2 minutes into the session, here's your equity market advancing 0.5% on the S&P 500. Outperformance coming from, guess where? The Nasdaq up 0.6%. Abigail Doolittle will bring you the sector composition a little bit later. Ton of Southside research over the last few weeks, and I have to congratulate the Southside. Some fantastic talking points. Everyone churning out their thoughts and ideas about a really complex time and a complex market as well. Much more difficult than it looks on the surface of things, I think. Here's the take from Goldman, the following quote. They say the following: a single catalyst may not spark a pullback, but a number of concerns and risks exist that we believe, and our client discussions confirm, investors are downplaying. The fear of missing out best describes the thought process. Skepticism abounds regarding the likelihood the rally will continue. On this topic, Emily Rowland of Jan Hancock. Great to catch up with you, Emily. Let's start there. The limits to this rally, your response.
Yeah, great to be here, John. And I think it really is all about the FOMO trade, or the fear of missing out right now. And we've seen this huge kind of whipsaw as far as sentiment goes. And we like to juxtapose that just on where the flows have gone. We've actually seen over $1.2 trillion go into money market funds over the past year. And investors are just sitting on this huge pile of cash on the sidelines right now, and they're looking to get back in as we see this market just continue to rally. Nothing can stop it. And it's almost, we sort of picture investors kind of standing on the side of a highway, right? They're looking at how fast markets are moving. They don't really know quite where they can find an opening. They know they can get hurt, but they're just going for it. And that's really what we're seeing today in terms of this sentiment pushing risk assets higher and higher each day.
Well, Emily, let's talk about where they are stepping in and going for it, because I think it would be a mistake to sit here that we're seeing signs of this huge cyclical rally, people pricing in a much better future. I don't see confirmation of that in rates. Treasury yields are still low. We've seen some steepening in the last week, but largely off the back of the extra issuance. I don't see that with financials picking up, industrials picking up. What I see at the moment, a Treasury yields rock bottom, a Fed that's going to have to keep rates low for a whole lot longer. I look in the equity market and I see the usual suspects winning, largely for secular reasons, tech, and healthcare for very obvious reasons. Do you see signs of a market and investors getting away from themselves and reality, pricing in a cyclical pickup that isn't going to come?
Yeah, you're right. And I thought your tweet on this was spot on yesterday. You don't see this kind of resounding bounce out of the cyclical parts of the market this time. Normally coming out of a recession, or when the economy's bottoming, you see areas like industrials and energy and materials really responding to that, and we're not seeing that. The leadership clearly has shifted here. Tech is positive year to date. We're seeing areas like healthcare.
Order submitted. Order submitted. Order submitted.
Services.
Order
Those are
submitted.
all areas that
Order
we've actually
submitted.
been overweight
Order submitted.
at John Hancock Investment Management, and we've identified this tailwind for these strong secular businesses with good balance sheets. And I'm not saying they're completely immune to the coronavirus and the challenges there, and technology certainly is interconnected in global supply chains, and that can cause an issue. But what we're saying is that they're simply better equipped to weather the storm. You think about something like communication services, which is an overweight for us. 2020 in our view is going to be, looked back at on the year of the screen time. Certainly that is absolutely the case in my house with 2 elementary school kids here. But we also look at earnings estimates. They're lower than they are for technology within communication services. And we think that bar can actually be beat. So we are leaning into those sectors, healthcare, consumer staples, other parts of the market where we just see more durability to the top line. And they were in better position coming into this. So we do prefer those quality growth sectors over those more kind of traditional or classically cyclical sectors, which tend to lead historically.
Just looking at the screen right now with the Nasdaq up for a 7th day, the highest since February 25th. Emily, I'm always thinking about what's the right question to ask in a moment like this. And if you don't think we're going to see a rotation to the more cyclical parts of this market, if you don't expect a pickup there, I guess the right question to be asking you is the limits to narrow leadership. What are they? Are there any physical limits to leadership remaining this narrow?
I mean, we're definitely getting to kind of, tech bubble levels in terms of leadership that we've seen over these big, in these big names. And I think it just calls to, remind us all of the importance of diversification. And we have advocated for a participation and protection strategy where, look, we don't want to fight the Fed. My former colleague, Megan Green, talked about that this morning. We want to be invested in this market, but we want to do it with a risk management mindset. There's been a lot of ink spilled about sort of the death of the 60-40 portfolio. We think it's alive and well. We think you need to own fixed income as a ballast of a portfolio here. And what really concerns us, going back to this incredible amount of money going into cash and money market funds, is it's just an inefficient asset class at this level. So looking to take a measured amount of risk within fixed income, investment grade corporates are really the sweet spot in our view, and balance that with a quality growth approach to equities with a little bit of value in case markets do rip higher. That's really where we want to be. Balance is beautiful right now.
Emily Rowland of Jan Hancock. Emily, great to catch up with you. Send my best to the family and the best to the kids as well. Great to catch up with you. In this market right now, 8 minutes into this session, as we are having that discussion, the Nasdaq gives up those gains and turns negative. The S&P 500 up by just 0.1%. Kaylee Lyons has some movers for you. Hey, Kaylee.
John, let's kick it off with PNC and BlackRock. PNC is actually down a few tenths of a percent now, giving up its pre-market gains. BlackRock, for its part, lower by about 5 full percentage points after PNC said it's cashing out its $17 billion, 22% stake in BlackRock that they've held since 1995. That stake made up 15.4% of PNC's profit last year, but Raymond James saying today, this is a sign of the times. It's bolstering PNC's capital levels, potentially allowing them to pursue an acquisition in this difficult environment. And I want to point out Novavax, too, absolutely skyrocketing this morning, up 60% and at a fresh record high, all about optimism around its COVID-19 vaccine candidate. The company has gotten $388 million in funding from the Coalition for Epidemic Preparedness Innovations. It'll use that money to ramp up manufacturing, hopefully to 100 million doses by year end. And finally, we have to talk about Tesla, John. Of course, the drama continuing out in California. Elon Musk shucking the law, saying, I'm reopening my factory. He did so yesterday. He tweeted that it went great, and he may be messing with the law, John, but Tesla investors do not seem to mind. That stock is up about 2% in early trading, John.
I might not be popular for saying this, but I've kind of given up talking about Tesla for a whole load of reasons. Kaylee, great to catch up with you. Kaylee Lyons, thank you very much. I'll leave that there. 9 minutes into the session, equities up 0.2% on the S&P 500. Your Nasdaq dead flat. Up next on this program, we take the conversation to Washington to cover two big issues: the tension between the United States and China, and a focus on one thing, not trade, but financial decoupling, and then the path forward for the next stimulus package. Democrats trying to lead the charge. Will the Republicans come with them? I've said many, many times on this program, I've been terrifically impressed by how well Secretary Mnuchin has worked with the other side. Will that continue down in Washington? That's our question covered up next. 10 minutes into this session, equities up by 0.2% on the S&P 500. From New York City this morning, good morning. This is Bloomberg.
Order filled. Order submitted. Order submitted. 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 Order filled. Order filled. Order filled. Order canceled. Order canceled. Order canceled. Order filled. Order filled. Order filled.
12 minutes
Order
into the session
canceled.
in New York City.
Order
Let's get you some
canceled.
price action,
Order
shall we?
canceled.
We pick up just a little bit, up by a third of 1% on the S&P 500, positive 0.2% on the Nasdaq. I'm out of retirement. It lasted around about 3 minutes. We're covering Tesla again. I know. The President of the United States tweeting in the last minute or so, California should let Tesla and Elon Musk open a plant now. It can be done fast and safely. I'm sure a lot more people will cover that for you through the day right here on Bloomberg Television. Plenty more coverage on that coming up. The President of the United States also addressing trade in the last 24 hours and that trade relationship with China. Take a listen to what he had to say.
We signed a deal. I had heard that too. They'd like to reopen the trade talk to make it a better deal for them. China's been taking advantage of the United States for many, many years, for decades, because we had people at this position right here where I'm standing, sitting right in that office, the Oval Office, that allowed that to happen. No, I'm not interested in that. Let's see if they live up to the deal that they signed.
The President of the United States there addressing the Phase 1 trade deal between the Chinese and the United States. The Trump administration also moving overnight to do something that I thought was quite significant. Blocking investments in Chinese stocks by a government retirement savings fund. This has been on the horizon for quite a while, but it's finally happened. I want to bring in Bloomberg's Michael McKee on the path forward here. Mike, financial decoupling, something we've been discussing for quite a while, and here we are.
Yeah, sometimes issues intersect with politics, John, and this seems to be a situation where that is happening. Our Jenny Leonard at Bloomberg News broke this story back in October. The federal government's thrift saving plan, which is the retirement plan for federal employees, had decided back in 2017 that they were going to shift $50 billion into the MSCI All-World Index, basically the index that includes stocks from everywhere, including China. And that raised some opposition from people who say that if you're putting money into Chinese stocks, you're putting money into firms that sometimes steal U.S. technology, don't necessarily have the best books being kept, and are competing with American companies. And it's been a dispute for a while. And so there was a legitimate question about whether this should happen, and now it seems to have intersected with the president's need to send a message, a warning shot to the Chinese, and he's decided to go ahead and block that transfer of money. It's not going to have a huge effect because the $50 billion was going across the index. About 8% of it goes to China, Chinese stocks. But it is sort of a message to the Chinese about the administration's view of what our relationship is right now. That said, the trade relationship has been working, even if the two sides are making noises like the president's comments yesterday. The Chinese have been buying sorghum, they have been buying corn and wheat, and they have just recently announced soybean purchases, major soybean purchases. So the phase one trade deal seems to be happening. No word on whether it will completely happen, whether they'll get through all of what they promised this year, but the Chinese so far living up to it, neither side talking about actually renegotiating it.
Michael McKee, always great to get your thoughts on the program. Mike McKee there on the relationship between China and the United States. Let's be clear, I think this is going to be a massive issue. I know you all agree, I'm sure you all agree, ahead of the election later this November of this year. An election that's going to centre around, of course, a whole host of issues, but particularly on foreign policy and when it comes to trade in China. That's going to come at the epicentre of this. This is one of the things that Democrats and Republicans largely agree on. I imagine it's going to come down to who's harder on China. Now, whether you think that's acceptable or not is not really the worry here. It's about what happens, not what you think should happen at this point, at least as far as financial markets are concerned. This is what Sarah Bianchi of Evercore ISI had to say on the issue. She said the following: President Trump and his allies are launching a full-scale campaign to frame Vice President Biden and Democrats as weak on China. Tough China rhetoric has been central to President Trump's political strategy, particularly in winning over voters in the Midwest. I want to bring in Sarah now and start that conversation. Sarah, where do you see this going? We're seeing incremental steps overnight, just in terms of financial decoupling. How far do you see this being pushed?
Well, I think the president is going to go as far as he can without really, really disrupting in a major way an already weak economy. And so, as you mentioned, this step with the $50 billion is not significant in terms of the actual financial market, so it's a good place to start. We expect there will be more executive orders around the supply chain, particularly around the pharmaceutical supply chain. So expect the rhetoric to heat up. But just as we saw in 2019, the president has to be careful here and not roil the financial markets and the real economy any more than they already have. And so I think that'll be the line. And then the other thing, as you heard in his remarks, talking about other occupants of the Oval Office, we expect he'll also try and make this very much a choice and try and portray Vice President Biden as extremely weak on this issue.
Well, Sarah, let's talk about this issue. How on earth does Vice President Biden look strong on this issue when previous administrations, which he's been part of, look so weak?
Well, I think the job that the vice president needs to do is something you saw in the recent ad that his campaign put out, which is really calling to question whether President Trump's strategy has worked. I think that you saw an ad from him questioning why wasn't he in and insisting on being in Wuhan and sending public health officials in February. And I think you also should expect to see him call to question, what about these purchases? Is China really holding up their end of the bargain? And so I think it probably will be some of not only outlining what he would do in this new era, but calling to question whether this tough on China approach, which has been core to the president's strategy since 2016, has really yielded progress for the American people.
Sarah, let's talk about progress for the American people with the next stimulus package. There are so many differences right now that we need to reconcile to get over a finish line and get more aid into this economy, to the people in America and to businesses as well, to do more. How do we reconcile those differences? And can you just identify the key ones down in Washington at the moment?
Well, I agree with what someone on your program said earlier, which is Secretary Mnuchin has done a masterful job of negotiating these early stimulus packages and bringing together Republicans and Democrats in Congress. I think the divisions are getting wider now, and I think the other problem is we don't have the pressures either from the markets or from the PPP running out. Those were critical to driving some of the early packages. Washington often needs something staring it in the face to get action, and I don't see that here. The differences now are extreme. The Democrats in the House are going to come forward with an extremely robust, comprehensive package. The Senate Republicans are saying, let's wait and see. Let's see how this is all going. And they're also particularly interested in some liability protections for businesses that reopen. That's really a non-starter with Democrats. So we're pretty far apart. We don't see a package really coming together until at least June. And then, again, we're looking to see what is that external event that makes everybody say, okay, let's put differences aside and sit down and hammer something out. And we don't see that yet.
Sarah Bianchi of Evercore ISI on the latest down in Washington. Sarah, appreciate your time this morning to try and get hands around what's happening down in Washington and what happens next. Let's get you on the price action, shall we? Abigail Doolittle taking a look at the sector composition of a market rally off the bottom of the last month or so. Good morning to you, Abigail.
Well, John, it's interesting because in the last 20 minutes or so, we went from a modestly risk-on tone sector-wise to neutral, possibly even slightly risk-off. If we use the IMAP in the Bloomberg terminal, I will show you what I'm talking about. So not so long ago, all sectors had been higher. Now you can see just 3 are higher. 2 of those are the defensive sectors, consumer staples and healthcare. So investors are bidding up defense. On the other hand, on bottom, you have a lot of those cyclical sector groups, including real estate down 2%, energy not being lifted by crude oil's rally today. Of concern, the financials once again down 0.7% over the last 7 days, down more than 1%. That key sector cannot get out of its own way, it seems, this year. And then take a look at tech, down 0.4%. If we lift the lid a little bit more on tech, it's sort of interesting here because we do have hardware higher. On the other hand, we now have chips lower, but really lower, that software index. So some of the stay-at-home stocks not doing well, John, today, including ServiceNow, of course, that software and cloud platform down about 4%, and Microsoft is also lower. So it'll be interesting to see whether this neutral sector composition at this time continues into the day, John.
Whether we can finally get some rotation from the mega caps, some sustainable rotation. We've seen glimpses of it over the last few weeks, but nothing durable, nothing sustainable. Abigail, great to catch up with you. Always fantastic to get your insight on this market. In this market right now, we're about 22, 23 minutes into the session. We do turn a little bit lower. The S&P 500 down by 0.4%. The Nasdaq off by 0.55. Next up on the program, we'll run you through the week ahead. Chairman Powell tomorrow, retail sales coming up on Friday, and a ton of debt issuance in between. From New York City, this is Bloomberg. 25 minutes into the session here in New York City, this price action shaping up as follows. On the S&P 500, we are slightly negative, down 1/3 of 1%. On the Nasdaq, we are negative by 1/2 of 1% after a really strong rally on the Nasdaq off the bottom. Just in terms of the sector composition, staples and materials leading the gains. The losses coming from real estate and the financials. The financials having a really rough time of things over the last few months, over the last few years, if you're looking over in Europe as well for that matter. The likes of JP Morgan still down 30-odd% from the highs for this year. Let me take the opportunity to get you the trading diary quickly, get you in good shape for the next couple of days. At the top of the hour, a Senate Health Committee hosting top U.S. officials, including Dr. Anthony Fauci, to discuss the coronavirus. The Fed's Randall Quarles testifying before the Senate Banking Committee, and then later President Donald Trump meeting with Senate Republicans at 4 p.m. Eastern. Fed Chair Jay Powell will be speaking tomorrow morning. A little bit later in the week, we'll get initial jobless claims. And finally on Friday, the data point of the week, U.S. retail sales. From New York City this morning, good morning. That does it for me. Stay well, be safe, and thank you for giving us an hour of your time. From New York, this was the Countdown to the Open. This is Bloomberg TV.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest-hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food, they're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He's all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has coming here yet. So we need a refill of this medication. After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá? I'm asking about why he's alone right here. He said things of in life happens. Yeah, I'm here by my side. So ¿dónde vive acá? En la parte de This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Order submitted. Order submitted.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue, and it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Order filled. Order canceled.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname
Pocahontas.
Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Order filled. Order filled. Order canceled. Order canceled.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world.
Order canceled.
Born in 1971 in Townsville, Australia,
canceled.
Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
When people think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for
Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited as having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia
a regional power.
Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with
Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. election.
Yes.
The U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world, yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to us, say, 24 people went for the job. 23 people were accepted. I was the only one guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma's an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker, and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different?
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, Value-Ag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
"... 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. origins of the creative content of a lot of the work at Lightbright comes from a variety of sources. Sometimes people come with a napkin sketch, some people come with an Adobe Illustrator file, and we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. Turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress. And sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular. But one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature, and it allows for all sort of external stimulation to fall away, and your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind. I think I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I learn so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is opened, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube and we evacuate that out. We introduce the gas into it. And we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when you see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
It's a bit like an addiction. You've got to make something, you have to do something. It's borderline obsession. And every bike we build is my favourite bike at the time, and as soon as it's done, I want to build another one. Spend cycles is something I've been thinking about ever since I started cycling in my late teens. We want bikes that ultimately you'll really enjoy riding. There's never a bike that's the same. There's always a slight change. And as we build them individually as well, they have the marks of a bike that's built by hand. Most people I know cycle have an idea of their dream bicycle. And it may be an evolving idea you've had in your head. And we've worked with a lot of people that have come to us with sketches and scrapbooks. It's really, really nice to build something that's just one-off and unique. I think a lot of people see a bicycle as two wheels and a frame in the middle. There are a lot of subtle changes and nuances in design which can change the riding characteristics quite dramatically. I'm a really big fan of modernist architecture, and the simplicity of a modernist building is really hard to achieve. And with some of our bikes, they may look very simple, but I think people should not underestimate the time and effort that goes into designing a product. Tubing is key to a bike's feel and ride. Reynolds tubing has been in my life ever since I can remember. Growing up, I could never afford a frame manufactured with their tubing. We can now put a badge on our bike saying manufactured at Reynolds, which is a sort of thing as a kid I just wouldn't have believed was going to happen. Every part of the bike has a specific tube. It's not universal. The first thing we do is get the tubes out, check they're correct, check the wall thicknesses, sand the edges, make sure it's all really clean, because if it's not clean, the tubes won't join together correctly. We build in steel because I still believe it's one of the best materials to use. It's been used in bikes since the late 1800s, and they're still using it now. For a very good reason. It's the flexibility that we can replace the tube, repaint the bike, and you wouldn't know it's damaged. I just like working with it. It's very, very sculptural. This isn't sort of aerospace precision engineering. It's a steel rule and a marker. So when we're cutting the tubes, it's within a mil or two. But what we're trying to do is take the best from bicycle building in the past and add a little bit of modern flair to it. There's various techniques for building bicycles. We do a thing called fillet brazing, where you connect a pipe together. We use a bronze rod and a flame. We heat the tubes up to the same temperature and we fill the joint with bronze. And it gives a very, very sort of fluid, lovely, sort of quite sculptural feel. You've got to practice, you've got to be able to judge material temperatures, you've got to just look at it and you just get a feel for it. It's the stage where your tubes start to look a bit like a bicycle. My father's a jeweller. He'd make sort of very pretty things. Which are lovely, but for me, they don't really have any function. What I love about bicycles, you can start on a Monday with a box of tubes, and you can be riding it by the weekend, and it can last you for the rest of your life. Outside of the frame and forks, the other most important part is the wheels and tyres. When you build the wheels, you have to lace them, so there's little holes going all the way around the rim. You poke the spoke through. We do build all our wheels by hand here because a machine can't get 30 years worth of wheel building experience. Colour is very, very personal. With any of our bikes, you can have them painted whatever colour you want. We've matched one to a teapot, so we can get that scanned and we can match that or someone's favourite item of clothing. I like to let the bike sit for 4 or 5 days minimum, just so the pain can have time to cure a little bit. And then we assemble it. We get out all the new components, and it's a case of putting them together. Some bikes you can assemble in 3 hours, some will take 3 days. And we've built bikes that cost in the £10,000 plus mark. Some people, they're saving up and this is their bike and they're going to own it for the rest of their lives. So we just want to make sure they get the right thing. I think the bike for me was the first time I had some freedom. So as soon as I had one, I was off. A lot of people still get that thrill as when they were a kid blasting down a hill, wind going through their hair. It's fun. Everyone has their favourite jacket or something that just makes them feel good. If you've got a bike that fits well, you actually feel part of it. Building bicycles as a creative outlet is fantastic. It's not something you do because you're going to get a big paycheck at the end of the day. You do it something you have a passion for it.
If you ever saw a wooden surfboard, it was probably hanging in somebody's house or underneath the deck. But kind of in the last 10 or 15 years, wood has made a big comeback. surf wonderfully. It's beautiful and it feels great to be on one of them. I always had a love for wood and kind of passionate about things that went in the water. I've kind of been around wooden boats most of my life. There's just so much character. The way they're built, the stories that come with them, a lot of that has translated over to why we build surfboards the way we do. When we first started thinking about building surfboards, wood was the natural material we chose. They have a very high strength to weight ratio. Wooden surfboards have the longest history of use in the surf world than any other material. People have been surfing wooden surfboards since kind of the first documented history of people riding waves. The board starts in CAD, where we take a 3D model, break down the shape, and kind of create frames and templates and all the inner parts of the board that we get cut on a CNC machine. We take those frames and we just pop them out, assemble the frame into kind of a skeleton. We go out to our lumber shed, pick a bunch of cedar, and bring them into our mill shop, put glue along the edges, clamp it all together into a panel. Everything's book matched, you have symmetry in the colors and texture of the wood. Cut your outline. Take our assembled frame, gently put it down right on top of the plank. Once that foundation is started, you're basically building up the three-dimensional shape, the outside part of the board, using lots of strips that kind of interlock and fit together. Every piece of wood is going to be different, and it's all going to react differently. There are frustrations with it, but I think that's one of the things that keeps it challenging. You learn to read the kind of what the grain lines are doing and what the color of the wood is telling you. Once those rails are cleaned up, we put our top planks on. It's a little bit like putting a lid on a box. It's like, this is it. Whatever's inside that board is staying inside that board. And by tensioning some rope, you can clamp the two together. It's like a time capsule. There are frustrations. What makes our boards unique are they are built right here in York. They're built using material that grows right here in the state of Maine. They're built 100% by hand by local craftspeople and surfers. There is a lot of time that goes into these boards, between 40 and 60 hours start to finish. We wanted to build surfboards that were as hollow as they could be, but still be strong enough to work well. Too light and they don't surf well, but too heavy and they don't surf well. So there's a balance point there, and that's where we try to be. Taking the board off the rocker table once the top has gone on, that is by far one of my top favorite parts. It's just you and a shaping stand, a board, and a hand plane. Everything else is out of your view. It's simple, it's pleasurable, it's quiet. You can be with your thoughts and you can just kind of be present. There's something about taking a nice sharp edge tool to a beautiful piece of wood and feeling the curls coming off and knowing that every pass that you're making, you're kind of getting it closer and closer to what you have in mind. Once we've shaped it down and the board's looking like it's supposed to look like, time for it to go into the glassing room. 4-ounce fiberglass, laying it over the board, draping it over the edges, cutting it, applying epoxy, and on the board. Once both sides are lamb coated, it's time to put in the hardware. Drill and router and install the fin box. And on the other side, we drill and put in the leash plug and a vent. There's a lot of air just naturally inside the board, and that air wants to expand and contract with temperature changes. And that vent has a little piece of Gore-Tex fabric in it, and it allows air to kind of breathe both ways, but it doesn't allow water to get in. Once all that hardware is put in, it goes back into the glassing room. We brush a nice, beautiful, thick coat of epoxy over the whole surface, and that we call a gloss coat. That's supposed to look beautiful and glossy and shiny and flawless. You get to see that board come to life. Whatever the colors in the wood, they really come out. It just makes it look like candy. You just want to touch it and run your hands down it, and it's just kind of the icing on the cake. once everything is hard, we put it into what we call the oven, get that epoxy to cure, really kind of bake it, and just get it to harden. Put in the fin, screw in the vent, and ship it out. We just love the idea of building something that's sustainable and long-lasting and made by hand. Kind of gives you a deeper connection to the product over something you might buy on a shelf. When a customer gets the board, they feel it. They 100% feel the amount of work and the amount of passion that went into the board. So I'm not really looking at hours and efficiency. We're looking at like doing it right and enjoying it as we go.
Ma Baoli, better known as Gung La is one of the 4 Grand Marshals leading New York's Pride Parade this year. But in the country he comes from, being gay is still a social taboo. The CEO of a Beijing-based internet company is on a mission to improve the lives of millions of gay men in China.
对于每一个 LGBT 人群来说，即使这个国家不允许你跟同性爱人结婚，但是你仍然要勇敢地去选择你自己的生活，你仍然应该拥有幸福生活的权利。
Ma's company Blue City runs an app and a website specifically for gay men. Blue is one of the biggest gay social networking apps in the world, with an estimated 30 million registered users. Unlike most other apps, Blue is more than just dating or hookups.
大家可以在我们这个软件里面找他自己的情感，然后可以阅读相关的内容，然后可以进行一些娱乐，比如玩游戏啊，比如看直播啊等等。
Back in 2000, when Ma studied at a police school in northern China, he realized he didn't feel like everyone else.
因为他们都找女朋友，然后谈恋爱，但是我对长得好看的同性的男生，我反而觉得对我更有吸引力，所以那个时候我就到互联网上去找这样的一些资料，然后希望能够告诉我自己我到底是谁。互联网上所有的信息都是负面的，都是错的，就是说同性恋要电击疗法，要被治疗，然后要吃药等等。
After visiting some foreign websites with different attitudes to homosexuality, Ma created his own site for a Chinese audience, encouraging people that
他们也是正常的，他们不用自卑，然后也不用自杀。
even though attitudes towards homosexuals are slowly changing in China, it's still a social stigma. The virtual world of Blued, where members can be open about their sexuality, is for most a striking contrast to their real lives. This is live streaming, a function added to Blued in late 2015, right as the internet craze was starting to take off in China. Many self-made stars like Jin make decent amounts of money by receiving audiences' virtual currencies and gifts.
我们不是彼此的初恋，初恋这种事儿多不靠谱啊。
For Kyle and Klaus, a couple who have come out, live streaming on Blued means something different.
其实我经常会收到很多粉丝的一些互动的留言，就是类似就是说你们让我们看到了同志情侣之间的一些希望啊，我看到这样的留言我是很欣慰。
The government's rules for acceptable content online may shift quickly in China, with LGBT material in a grey area. Many companies feel the chill of the recent internet crackdown. But Blue City still runs as usual. Ma has won the Chinese government's trust by helping with HIV prevention among gay men. A third of the company's staff are dedicated to screening pornographic and politically sensitive content.
我不太多的愿意去对抗，我更多的愿意去对话，去改变他们的想法。我觉得这个可能在中国来说是更有效的。
In the past 5 years, Blue City has grown from a team of 7 people promising business with about 250 staff. Ma said the company earned over $15 million last year, mainly through advertising and selling virtual currencies to live streaming audiences. Now the company is expanding overseas.
我希望吧，通过我们的努力，WMBoT能够成为全球第一家在美国纳斯达克或者是纽交所上市的这样的同质互联网公司。
This is Rich Jigga. He's a Chinese rapper by way of Indonesia, and he's very popular on the internet. This is Joji. He's a Japanese-Australian singer, and he's also very popular on the internet. Plus, Joji invented the Harlem Shake meme. Let me say that again. This guy, Joji, in the blood bathtub, invented the Harlem Shake meme. But we'll come back to that. So Rich and Joji are both signed to 88 Rising, an entertainment company hoping to build a lasting global brand that will outlive singular moments of virality. They primarily create content combining Asian culture and hip-hop, a formula that apparently pleases the internet gods greatly. They've only been around for 18 months, but they're already putting up major label numbers.
I think that we have an unprecedented collective of talent, a group of like predominantly Asian artists, you know, really like making waves globally, which from an independent point of view as well.
88's founder, Sean Miyashiro, cut his teeth launching Vice's electronic music channel, Thump. But quickly, Sean became interested in life beyond dance music.
I knew that after launching a whole content platform that I have kind of the ability and the know-how to do it again, but like for what was the question.
So Sean moved to the Bronx to start over and figure it out. He couldn't afford an office space, so he worked out of his car at the top of a grimy parking garage.
Everything kind of started here. If you look around, this is my environment. This is my serenity, really. 88 Rising was built here. Built on the grounds of LA Fitness residence in a parking garage. I was living in the Bronx. I'm just like, damn, where the hell do I go? So I just come up here and I like, you know, I just kind of figure things out every single day. Being like, okay, what the hell is this thing? Coming here, 88 Rising was built here. It was kind of like my own kind of private office, basically. Like, to be honest, I would even go to the bathroom here. I would like take pisses here, you know what I mean? Like, it was, you know, it's too far to go back down there. When I need Wi-Fi, I'd spend a good part of the day at Dunkin' Donuts. Hi, how are you? Can I get a chicken snack wrap?
Before 88 Rising officially launched, Sean caught a surprise break in the form of a Twitter friendship with a funny 16-year-old kid from Indonesia named Brian, who taught himself English by watching Rubik's Cube tutorial videos on YouTube. Seriously, that's true.
I thought his Twitter was genius, from the future, just crazy. And like just the shit that he was saying, like the memes he was making. But I didn't know that he rapped or anything like that. I really didn't. And he came up with that stick like 2 weeks later.
Dat Stick was Brian's first ever attempt at making a rap song, and it immediately went viral.
Everything was great about it, but the one thing that I noticed is the song was hard as hell. Just like everything about it, man. Just like, it was menacing, bro.
Soon after the video dropped, Brian signed with 88 Rising.
I'll FaceTime with Rich. Sorry for calling you Rich Chiga on my phone, Rich. Brian, he gets like super pissed off that he's saved in my phone as Rich Chiga. He's like, dude, am I not a human to you? What's good, bro?
What's good, brother?
How you doing?
Doing great. I did the sound check.
How was it?
It was tight.
So, Brian could definitely rap, but some viewers understandably took offense at a Chinese kid satirizing rap cliches and calling himself Rich Chiga. But if a group of well-known rappers saw the video and genuinely liked it, that could at least help validate Brian as a legit hip-hop artist. Plus, it could be really funny.
It was just kind of an idea that kind of I just had on the spot. Everything that rappers say is better and funnier and smarter and wittier. You know, and it's just more entertaining. We just edited it as tight as possible, put it up, and it really worked.
Yo, this nigga got a pouch on and a Reebok pouch.
This is the hardest nigga of all time.
He said, when you come for a chigga like me. That was dope.
Like, it's just lit, and I think people will take it as a joke at first, but it's like if he ran with that and kept doing more videos like that, it's just lit.
You know, I'd never been to America before, and like all of a sudden, just like I see like all the rappers that I listen to just like reacting to my stuff, and I was like, what? How did this happen?
The reaction video also went viral, and even led to a remix of Dat Stick featuring Wu-Tang's Ghostface.
I'll get on that track. You know what I'm saying? Yeah.
Really, on the remix?
Yeah. Oh, you know him?
And yeah, the remix went viral too. Brian has since acknowledged the misstep in his name and claims he may change it. But for the time being, he's still Rich Chiga to his fans, an ever-growing global audience, hungry for more releases from emerging talent around the world.
I didn't know that it was gonna be this impactful and this important to people, and I'm very thankful and blessed that it has. And every day now that I wake up, it's like it's just like a new mission every day.
A major part of that mission involves Joji. Remember the bloody bath guy? He's a former YouTube personality in the middle of a career transition.
The sound of this song, Will He, it's like a trap song that you can like slow dance to. Awkward prom shit, you know what I mean? I used to do crazy episodic internet videos. It was going well, and one day it was me and a few friends just in a room. We were casually chilling, and then someone plays the song, and it's brand new at the time. I happened to have a lot of costumes laying around, so I told the other guys, I was like, get in these costumes and let's just dance to it, like who cares? We were like, okay, let's just go crazy at the drop. So that video goes up, I go to sleep, and the next morning, everyone's doing it, like next morning. That taught me a lot about the internet, how people want to just be a part of something. And from that point on, something changed, and I was a little better at understanding demographics and people and what they want to see and what they want to hear. I was friends with a couple other artists who were affiliated with 88, and then I also started to realize that 88 is the bridge between Western and Asian entertainment, and I really wanted to be a part of that.
Joji just released the In Tongues EP, his first project as a serious artist.
Joji's In Tongues record came out a couple weeks ago. It's #2 on Billboard on the R&B charts, which is crazy for an independent release, and he's like a brand new artist.
And the success is even more impressive, knowing he went from creating something like this,
it's just Taco Bell, what could possibly go wrong?
to creating something like this, the newest music video for his song Demons. Tonight, Rich Chiga has a show in New York City. Tickets sold out in an hour.
I came here, I'm first online. I was here at 1. I was the third person online.
So why'd you get here so early?
Because I want to see Rich Chiga. I want to touch him.
What do you guys think of Joji?
He's
That's my dad, son. Did you guys cop the new EP or like?
Yeah. I woke up at 6 in the morning just to cop that shit. And then I listened to it, and that shit started making me cry.
This is actually kind of exciting. Every time, this never gets old. Like, you live online and social media, but like, there's nothing like just being with the people.
More often than not, viral success happens by accident. And then after an appearance on Ellen or Jimmy Kimmel, the creator's star power fizzles out. But 88 Rising has figured out how to turn potential gimmicks into brands with an actual following that keeps coming back for the next thing.
Oh shit!
So keep an eye out for 88's next move. but more than likely it won't be covered on network television or terrestrial radio. Although, as they've already proven, nowadays that really doesn't matter.
Online retailer Farfetch is betting it can shape the future. This is its concept store, showcasing the latest in retail tech.
How do you capture all of that fantastic information that you gather in store when customers touch and feel products? And we created a concept called the connected rail. And this is using a combination of RFID and ultrasound. The RFID signal recognizes the product, and the ultrasound recognizes the movement. Take the product off, and then you'll start to see your products appear. And essentially, it's like online browsing behavior. Whichever products you touch and pick up in the store are automatically sent to your app. This is effectively what you've created is your in-store wish list. In the middle, you'll see essentially a hologram of the product. What the customer sees, they control the experience on a touch device. What this allows the customer to do is take elements of products and then add their own style to it. Right, so this is the connected mirror. So in this example, I see my products. I select a coat, and that's tried it, and it's slightly too big for me. So what I can do is choose an alternative size and send a request to the sales associate, and they'll bring that size to me in the fitting room mirror. You'll also see that we've got some product recommendations here. Crucially, the sales associate's able to push items into the mirror from their device. If you wanted to, you could simply use the mirror and pay and go. Your items would then be packed and dispatched to you afterwards. You'll also see that we've got some product Your items would then be packed and dispatched to you afterwards.
you want me to turn you so you're looking outwards? Yes, please. How about there? First time we came out with B, Jade said, it feels like I've been released from prison. Do you want these, Mrs?
Definitely.
Definitely. Right. Yeah. And she could say hello to everybody, people she hadn't seen for months.
It's
Hi, it's Jade.
Oh. So you can talk to Jade through this.
Hi, Katie. She's there.
Hi.
First time we came out with B, Jade said.
Every time anyone's seen her, they want to know why she's there. And it's kind of the opposite of when you're in a wheelchair and people see you and they kind of go, oh, should I look? I don't know what the right protocol is. When there's a tiny robot with its bright little eyes going around just looking happy everywhere, it really opens you up for conversation.
You've got some friends here, look.
Hiya. When I saw her for the first time, I remember thinking, this is going to change things. This is one of those points where if this was a book, this would be the cliffhanger. I have a condition called Ehlers-Danlos syndrome, which means that I have a lot of dislocations, there's a lot of pain, and a lot of seizures and whatnot. So I can end up on my own in my room for long periods of time. A lot of the time, with a condition like my own, of course there's the pain, and the pain is bad, and the dislocations are bad, and the seizures and being in paralysis and never knowing whether you're going to be able to wake up properly tomorrow, that's bad. But what's worse still is being able to count the number of people you see a day on one hand.
Are you ready?
Sure am, I'm just hoping the connection's going to stay.
Yeah, me too. Alright, here we go.
When you're used to just the same little metre by metre and a half window every day, and you've been there for months, being able to just see the sky from somewhere else, or the tops of trees, or a sign is incredible, or being able to have that kind of chat in the car that most people would probably take for granted.
I'm going to go past Grandma and Grandad so you can give them a wave. Now, if Jade is particularly seizure-y, she can still take part. And that's brilliant, really, because before she would just be left in a bed or in the house with just her carers. It's quite a small world, that.
Right, so there's one of her. Here, this costume I'm busy making at the moment. When I'm not on bed rest and I'm not just wearing pyjamas all the time, I enjoy being able to dress as different characters and go to Comic Cons and that kind of thing, because it just lets me show a different side of myself, and it's a bit of fun. If you can't go out that often, you've got to enjoy it when you do.
Was that? Good.
It's It's one of those weird things where I want to not have to use B because I want to be well enough to be able to go to those places myself. Like, it really makes a big difference to me to be able to go into school. But the thing is, with my condition fluctuating all of the time, I can't go into school reliably. He's written it out bigger on the board. Thank you. Today's the first day that I've been in school via B, and so far it's interesting. Still a few little things that we need to work out, but for the most part I think it's going fairly well. And it's brilliant because I can really tell the difference between today and yesterday. How yesterday I forced myself to go into school when I wasn't very well, and I was really tired afterwards and ended up having loads of seizures. Whereas today I've been able to do all of the work. I've been able to keep a clear head and not be ill, which means I'm able to be more focused on my schoolwork.
So there is my first step of working, is to simplify. Route 8. The algebra test is next week.
Now I'm trying to make friendships which I'll be able to maintain with B. Before that, I end up letting people down quite often. B gives me hope, yeah. She's just always there. And if I can't do something, she can. And if I need sort of assistance to be able to make commitments, then she's there, and she means that I feel like a more valuable person. Because I'm more reliable.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as the class of devices like internet as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.